It is Thursday, February 11th. We have a special edition of Yahoo Finance Live this morning inside the C-suite. Over the next 2 hours, we're going to be breaking down earnings numbers with top executives. We'll also be talking about their challenges and opportunities as they look ahead to 2021. Included in our blockbuster lineup this morning, Patrick Spence, the CEO of Sonos, Hugh Johnston, PepsiCo CFO, Jose Sil, Chief Executive of Restaurant Brands, and Ynon Kreiz, CEO of Mattel. And that's just a few of them. We will have more executives from Yeti and Zynga included. And of course, we're going to keep you posted on all the market action. Speaking of which, let's take a look at futures this morning. They are pointing to a higher open. This is after the Dow yesterday closed at a record. The S&P and Nasdaq touched intraday records during the session, but then fell back by day's end. We should also mention we got jobless claims numbers this morning that were disappointing in terms of job market improvement. 793,000 people filing for unemployment claims last week. So we'll be weaving that into the conversations as well. I'm Julie Hyman. That's Miles Udlin and Brian Sozzi along with me. Brian, of course, is particularly pumped this morning by this lineup, and that's saying something for Sozzi to be particularly pumped. Before we get into our conversations with executives, we do just want to bring you some of the details of some of the earnings stories that we're watching this morning. One of them is Uber, that company coming out with its earnings after the close of trading yesterday. The company's loss shrinking on a year-over-year basis. Revenue was down by 16%. That was a little bit of a miss of estimates. And you have this continuing balance at Uber, right, between its traditional or its more bread and butter sort of ride-sharing business. And then, of course, its newer delivery businesses, food delivery. Now it's getting into the liquor delivery business with its acquisition of Drizzly. And so delivery bookings pretty much doubled. Ride bookings were cut in half. So this illustrates sort of what works. Hopefully that part of the business will work if the other part isn't working. Miles, what do you think here? Has Uber sort of gone the right path in terms of this balance that it's got?
I mean, it's kind of crazy. It's a completely different company. Really, you look at the revenue split from the most recent quarter. The delivery revenue, so the Eats business, was about $100 million less than what they saw on the mobility side, which includes basically it's all rides. They have a few other things in there. If we go back in time a year, that difference was $2.5 billion. So yeah, revenue came down overall for the business, but the mix has gone from, something more like 85-15 to essentially 50-50 inside of 1 year. And, I think when you look at the profitability of each segment, obviously the Eats business is not profitable, whereas the mobility segment has been profitable. And again, this is adjusted EBITDA, and we can go through that at a later date. But at least as Uber is defining it in their reports, they've been making money on the rides. It's the other stuff that has been a money loser. Now, Julie, as you mentioned, the losses in the Eats segment shrank during the last quarter, but still that is operating in the red. And we also saw the profitability in the mobility segment come down significantly during the latest quarter. Now, again, I don't really think, Uber put it out there that they were going to be profitable fourth quarter 2021, I think it was. So they made it a profitability story. Uber, of course, has never really been a profitability story over the course of its life cycle as a business. Uber has been a story about how they can change all these different services using their technology and so on and so forth. But I think it's just an amazing transformation of a company on the fly. You look at the stock, the street is certainly excited about the direction they're going. And I think when you look at the results we got from Lyft the other day, where they're pure play, or purer play, I should say, in the actual, bringing people from one place to another space. I think it's very interesting just to watch the different paths these two companies are charting right now. Uber, again, is just a completely different company than it was a year ago. And I don't see, Sozzi, how that's really going to change materially when the pandemic ends, even if people start taking Ubers again. I mean, this Eats shift is serious, and it's not like the management team is going to, walk away from that. They've made several acquisitions there as well.
Yeah. I also, if I could, just quickly want to bring in what's going on with the food companies this morning, because we have a number of different companies reporting in food and beverage. We've got Pepsi, we've got Kraft Heinz, we've got Kellogg. And The sort of overall theme seems to be that people are still snacking at home more than they were before. We saw sales at these companies go higher, although Kellogg's, if you look at just its organic sales, excluding currency effects, it wasn't quite as robust as the other. Kraft confirming it was selling its nuts business, including Planters, to Hormel. And Pepsi, if you sort of break it down and look at its organic growth by division, definitely saw growth in snacks, but surprisingly, perhaps, Brian Sazi, considering how many people are not going out and buying soft drinks in restaurants, their beverage business is doing pretty well also.
Yeah, and I'm glad you brought that up because there's a key difference between PepsiCo and Coca-Cola and what we saw from Coca-Cola yesterday. A large part of Coke's business is still off-premise, so a lot of sports stadiums, a lot of fountain drinks. PepsiCo's business is more direct to consumer, people going to the supermarket buying those type of products. That's why I think you saw that business hold up well. And then lastly, I would say PepsiCo is about 2-3 years ahead of Coca-Cola in just cutting expenses out of its business. Coca-Cola last year sacked 11% of its workforce. In many respects, I think catch up to where PepsiCo is in terms of just operating a better business. But I'm also glad you brought up Kraft Heinz because the sale of Planters continues that company's transformation. To what Miles just said on Uber, Kraft Heinz is showing that it also is a different company. And I think they will continue to spin off assets in this business to reduce debt and invest in more growing parts of the business, guys. Let's go from food to speakers. And judging by the quarter and raised outlook from Sonos after Wednesday's close, a whole lot of people are building some pretty epic home theaters during the pandemic. Sonos said sales rose 15% in its first fiscal quarter, earnings up 58%. Joining us now for a first on Yahoo Finance is Sonos CEO Patrick Spence. Patrick, good to see you as always here. This is the second quarter in a row you have told investors you have reached an inflection point in your business. Sales up 15%, operating margins up close to 1,000 basis points. What in the world are people buying, and are these results sustainable?
They're buying everything. We had a strong performance right across the portfolio. And when I talk about inflection point, it really goes to the fact that the number one driver of new homes coming to Sonos and new customers is people that have existing Sonos systems telling them. And we've seen that really work as a flywheel here where people are telling their friends and family, they're coming into Sonos, and they're buying all of the new products that we have. You did mention home theater. That's a big category right now, obviously with a lot of the streaming video companies doing first run movies going straight to home. That's been huge. So that's been a particular area of strength. But right across the portfolio, we saw some incredible sales in our fiscal Q1.
I was a little bit surprised, Patrick, to see that the strength of the margins and the sales, because the last time we spoke, you were seeing some product shortages, just not able to make enough products given the crush of demand. We've seen a lot of companies do this or experiences lately. Peloton comes to mind. Have you seen any lessening in those product shortages?
Our team has done an incredible job. I mean, on its own face, it's an incredible job, but in the face of the pandemic and all the challenges that have happened across supply chain that you guys talk about all the time that we've seen, our team has just stepped up and done an amazing job. So to deliver, beyond the expectations we had for the quarter when there are component shortages, container shortages, port delays, COVID and people catching COVID in the supply chain, is just tremendous. And I'm so proud and thankful of the work our team has done. And, there's still lots going on in the supply chain right now, but our team has done a great job just trying to balance everything, making sure that we've got some safety stock here and there. We're still a little behind on 3 products, as we mentioned last night, and we hope to have those caught up by the end of this quarter.
Patrick, I just want to ask about guidance and really just the ability to be able to issue it. We've talked to a lot of companies who haven't been able to do that for several quarters, really since the pandemic began. And I'm just curious, you mentioned some of the challenges that you're seeing in the supply chain and getting things in stock, but it does seem like enough of it has leveled out that you are able to, at least offer some guide map publicly that you're comfortable putting out there.
Yeah, it's a great point, Miles. I think over the last 3 quarters, we've really learned a lot. We've shown a lot of resilience. And so we feel comfortable being able to look to the future. We also know our roadmap quite well. And so we have a good feeling around that. We're in close contact on one side with all of our supply chain vendors and our manufacturing partners, and then on the other with our retail partners and everything there. And so we feel very good about where we are. We do have an advantage, again, because of our system and the fact that 40-ish% of our sales come from existing customers coming back and buying more. We almost know that that's going to happen as well. And so we do have an advantage, I'd say, over most hardware companies in the way that we have better visibility as we look at the future. But yeah, it looks like an incredible year to set up a even more incredible long-term future.
Patrick, it's Julie here. How big is the market overall for smart speakers? I mean, when I think about Sonos, I consider it a premium product. It's certainly not an inexpensive product for most Americans, most people globally for that matter. But on the flip side, I've been surprised at, say, how something like a Peloton has seen the penetration that it has had at the price point that it is. So how do you think about that?
I really think that it's something where if you create an amazing experience, people are looking for something better and they will flock to it. And, I think the audio market in general is about $60 billion a year. We've just produced guidance which shows about 1.5 to 25 to 1.575 billion. So we're just a small sliver of the world's audio market today. So we feel like we have a huge opportunity in front of us. It's not just smart speakers, it's home theater, it's the components that we do through our installed solutions partners who are installing systems in wall, in ceiling at homes as well. And we think there are a lot of categories for the future that we can play in that we don't play in today. So there is a huge opportunity ahead for Sonos.
Patrick, we're talking to a lot of leaders today, really get inside their minds, and you're the first one up here. So what is your biggest challenge on the leadership team this year?
Definitely how we manage through a period where we have everyone at home. They've been working like crazy. I think all the CEOs I talk to too, really trying to be thoughtful about how we support our people through this period. And that's been one of our top 3 priorities, is really supporting our people, making sure they have what they need. They're not burning themselves out as we go through this. So we're trying to make sure that we keep some of the special aspects of our culture going as well. We did a lot of in-person events, no surprise, music, concerts, some of those things. How do we bring those to a virtual world? How do we make sure that people are thinking about it as a marathon, not a sprint in this period? And so that's the thing that right now is definitely top of mind for me and my team.
Patrick, I have 30 seconds left. What percentage of your workforce will be back in the office? Are you going to bring them all back, or are you envisioning a hybrid workforce?
So we've already given guidance to our people that the earliest we'll be back is September 1st. We wanted to make sure parents, can manage the summer and everything that happens there. I think we'll see a lot of flexibility, Brian. So we build physical products. There'll be people back in the office, but people as well will have the flexibility to work from home as well. So I think you'll see us trying to do everything we can to, again, support our people and make sure that they have kind of the flexibility they need to get their jobs done.
All right, we'll leave it there. Sonos CEO Patrick Spence, good to see you, and good luck on your March 5th Investor Day. Looking forward to some long-term targets.
You bet. Thanks, Brian.
All right, thank you. All right, do stick around. On the other side of this short break, we'll chat with PepsiCo's CFO, Hugh Johnston, who just wrapped up his latest earnings call. We'll be right back.
All right, welcome back to Yahoo Finance Live on this Thursday morning. Our busy day, busy look inside the C-suite continues here. We're joined now by PepsiCo CFO Hugh Johnston, the company coming off a quarter that beat expectations. Hugh, thanks for joining the show. I'd love to begin by talking about the year where you guys saw organic revenue growth across all of your major geographies and categories. And if I had said to you in June that that's what 2020 would look like, how surprised would you have been?
Probably very surprised, to tell you the truth. The good news is we exist in a business where people need to eat and people need to drink, and that's going to happen regardless of what's happening in the broader context. But we had to spend a little bit of time figuring out how do we operate in this new environment, because it's quite different. And what you saw was Q2, we were down just like everybody else. We got stronger in Q3 and then even stronger in Q4 as we've really figured out how to navigate the environment. If you look at our operating results, every one of our reportable divisions grew 5%, except for Quaker in Europe, and they grew 8%. So I think we've really figured that out. And that's why we chose to, as we entered this year, to give guidance of mid-single digit revenue, high single digit EPS, and we raised the dividend 5%. I feel like we've figured out how to do well in the new operating environment.
Hugh, another good quarter of volume gains really throughout many areas of your business. What happens when folks around the world do get their COVID-19 vaccines?
I think it's going to be more of an evolution rather than a revolution, Brian. I think, the rollout globally is going to take some time. In addition to that, even within the United States, it's coming in various degrees of speed, depending on which state you're in. And I think what you're going to see is some return to the old normal, but some retention of the pandemic behaviors. So I think you'll see more work from home, which implies we're probably going to continue to see breakfast at home being an important variable. I think you'll see people venturing out, so the restaurant numbers will improve, but there's still going to be some reluctance, I suspect, for a period of time. As you said, that probably the best news for PepsiCo is, as sort of this new world has evolved, we figured out how to get to consumers and give them what they want. So I think we're well positioned regardless of the pace of recovery.
Hugh, thinking about some of those dynamics on the other side, I was able to kick my soda habit, but I have not kicked my chip habit. And so what I saw with the Tostitos and Cheetos results certainly stood out to me. How do you see those kinds of brands normalizing as I'm able to go do things in my life that are rewarding, whereas right now a reward for me is a bag of Cheetos, which is great, but I'm not sure that that's going to be true in 2022.
I think the truth, I don't think that we've seen that dramatic an increase in consumption in Frito-Lay as a result of the pandemic. Quaker business has clearly benefited from it because of breakfast at home, because of dinner meals at home, which has obviously played well into our prepared meals business with rice-a-roni and pasta-roni. Frito, I think what we're going to see more of is a channel mix shift. So right now, the grocery business is growing at an accelerated rate, and the food service business is down pretty significantly. Both are important channels for us. So as consumers move to a more out-of-home environment and mobility increases even further, I think we'll just see different areas where we'll get those sales. It's not that the sales are going to be under pressure. It's certainly not the way we're planning the year.
Hugh, it's Julie here. I want to ask you about your workforce. You heard us talking to Patrick Spence of Sonos a little bit about how executives are thinking about their workforce right now. You guys have a workforce that's many multiples of that of Sonos. I think more than 250,000 people employed by Pepsi. How do you keep them happy, especially right now? How are you thinking about women in your workforce? And I also would ask you, if I could, I imagine there's quite a gap in circumstances between the C-suite at Pepsi and sort of the lowest paid workers at Pepsi. How do you keep in touch with what they're experiencing and what their needs are?
Yeah, I think maybe the right way to think about it is the folks that we refer to as our frontline workers, because you're right, we have over 250,000 employees in our company. And so the frontline workers who work in route trucks, who work in warehouses, and who work in our manufacturing plants, that's sort of one big population. And then you have more of an office-based, more knowledge worker-based type of a worker inside of the company. As we started the pandemic, the first priority that we put in place was the safety of our associates is the number one priority for us. And we put a lot of money behind ensuring that safety. Overall, the COVID-related costs for PepsiCo were almost $800 million. Now we expect that to diminish as we come into the new year, but a lot of those things will I think stay in place as well. Whether it's personal protective equipment, having an absenteeism policy that allows people to stay at home and they're not trying to come to work when in fact they're sick. So we really did focus quite a bit on protecting our frontline workers and making sure that they would be safe in operating. And we got smarter and better at it over time, because when we first put it in place, it was literally, we had seemingly days to figure out how to operate in this new environment. As you think about their work, I think we've gotten that to a place where as sort of society changes, that profile will change. But by and large, I think we've figured out how to operate successfully with all the things we've done. From a knowledge worker standpoint, I think that world is probably permanently shifted. I'm not sure exactly where it's going to land yet, but I think in terms of office work, it's certainly likely to be less than 5 days a week in the office, even post-pandemic. Where we land on that, I think it's going to be different by office, it's going to be different by geography, and it's going to be different by teams. Some teams need to do more work collaboratively, others can work from home a little bit more. So we're going to learn through that over time, but I do think there will be a new normal that won't be just a return to the 5 days in the office anymore.
Hugh, managing the PepsiCo workforce in that new normal, is that the biggest challenge for your leadership team this year?
It's certainly one of them. I mean, in a company of our size, we always have a multitude of challenges, whether it's meeting customer needs, figuring out how consumer priorities are shifting. But we maintain the number one priority that we have is ensuring the safety of our workforce and ensuring that we're providing them with what they need in order to be safe and successful in their jobs.
All right, Hugh Johnston is the CFO at PepsiCo. Hugh, really appreciate you taking some time to talk with us this morning, and I hope we'll be in touch in future quarters.
Thanks. Great to be with you guys.
All right, coming up on the other side of this break, we're going to have the opening bell on this Thursday morning. Stocks right now pointing to a higher open. As you see, our exploration of the C-suite will continue as well later on this hour, talking to Restaurant Brands CEO Jose Sill. We're back right after this.
This is Yahoo Finance Live. We're setting up for a higher open here this morning on Wall Street, building on at least the Dow gains yesterday. Could see some more records for the major averages today. So why is Matt Malley less bullish? Let's bring him in now. He's the managing director and equity strategist at Miller Tabak. Matt, it's always good to talk to you. As you said in your notes to us this morning, you are turning less bullish right now. Why?
Well, yeah, it's I've been very bullish at the last 4 months of the year and into the new year. It's just that the market is getting is kind of like what we had this time last year, where it was priced for perfection. And I just see some things out there. I mean, we could talk about valuations, of course, but they're a lousy timing tool. But there are other things out there that do concern me. And that if all of these things don't fall into place, it's going to be very, very difficult for the market to rally significantly further. And it almost feels like it's being pulled magnetically to the 4,000 level on the S&P, and maybe we'll get there. But one of the things that really concerns me is this whole situation with the coronavirus. I mean, we're starting to see some things, and everybody's planning out that the vaccines are going to work and everything's going to open up, and we're going to have no hiccups along the way. But we hear people like the Centers for Control for Infectious Disease who are warning about that this new variant is going to be a big problem. We have last night Chancellor Merkel out of Germany saying that this new variant could cause a big hiccup for the reopening situation. And even the Biden administration is now talking about restricting some travel around the U.S. because of areas like Florida, which again are seeing these new variants starting to increase. So if we do get extension of lockdowns and God forbid more stringent lockdowns, a lot of these predictions for a big increase in economic growth and earnings growth this year are not to kind of come to fruition, which is not great for a stock market that's priced for perfection. Not calling for the end of the world here, but just getting a little bit more cautious.
Matt, what stocks are you most concerned about?
Well, I mean, a lot of the reopening names. Number one, I mean, we see this big situation where we're seeing some of the airline stocks really starting to rally nicely now, the cruise stocks and such. I mean, if again, the Biden administration talking about just restricting travel a little bit more, that's going to be clobber the airline stocks, which have seen a nice rally. I'm also a little concerned about some of these, these text names. I'd like the chip stocks. They look very, very good, and there's a shortage of chips that's hurting other areas, but will help them in pricing over the long-term basis and even in the intermediate-term basis. But some of these names, I'm really concerned about what's going on in the with the social media stocks. I think we're going to have a lot more restrictions there. I mean, this Paul Meeks, one of the best-known technology investors of the last 25 years, he sold all of his Facebook. He's talking about big restrictions, a big regulation coming to these names this year, and I agree with him. So it's just something that I'm a little bit worried about there. That doesn't mean there aren't good opportunities, and there are going to be opportunities, especially if the market corrects in areas like banking and energy stocks. Some of the ones that didn't do well last year.
What about the role of retail in this market? It's obviously been everything we're all talking about all the time. It's kind of undeniable at this point. How do you think about it from your side of the exchange?
Well, it's again, I don't want to sound overly cautious here because we have certain people like Jeremy Grantham calling for a major bubble to pop, but I do think we can have a deep correction, and part of that is because of this what's going on with the retail investor, and they always come in, there's a key sign, again, always not a good timing sign for exact timing, but they tend to come in when the market's at a top, and some people are talking about there's not a lot of complacency out there, and to a degree that is true because we see the VIX, even though it's come back down from 2 weeks ago, it's still relatively high. But the thing that's worse for me is that the amount of speculation in the marketplace is off the charts and is very reminiscent of what we saw back in 2000, in late 1990s, early 2000. It's funny, people got absolutely creamed in GameStop and AMC when they got too high and they came crashing back down. But they don't care. It's like they're right into the cannabis stocks now. It's kind of like they've forgotten about the pain that some of that things felt. And again, you get these kind of crazy moves, and it's a sign of really high speculation, and that's usually a dangerous time to be invested for the market. I guess my big point is that, raise a little cash here is a good idea. I mean, is the market really going to rally 20% over the next next month or so on the upside? And we do have, I think, 10 to 15% or even more downside risk. And if I'm wrong and the market still rallies a little bit from here, you can go back in, because we'll know in a month or so whether these new variants are going to cause a problem or not.
We had there the opening bell, obviously, Matt, Signify Health ringing that as we look like we're opening up higher here. As you look around the market, is there anything overlooked? Like if you're raising cash now and you actually wanted to deploy that somewhere within equities, you talked about semiconductors, but I don't think you can argue semiconductors are undervalued right now or overlooked right now, right? That story has been well told. Is there any story that hasn't been well told? Are there any discoveries left to be had?
It's really hard to find those, to be honest with you, because the whole market has rallied so strongly with all this liquidity from the Federal Reserve and the global central banks. But the one which I'm a little bit, I was very bullish on, and we've talked about in the past, in the last couple of months of the year, is the energy stocks. Crude oil is getting overbought on a near-term basis, and so are these like the XLE and the XOP, two of the key energy ETFs. But I think any kind of pullback would be a great opportunity to buy them. Now, this is fossil fuels. If you're buying for the 40-year outlook, you don't want to be owning fossil fuels, but they can still be great trading vehicles, and they can still be, on a few years basis, can still be quite good. And the key thing there is, number one, they're still inexpensive compared to where the price of oil is right now. Number two, many of them pay very good dividends, which are safe. Not for all companies. You do have to be choosy. But are very safe. And number three, they're still incredibly underowned by the institutional community. That's a huge amount of money that's going to have to shift. They don't even have to rally a lot more here. As long as they hold anywhere near current levels, those institutions are going to have to shift into that area. That's going to put a huge piece of demand into the supply-demand equation. So I think it's going to be a big winning group for the year. It's not one I want to be aggressive right now, but any kind of pullback I think would be a great one.
Very interesting, especially given JP Morgan this morning, or I guess late yesterday, saying that we are in a new commodity super cycle, which kind of goes along with what you're talking about. Matt Maley of Miller Tabak, always great to talk to you. Thank you.
Thank you, Julie.
All right, let's take a look more broadly at what's going on with stocks right now and in more detail. Jared Blickery is here with that detail. So looks like some more records here this morning, Jared.
We have records in the tech sector, specifically XLK to a record high. Not seeing any of the averages just yet, but wait a few minutes. We'll see what happens. Let's take a look at the Wi-Fi Interactive, where we can see the NASDAQ and Russell 2000 again leading the way. So this has been a trend we've observed recently, where both the small caps and the high growth names in the NASDAQ really surge here together, which is a kind of an unusual circumstance, but we'll take it. So looking at the NASDAQ 100 leaderboard, we see NVIDIA and PayPal each up over 2%. So is Micron. Chip stocks doing well today. Tesla's up nearly 1%. Facebook is just about trading even, and Alphabet down slightly. Now checking out the sector action for today. Tech, record high. That is the only outperformer in the S&P. That is up almost 1%. Just under that is financials, materials, and industrials in the green. Energy to the downside, just talking about that with Matt Maley. That's down the most, off 1%, as crude oil just down a little bit, but still holding above $55 per barrel. And then let's take a look at the most shorted sector or industry, or whatever you want to call it here, style. We see a number of names at the top. So we haven't seen Naked up in some time. This is Naked Brand Group. It's up 25% today. Over the last 5 days, you can see some pretty volatile price action, up 62%. So this stock coming back. This was one of those GameStop stocks that was really flying high, then fell off. So this one has managed to recover to those, almost to those prior highs, something that we'll be keeping an eye on. And then also to the downside, Texas MD, one of those biotech stocks that was doing well last week, not so well this week, off about 9% today. Guys?
Jared, let's talk about one of the big macro trades that everyone was calling out coming into this year that we saw take hold at the end of last year. It's the weaker dollar. We saw some relative strengthening of the dollar during that volatile period around GameStop, but it does seem that overall trend of a lower dollar is kind of getting itself back together.
Yeah, if you look at the DXY, that's heavily weighted towards the euro and British pound, but also kind of broadly reflective of the US dollar. That has been down 5 days straight. We'll get to that chart in a second. What I'm looking at now is our energy heat map. That's underwater now, but I just want to show you year to date. We were just talking about the energy sector, and JP Morgan's Kolanovich, he was calling for a commodity super cycle. All of this is supportive of these names here. Exxon's up 23% year to date. They still have a lot of catching up to do. And there's another factor that I think is interesting where a number of these names are heavily shorted. Some of them have turned into penny stocks. Some are emerging from bankruptcy, like Chesapeake Energy. Just got its old ticker back, CHK, only yesterday. So going forward, I wouldn't be surprised to see some of these energy names attract the Reddit crowd. Now here's the US dollar index. You can see the trend is broadly down, and including over the last 5 days, as I was talking about before. We did have that small run up here, but we'll have to see. Any further downside in the US dollar are going to be broadly supportive of the energy trade, of the commodity trade, EM, and what have you. And as I like to point out, to the upside, if the dollar spikes higher, that is often concurrent with some losses in equity. But so far, I haven't seen much of that in a sustained way over the last 6 months. Guys?
Yeah, not much has slowed stocks down in the last 6 months. Thanks so much, Jared. Appreciate it. And speaking of energy, but renewable energy, we are going to talk next to the Chief Financial Officer of Bloom Energy. This is a fuel cell company. And remember, many of these renewable stocks have taken off well in advance of more fossil fuel energy stocks taking off. Look at that 1 year chart, 286%. That Bloom Energy CFO with us next.
All right, welcome back to Yahoo Finance Live on this Thursday morning. We continue our discussion inside the C-suite across American business. One of the hottest trades over the last year has been what's happening in the renewable energy space, and Bloom Energy has certainly been a part of that. Joining us now to talk about the company's latest results and its fiscal 2020 is Greg Cameron. He is Bloom Energy's CFO. Greg, thanks so much for joining the show. I'd love to just begin with the guidance, both that you are issuing it at the annual run rate of where revenue got to in the fourth quarter, and also just what you're seeing in the business that enables you to even offer guidance, because obviously at the beginning of 2020, so many companies were forced to pull that outlook, but now clearly you guys have enough visibility to start talking about 2021.
Yeah, Miles, thank you. And thank you for having me today. So I joined Bloom Energy about a year ago. And at that time, we suspended our guidance through 2020 as we worked through the impacts of COVID on our business. And as we went through the year, we were deemed an essential business in both of our large manufacturing sites. So we were able to continue to manufacture. Incredibly grateful to our supply chain team and operations team, and just their ability to continue to work through there. And as we got through the year, we got more and more confidence, not only on our ability to manufacture, but our ability to install our projects within the US. So we held an analyst day in December. It was kind of our first big event since our IPO 3 years ago. And at that time, we talked about a framework going forward where Bloom Energy, we feel, could be a 25 to 30% growth company. We think we can expand our margins from 25% gross margin today to 30 and move to being operating income positive, expand those margins and work our way towards being cash flow from operations positive. So we laid out that framework over 5 years. And then for next year, for 2021, this current year, we laid out our path as part of that with our objectives of being a $950 to $1 billion revenue company, which would be 25% over last year. We look at our fourth quarter performance, which we feel we had a very strong fourth quarter, as a proof point that we were able to grow our revenues, expand our margins, and move closer to cash flow positive. So we think it's a valuable proof point on that journey.
Greg, it's Julie here. You guys, as we just showed on the screen, had a 16.6 increase in acceptances to 450, meaning people who have systems who turn them on. Yeah. Who are your customers? I mean, I have to cop to not fully understanding fuel cells, how they work, where they fit into the energy ecosystem. So if you could explain briefly, if you don't mind, where they fit in and who your clients are.
Sure. I'm a liberal arts econ major, so I had to learn the technology when I joined Bloom a year ago. So its simplest form, a solid oxide fuel cell operates, it converts to electricity without combustion. So there's no SOx, there's no NOx, there's no particulates coming out of the machine. So it's very clean. Our primary customers within the US are data centers, hospitals, universities, other industrials, where we were able to provide for them very efficient, very clean power on site. We have a very strong franchise with our partner SK E&C in Korea, where we have a strong business there as well, where we predominantly sell into the Genco space. But we've got a broad customer base. We are expanding who we sell to within the United States, given the work that the team's done on reducing our cost of the product. We're a lot more competitive. So we're going to be expanding to almost half the states within the US, starting with five this year, where we think we're cost competitive. And at the same time, we've hired on a team internationally that is going to expand as well. And we're looking for similar types of relationships like we have in Korea to expand internationally as well. So we think there's a lot of opportunity for people to leverage our fuel cells as a way to provide clean and resilient power. It's going to be a big deal here as we move forward, especially with some of the disruptions we're seeing in the grid. Our ability to create the electricity on site for many places and not have it disturbed if there are weather events, severe weather events, which we're going to continue to deal with.
Greg, what policy or set of policies from the Biden administration do you think will be most financially beneficial to your company?
Yeah, so we're really excited about what we're seeing happening in Washington. And we think it's a lot about an effort here to address climate change. We think it's a lot about investing in our aging infrastructure. And we think it's a lot to do with American jobs. So we are very excited to see the discussion that's going on there. We were happy to see some of the extensions in the investment tax credit, which our customers take advantage of. Utilize as part of their financial equation. I think similar types of activities there where we can continue to see the extension and maybe an increase back to where those rates were. An ability for folks to monetize those tax benefits would be very beneficial for our customers as they continue to evolve. We've been able to reduce the cost of our product. 17% was the number I focused on last year. That's almost 30% year over year. So we continue to get more competitive, but these incentives are for sure a way that which helps customers to make sure that they are seeing a return on the investments that they make. So we're really excited about what we're seeing in Washington right now.
And, Greg, just quickly before we let you go, I mentioned at the top that renewable energies has been such a popular trade within the market. I think investors are very excited. I'm curious, as the CFO of a company where the stock price has gone up a couple 100% over the last few months, how you think about that dynamic and what it does for you, if anything, at this point.
Yeah, so listen, I think within the company, when I got here last April, we had some issues that we needed to address. The company was already in process of doing that, so I was happy to participate in that. But we spent a lot of time through 2020 addressing some of the issues that we had with our debt and our liquidity. So we exited 2020 in a much stronger balance sheet position, and I think the market recognized that as both an increase in our cash and a reduction in our debt. So as I look at that, as I look around the rest of the market, I think Bloom Energy is our valuations that we're seeing right now are extremely attractive relative to our peers. I think the work that we needed to do around the balance sheet has been done. I think our technology roadmap, as we continue a path toward decarbonization, is there. So I think Bloom Energy is at an inflection point, and I think it would continue to be an attractive investment for investors.
All right, Greg Cameron is the CFO at Bloom Energy. Greg, really appreciate you taking some time to talk with us this morning. I hope we can stay in touch.
Greg, thanks so much for having me.
All right, coming up on the other side of this break, Restaurant Brands CEO Jose Sill will join us to talk about that company's latest quarterly report. We're back with that conversation in just 2 minutes. Welcome back to Yahoo Finance Live on this Thursday morning. We continue our exploration inside the C-suite, fresh off the company's latest earnings call. We're joined now by Restaurant Brands CEO Jose Sill, company just finishing up its latest quarterly report and fiscal year. Jose, always great to speak with you. I just wanted to start with how you guys finished 2020. Sales still down in the fourth quarter, but down less than the full year. So what kind of momentum have you seen coming through the end of 2020 and in the beginning of this year?
Hey, Miles, great to see you, and thanks for having me. We saw sequential improvement in the fourth quarter versus Q3 and Q2 before, which were kind of the height of the pandemic. We were excited and encouraged by progress that we made with each of our brands in our home markets, as well as our international business. On the home market front with Tim Hortons, we saw some of our best performance since the onset of the pandemic, especially in our drive-through business in December. We've made a lot of investments in that business around the quality of our coffee with fresh brewers. We've made investments on the quality of our core offerings at breakfast. We launched fresh cracked eggs and a new dark roast blend, all of which is aimed at addressing what the consumer in Canada is asking for, which is, hey, we want Tim's to do what it's been famous for decades, which, be great at the basics. And so we've been making investments with our owners in Canada, and we're beginning to see some progress on guest satisfaction. We're seeing progress in certain day parts from a market share standpoint. We have a long way to go, and obviously the restrictions in the market have an impact on our performance. But we feel confident and encouraged about the long-term prospects of our business in Canada, and the same goes for Burger King and Popeyes in the U.S. We had some positive performance and improvements in our core offering. Lunch day part in particular was really strong, and we have exciting news and exciting initiatives that we have for the business for both Burger King and Popeyes, especially in the digital side for 2021, which we think will have a big impact long term.
Jose, when do you think Popeyes and Burger King US, when will they get back to same-store sales growth this year?
Yeah, so with Popeyes, we Q4 2019 was when we launched the now famous chicken sandwich. We elevated the game as it relates to chicken sandwiches, and we drove a 38% same-store sales lift in Q4. So the performance in Q4 2020 was really just a function of lapping over an incredible Q4 2019. The nominal sales continue to be very healthy. We've reached 1.8 million in average restaurant sales for Popeyes in the U.S. Over the last 12-15 months, which is an incredible amount of growth from 1.4 before the launch of the chicken sandwich. Our four-wall restaurant profitability has reached record levels at Popeyes. So the momentum continues. We had an incredible run with Popeyes, and we think we're going to have continued growth in 2021. We just launched we elevated the game on chicken sandwich, and now we've launched a fish sandwich that we think will be a game changer in the quick service restaurant space. It's a flounder it's a fish sandwich with a Cajun twist, a Cajun flounder, and we think it'll be an incredible limited time offer for the business as it takes hold now during the Lent season. And with Burger King, we made some important improvements and kind of long-term investments in the business around value, around our core offering, the Whopper. We launched the 100% real Whopper. We continue to invest in digital. We've now started to test our loyalty program for the Burger King brand here in the U.S., and we think the combination of all these investments and initiatives will see some really good growth in 2021 and beyond.
Yeah, Jose, I think our Miles Ellen is good for 3 of those Cajun flounder sandwiches for breakfast. But I do want to go back on the chicken. We've seen a lot of fast food players really come out with a lot of new chicken offerings, new chicken tenders. Hardee's, Carl's Jr. come out with these giant chicken tenders. You have had a special promotion on chicken tenders. How concerned are you about maintaining your position with Popeyes in that chicken sandwich?
Look, it's not a surprise. The chicken protein has been a big part of growth in the chicken QSR space, but really for others in the QSR space. So we're not surprised, and we welcome, all competitors to go out there. But more importantly, we welcome our guests and new guests to come out and try the Popeyes chicken sandwich, and they can choose for themselves which is the one that they want to go to. We have an incredible everyday value proposition with that chicken sandwich at $3.99 a la carte. So we feel confident with the Popeyes chicken sandwich that it'll continue to be kind of the standard bearer, if you will, for chicken sandwiches in the space. And we think there's opportunities with Burger King to continue to invest in and expand its chicken offering as well, and be part of what's a growing category in the quick service restaurant space. We also think, as it relates to Popeyes, a big opportunity in handheld chicken with nuggets, tenders, continuing to grow that part of the business, which is one of the fastest growing parts of the chicken QSR space, handheld chicken beyond the bone-in, which we already do quite well with.
Jose, it's Julie here. I want to ask you about input costs, specifically labor costs. As you know, there's been a debate in the U.S. Congress about raising the federal minimum wage. It doesn't seem like it's going to be in this stimulus bill, or if it is, perhaps not as high as some Democrats would have it. There's been a lot of academic papers on the effect of higher minimum wages. I'm sure that you all have studied it. what would the effect be on your business of a $15 minimum wage?
Hey, Julie, and thanks for the question. Look, we've been seeing increases in minimum wage across the country in many markets and many states. Just recently, Florida voted it in a staged approach over the next several years to get to $15. So it's not new. I think the new idea here is that there may be federal oversight on that, and that that might bring a little more consistency to the discussion and to the topic. We've been working on it for a long time. We're in several states already. Probably, I think it's north of 20 states today that have minimum wage statutes that are staging their way to $15. Our business has been accustomed to dealing with labor inflation and commodity inflation for decades. It's part of the business. The focus we have is to continue to work with our owners and our franchisees to ensure that they have really good teams, that we have productivity tools that help them be more efficient with their labor in the drive-throughs. We've introduced the mobile apps, pre-order mobile order and pay, which has helped from a labor standpoint as well. We continue to be more efficient in the drive-throughs and in service modes, which helps productivity and throughput, all of which help drive the top line and help ensure a balanced flow through to the bottom line. So we'll continue to work with our teams on that and keep working on tools to help ensure that we continue to serve great food and do so efficiently and productively, so that our franchise owners can continue to make a profitable living with the business that they have.
Jose, I liked your annual letter that you wrote this morning, also out with your earnings release. I actually tweeted part of it, but what's the biggest challenge your leadership team has on its plate this year?
Look, I think we've made, Brian, some incredible advances in 2020 in the face of unprecedented challenges. Our team has come together incredibly well. I think we're collaborating better. Any walls that might have existed beforehand, I think everyone's putting everything aside and working more closely together and more focused on priorities that we think are critical for the long-term health and growth of our business. My focus and my prioritization is around ensuring we have great teams. We keep investing in our tech teams. We're investing in our marketing teams. We're investing in our operations teams, our development teams. We continue to invest in the business on the people front as well as on the technology front, because we think it's critical for the long-term health of the business. So I'm focused on teams, and I'm focused on engagement. I'm focused on our franchisees, ensuring that they have the tools and they have the clear vision of where we're going, so that they can focus on the guest, which is ultimately the most important aspect of our business. So people, investment in those areas, as well as focusing on engagement and keeping everyone energized. That's my focus. That's what keeps me up at night. And I'm excited because we've got great brands, great opportunities in front of us, and we're excited about heading into 2021 with aspirations for growth for the long term. So looking forward to keeping you updated on our progress, and we're excited about what's to come.
All right, Jose Sill is the CEO at Restaurant Brands. Jose, it's always great to talk with you. Stay safe, and I know we'll talk after the next quarter.
Great. Thanks so much, Miles, Julie, and Brian.
All right, appreciate the time. All right, we're off for a short break here. Stocks higher, but losing some steam in the early going. Dow now up just 2 points. We'll have more on all of this coming up in just 2 minutes.
Stocks are higher at the moment, not by much though, especially when you're talking about the Dow, but it's enough to take the Dow to an intraday record in today's session. We're also seeing intraday highs in the likes of, or actually the Dow's just turned lower, but it touched an intraday high. Also intraday highs in the XLK, which is an ETF that tracks the tech industry, as well as EEM, which tracks emerging market stocks, and an intraday high in Bitcoin. We're going to talk about some of the momentum movers in just a moment. Incidentally, the momentum ETF, MTUM, also touched an intraday record day. We'll be right back with many more CEOs and a deeper discussion of the markets.
All right, just after 10 o'clock here in New York City on this Thursday morning. Welcome to Yahoo Finance Live. Miles Zubin here, joined as always by Brian Sazi and Julie Hyman on this very special edition of our 2-hour program Inside the C-Suite. What's the count? 7, 8 guests, C-Suite guests coming up over the next, or we're coming up over the next couple of hours. We've already talked to 4 so far. A few more coming up later on in this hour. Let's take a look first at what's happening in the markets today. We can see all 3 majors are higher, but off session highs, not doing a whole lot. NASDAQ continues to be the relative leader. Jared Blickery talking earlier about what we've seen in both the NASDAQ and the Russell doing a lot of the leading as of late within the market, but things do seem to be calming down just a little bit after all the craziness we saw with GameStop, but that doesn't really mean there are no meme trades out there. We'll get into that in just a minute. Do want to talk a bit about what's happening in Bitcoin. Been a very exciting week, as it always is, for the cryptocurrency. News out earlier today that BNY Mellon would begin basically holding Bitcoin, and the quote that they gave to the Wall Street Journal was that they would treat it like any other asset. So I think a couple different ways to maybe read that one, but my read on the story was certainly that they're getting questions from their high net worth individual clients about how they can buy Bitcoin, and this move seems prompted by that dynamic, again, at least as far as I'm interpreting that story. And I think that's really going to be a big part of how Bitcoin becomes a more mainstream Wall Street story, is individuals saying, I would like to own this. Please help me do that. And we start to see some of the outlines there. Fidelity is in the space a little bit already. And now we see Mellon getting in the mix there. 47,900 on Bitcoin. And of course, who could forget Elon Musk earlier this week putting $1.5 billion on Tesla's balance sheet. Uber CEO Derek Khosrowshahi asked about buying Bitcoin on the call last night. And I guess that's now a question. If you're the CEO of a tech or tech adjacent business, you will be asked when are you also going to buy Bitcoin? So certainly exciting times for all of those folks. But let's talk a bit more about everything that's going on in the markets right now. Let's bring in Julian Emanuel. He's the managing director and the head of equity and derivatives strategy over at BTIG. Julian, it's great to speak with you. I'd love to just start the conversation. We were chatting very briefly before we came on the air about the meme stocks, the YOLO trades, everything happening in the market. How are you thinking about these dynamics, which are so unique and have come into the market seemingly overnight?
Well, it actually hasn't come in overnight, Miles. If you look back, in fact, this was an appearance that we made at the end of 2019 on Yahoo Finance, where I had a conversation with Charles Schwab himself in the green room. And we were basically talking about, they had announced a week earlier, the start of zero-fee online trading. And that conversation just galvanized our thought process to the fact that this bull market, which has essentially been going on since 2009, was one that the public has never really been enthusiastic about. All of a sudden, you have zero-fee online trading. The public begins to get interested in stocks in January and February of 2020. We all know what happened after that. But incredibly enough, the public came back stronger than ever in the summer of 2020. And in an environment where there's the kind of liquidity that there is, when people ostensibly have more time on their hands, and the interest in asset diversification and investing in a world where yields aren't very attractive, just something that has continued to proliferate. And from our point of view, when you look at the evolution of bull markets, the fact that we're in a much more speculative stage right now, I wouldn't yet call it any sort of mania. Could we get there? We could. But the fact is that the public has taken a lot of knocks in terms, especially new investors, and has come back stronger each time. And we're seeing it again this week in the cannabis space. It's really a testament to the resilience and the stick-to-itiveness of this new generation of investor.
I well remember your Charles Schwab encounter and you talking about it and how excited you were about that, Julian. So I'm glad that you got some sort of actionable insight out of that as well, besides just being psyched to meet him. Julian, you know, there seems to be this sort of attitude on the part of most people that we talk to that these retail investors are going to get burned, that all of this is going to end badly. But what you're talking about, this sort of stick-to-itiveness and people still coming into these trades, suggests maybe it won't end that way. I mean, is there an alternative ending to all of this?
Over the long term, it is likely to be a very significant net positive because, again, this generation of new investors has been underinvested as a percentage of assets. It's, you know, that's research that's very well known. In the medium term, there's no question about the fact that we are setting up for the potential for this kind of extreme speculation to become more intense, such as what we saw in 1999 and 2000. And obviously that ended badly for several years. But then we think about it and, you know, the NASDAQ 100 topped at 4,800 in March of 2000. And here we are, 13,000, 14,000. So really what it does is likely going to be at some point a learning experience with regard to the idea of short-term trading, but a more retainable experience on the benefits of long-term investing.
Julian, look, just given the flows we've seen into equities that have pushed the Dow to record highs here, let's compare that to Bitcoin. Just given how everybody is now invested in the market, would you make the case that Bitcoin is underinvested in, and then by extension, is it undervalued, even though we've seen prices really go through the roof the past month?
Well, look, Bitcoin and blockchain itself, and obviously all the other cryptocurrencies, are in what we would call the price discovery phase. It is essentially a new technology, a new way of looking at the world. And from our point of view, again, we think about it in terms of it's a 70 volatility asset, very, very volatile. when we launched coverage of cryptocurrencies in late November, Bitcoin was at 18,000. We had a $50,000 year-end 2021 price target. People thought we were quite aggressive. The same people are now telling us that we're probably not aggressive enough with this price target. So the truth lies somewhere in the middle in all likelihood. But when you think about all the incremental buyers coming in, the interest that's building, and on the other hand, the likelihood that the government is going to begin to look at cryptocurrency more carefully from a regulatory aspect, the long-term picture looks very, very sound. And we do think that it is a secular bull market, but there are always pullbacks in secular bull markets.
Julian, what's your current price target on Bitcoin? Are you looking to raise it?
We think at the moment, frankly, when you think about the news of the incremental very large buyer that we saw at the beginning of the week, that type of news was something that the market probably was aware of when the chatter started on social media a month or a month and a half ago. And so from our point of view, again, similar to what we felt in January when Bitcoin first traded over 40,000, we think the market has come a very long way very quickly. So we're going to watch. We think actually it's one of these times where a bit of sideways activity is likely to be healthy in preparation for another leg higher.
And Julian, you can't say it for compliance reasons, but I can. You're talking about Tesla, of course, when you talk about that big buyer. In addition to looking at all of these assets on the face of it, you're a derivatives guy too. So you look at the options market. We have seen also, it hasn't just been action in straight up equities. We have seen a lot of action through options at this time. Does that limit retail investors' downside? And how then does this big surge in options activity, how does that play out through the market?
So it actually does limit retail investors' downside, because if you buy a put or you buy a call, it is by definition limited risk, theoretically limited, unlimited reward. But what it does potentially do is, because of that profile, encourage the average investor, certainly if they've had a degree of success, which many of them had the last several months, to trade more than they might otherwise normally. So the structure itself limits potential losses, but because of all the trading activity and the call volumes have been absolutely breathtaking. There's no other way of thinking about it. And option prices themselves, particularly on a lot of these meme stocks, have become very expensive because the volatility started moving. So you really have to think about it in a more balanced perspective. What we would say is, as an investor, just pick your spots carefully, understand, what you're doing, and, hopefully, think about the risk reward aspect of it, and let the market work for you, and know that you have limited risk to the downside in those kinds of structures.
Julian, before we let you go, is this the most interesting market that you've seen in your career? Because I'm just thinking about the arc of this conversation. I mean, this is fascinating stuff that we're discussing here that's very different than what the textbook kind of suggests financial markets are like.
So I've been doing this quite a while. I was a proprietary trader in 1999 and 2000. And frankly, I thought that I'd seen it all at that point. But there's no question about the fact that the last year, and in particular, the last 3 or 4 months, have been absolutely fascinating. And the benefits of living in the same house with a 23-year-old and a 20-year-old who are actively engaged in social media and investing themselves has been incalculable in my ability to understand it.
There we go. That is some good old-fashioned sector-level channel checking going on there in the Emanuel household. All right, Julian, Emanuel, always great to get your thoughts. Chief Equity and Derivatives Strategist over at BTIG. I know we'll talk soon.
Thank you.
All right, let's take a look at the market here before we head off to break. Coming up a little bit on the Dow as we were coming in to this hour. Julie mentioning Dow flipping back and forth between red and green figures. Right now, we're looking at gains of about 0.2% across the board. Coming up on the other side of this break, a lot more here on Yahoo Finance Live on this Thursday morning.
Well, if you have played a game on your phone, you may know our next guest, although not necessarily the name of the company. Zynga is the company. The shares are up 3% today. This is a video game maker, better known perhaps for things like Farmville, Words with Friends. Matt Bromberg, the Zynga Chief Operating Officer, is joining us now. You guys just reported revenue rising 52%. Obviously, a lot of folks are playing games on their phones right now. When you look at the popularity of the games, where are you looking to grow in the coming year? Is it going to be more people playing the games that you have? Is it going to be new games coming online, acquisitions, et cetera? Where's that growth going to come from?
Good morning. Thank you so much for having me. 2020 was really kind of an unprecedented year for all of us, obviously, and a really difficult one. But one of the things that have also come out of this year is that more people than ever have turned to games for a sense of community and connection. And we see so many more people playing our games, and that's been true of the industry in general. We did have an unbelievable quarter, our highest quarterly annual revenue and bookings in history. And that growth came across our business, with our growth in our live services, growth in recent acquisitions. Our global ex-North American revenue was up more than 50%. So we saw strength across the board.
You know, Matt, I want to ask specifically about Words with Friends. You guys note that it was the best quarter you've ever seen for the best year, I guess, for that brand. And it's one of the stalwarts in the mobile gaming space. I'm curious how you kind of keep that momentum going. You know, anecdotally, I know a number of people who probably hadn't thought about Words with Friends since college, all of a sudden had multiple games going with multiple different people, some of whom they were like only tangentially friends with. So how does that momentum fit into, again, kind of a tentpole franchise?
Yeah, we were so excited just to be able to play a part in helping connect people through this difficult time. And as I mentioned, that's been a big part of what our games are all about. They're social, they're mobile, anybody can get into them. And they really provide an opportunity for people to create community for themselves. From a business perspective, what you just outlined is sort of the heart of our business strategy. We have a wide variety of games, a big portfolio. Words with Friends, as you point out, is a more than a 10-year-old game and just had the best quarter in its history. And what we do is we focus on putting new, fresh content, exciting things to do in these games on a regular basis, regardless of how old they are, and making sure that players are deeply engaged and really enjoying it. And people just come back, they connect with one another, they ask their friends to come back and play, and it's really been driving our business forward.
Matt, how large an impact to your advertising business will come about because of the new iOS 14 update?
Yeah, look, we have looked really carefully at this, and there's been a lot written about it. The fact is that our advertising business, we had a record in the fourth quarter. The business will continue to grow. It will grow next year. We've got lots of puts and takes in our business. This is one of them, but we don't expect it to be a major issue for us at all.
And Matt, we've been talking to people this morning about how they're thinking about their workforce right now as well. You guys being a tech company, obviously a lot of your peers in the Valley are also talking about keeping people at home, how that's going to look. You're the chief operating officer, so I'm sure you're thinking about through these issues. How are you approaching work from home? Are all your folks still home? Are they going to be for the foreseeable future? And how are you supporting them right now?
Yeah, for everyone running a business or really any large organization, it's been a pretty incredible time. I will certainly never forget that day in March when overnight we sent almost 2,200 employees home, and we just started working the next day. We've been really, really proud of our teams. Everybody's been working from home since that day in March, now almost a year ago. And we'll continue to do that until we feel like it's safe for everybody to come back. We're a company that is spread throughout the globe, and so there are lots of situations in each locality that are a little bit different. But by and large, we are completely at home and will remain so, until it's safe. In terms of the future, we're working through that like everybody else. I think the one thing that's clear for all of us is that the future will look different than the past, and work from home will be a much bigger part of what we do going forward.
Matt, is Zynga ready yet to start accepting Bitcoin for microtransactions and for game downloads?
We don't have any plans to accept Bitcoin at this time, no. And keep in mind that our games are principally operated through Google and Apple stores, so that would probably be something that you'd want to ask them.
All right, Matt, thank you very much. Appreciate your time this morning. Zynga COO Matt Bromberg. All right, coming up, we're going to talk about different kind of games. We'll have the Mattel CEO joining us shortly.
Mattel just gave the Bulls a whole lot of fodder to play with. The toy maker reported its best fourth quarter sales growth rate in 15 years. Sales gained 10%, marking the second straight quarter of double-digit growth for the company. Profit margins soared, and Mattel offered an upbeat outlook for 2021. Joining us now is Mattel CEO Ynon Kreiz. Ynon, good to see you again here. We've talked to a few in the toy industry over the past couple weeks, and they say momentum in their business has continued from really a strong holiday season. Have you seen that in your business?
Yeah, well, Brian, as you said, this was a very strong quarter for us. Our best performance in years with strong demand by consumers and another milestone year for Mattel. For the second quarter in a row, we achieved double-digit sales growth and grew ahead of the industry and continue to gain market share. Our results exceeded expectations, and we also managed to increase our profitability and grew our operating income by more than 2.5 times relative to last year. But this is not just about the quarter or the year. It's about a multi-year strategy that is progressing very well, which puts us in an excellent position to continue to increase profitability and accelerate our growth this year and beyond. And as you said, momentum continues. We had a strong third quarter, a strong fourth quarter, and overall very strong end of a year and a good start in 21.
So what are folks buying?
Well, we have a very large portfolio. The highest driver, of course, is Barbie, which continues to go from strength to strength. Barbie retail sales were up 30% in the fourth quarter. And Barbie, as you know, finished as the #1 overall toy property globally, both in the fourth quarter and the full year. Our dolls portfolio as a whole continues to perform very well. American Girl was up 9% in the quarter. It was the first quarter of growth in 4 years, so we're seeing renewed momentum, and this is in spite of COVID retail-related disruptions. Our vehicles category also grew by double-digit, with Hot Wheels continue to perform so well. The Hot Wheels single assortment was the #1 toy sold globally for the full year in terms of number of items. And the brand achieved its third consecutive year of record gross sales. So very strong momentum in our vehicles category. And likewise, we're seeing really good momentum continuing with our games category that had its 8th consecutive quarter of year-over-year growth, with Uno being the #1 item sold in the games and puzzles category globally for the year, based on number of units. So momentum across the board. And of course, we did really well in our building sets category, our plush category that was just a white space for us a year ago. And we ended the year with the #1 item in the category. And Fisher-Price achieved growth for the first time in 4 years, up 11%, up double-digit in the quarter. So I would say, this was a quarter where we saw growth in every region in constant currency, in each of our power brands, and in the 4 categories that we report as a whole. So very strong momentum, and we're very encouraged by that performance.
Let's go back to Barbie. We've talked about it in the past, but the fact that you are now making more diverse dolls, I've seen recently now you are going to be coming out with Ken dolls with Ken sitting in a wheelchair. That push to diverse your dolls, has that changed the longer-term growth trajectory of the Barbie business?
The story of Barbie really is a multi-year journey. It's about diversity, inclusivity, ethnicity, evolving body shapes, and purposeful play. But in talking about Barbie, you need to really understand that this is about the Mattel playbook. Without taking anything away from the incredible success of Barbie, which we're so proud of, it is about the same approach, the same methodology, the same capabilities, the same authenticity that are being applied across our product offering. It's about brand purpose, design-led innovation, cultural relevance, and executional excellence. We have our category structure and centralized design and development organization that are filled with extraordinary talent that are working as a team across the entire portfolio, leveraging skill sets and creativity across all brands. which is why we're so confident about our growth trajectory across the portfolio, leveraging the Mattel playbook and staying authentic and focused on our mission and purpose as a company. And this is working really well. And what is behind the success of Barbie is ahead of our other brands, but this is where we're heading as a company.
And you're also continuing to push into the content sphere. And apologies if I pronounce this name wrong. You signed a deal with Lil Yachty, and I guess I'm showing my age there. I hope I got it right. How big of a movie or a piece of content? How much could that financially move the needle for Mattel this year when that comes out?
We own one of the strongest catalogs of children and family entertainment franchises in the world. And the opportunity that we see in the mid to long term is to extend our great catalog outside of the toy aisles. We have a lot of potential and upside opportunity on the toy side of the business, but we see incremental opportunity to extend our brands in highly accretive business verticals that are directly adjacent to the toy industry, that are driven by big brands, big trusted brands that people know, that have a relationship with, and are drawn to them. So we've announced the Uno live action motion picture recently, as you said, but this is the 11th project we announced under the Mattel Film banner, and there's more coming. And in addition, we also are making a lot of progress with Mattel Television. We have 17 shows or series or projects or specials in production and more than 25 projects in development. So there's a lot of activity around our brands. And in today's world, in a world of unlimited shelf space with the growth and proliferation of distribution platforms, everyone is looking for big brands, big intellectual property that rise above the noise level. And this is what we have. And in success, this will be transformative for the company because there's a lot of opportunities for us to reimagine and engage with consumers, with our content, with our brands. And we're very excited with the progress we're seeing so far in terms of interest and the partnership that we have with some of the best creators, some of the best filmmakers of our generation.
How do you think the COVID-19, the pandemic, how do you think it has changed Mattel? And once we do go back out and venture out into the wild and maybe go to the movies, go shopping a bit more, how do you think that will impact your business?
Well, there's no question that the COVID lockdown drove strong consumer demand for toys last year. 2020 ended up being a very strong year for the toy industry as a whole. But the way we see it is that much of our overall performance, our success that we talked about, has been driven by the work of our organization and by the strength of our own brands and the quality of our products. We did not just ride the wave. We outpaced the industry and gained share on a global basis in the third quarter, in the fourth quarter, and the full year. In the US, our growth rate in the fourth quarter was 30% ahead of the industry. In Europe, our growth rate was 5 times faster than the industry. And in Latin America, we gained market share in the quarter and for the full year and continue to extend our leadership position. So, we are doing what we're supposed to do. We're growing ahead of the industry. We believe the categories where we are global leaders, dolls, vehicles, and infant, toddler, preschool, will continue to perform well beyond the pandemic. These categories did not get as much of a lift during the pandemic. We drove growth, but it was less so from the pandemic itself. And we expect to accelerate our growth within these categories and increase our overall market share. Beyond 2021, we believe that in the long-term growth prospects of the industry as a whole, given the strong fundamentals, the industry proved that it's a strategic category for retailers. It's recession resilient, and it really highlighted the importance of play. And with that, we think the industry has a lot of room to grow. It's a growth industry, and we are well positioned to accelerate our own growth and grow our market share within that environment.
All right, let's leave it there. Mattel CEO Ynon Kreiz, always good to see you. Good to see what you're doing on the Barbie front. We'll talk to you soon.
Thank you, Brian.
All right, do stick around. Much more ahead on Yahoo Finance Live, including a chat with Yeti CEO right after the company's earnings this morning. We'll be right back.
Coolers are hot, apparently. Yeti sales up 26% last quarter as the company sold more of its coolers and other products. Drinkware as well was doing well. Matthew Reinschus is joining us now. He is the CEO of Yeti. Thanks for being here, Matthew. So as I mentioned, sales up 26%. I noticed the breakdown, though, interestingly, direct-to-consumer sales up 46%. To be expected, right, at a time like this when people are not going to stores as much. But I wonder if that is part of a longer-term strategy as well. Your wholesale channel sales only up 6%. Do you think that that's going to be something you're going to be seeing more over the longer term, that people come straight to Yeti to buy your products?
Yeah, thanks for having us. We had a great quarter. Incredibly proud of our brand and our team, considering all that 2020 and what the world faced, and excited for what we have coming in 2021. You know, one of our stated strategies when we went public in 2018 was to continue to be where consumers want to shop and continue to evolve our digital reach and our D2C business. And we've really been on that journey for the last 5 years, bringing our D2C from less than 10% of our sales to over 50% of our sales.
You know, Matthew, when you look at the split between, you know, kind of the cooler products, the bulkier stuff, and the drinkware, I'm curious how you're looking at the future of that breakdown. And you saw faster growth in some of the coolers. A lot of people spent a lot of time outdoors in 2020. I'm curious how you maybe see that trend going forward, both as life normalizes, but also I think a lot of people may have realized the outdoors are great, and a lot of those products are certainly better suited for that use.
Absolutely, and we've always focused on driving a balanced portfolio between coolers and drinkware and our expansion categories. You know, we believe we have a brand that is much bigger today than the product portfolio we have, and that's really rooted in the quality and performance of the products that we create. As it relates to 2020, as we introduced both our brand to new consumers, we introduced it through both coolers and in drinkware. And then you add the evolution we've seen for a number of years, even pre-pandemic, which is this idea of active outdoors, the health and lifestyle benefits of being outdoors. And we think our products and our brand are well suited to take advantage of that trend. And it's, for us, not just a pandemic trend. We saw growth, strong growth before the pandemic. We saw strong growth exiting 2020, and feel great about where our business is positioned.
Matt, I remember being down the floor of the New York Stock Exchange with you in 2018 on IPO day. We talked a lot about coolers, but since then, there's been an explosion in this category. A lot of competitors that have come into the space, yet you continue to put up these results. For those who perhaps don't understand the brand or believe in the brand, why do you think you have been able to put up these results even with really an influx of competitors?
Yeah, as we go into these markets and create attention around the premium nature of the products we can design, I think it invites people to come into the market to try and take advantage of some momentum. And what we always focus on is continuing to drive innovation in our products, and we've done that and will do that in all of our legacy products, even as we're focused on driving new products. I think the other piece of it is both what the brand stands for and being true to design great products, bring shocking performance to the market, and give consumers a reason to believe, and then make sure the product backs it up. And that's really been our focus, and never stop innovating. And we've continued to do that through our coolers, our longest standing coolers, and our drinkware. And today we announced an expansion into a really exciting category in bags.
Let's talk costs for a moment, because we have seen input costs for a lot of manufacturers go higher. Where are your products made? Are you seeing any bottlenecks coming from there? And I'm also curious, as we head into this new administration, we know that President Biden just had a conversation with Xi of China in the last 24 hours. How are you thinking about the potential for cost increases and decreases based on the sort of relationship between the two countries?
Yeah, there's a lot of things in there. One of the things that we're focused on is making sure we have a global supply chain and one that can withstand any single disruption. And I think we showed that through the pandemic and our ability to pivot and make sure that we continue to bring supply to reach the rising demand. One of the things our team focuses highly on is making sure we build strategic partnerships, and how we build those partnerships with our suppliers. Cost is a component of that. And as we drive success and we drive demand, that we're working together to make sure we're managing costs so that no single input cost really kind of hits the business directly. And we always have offsets, and that'll continue to be a focus of ours. One of the things as we grow, we bring demand, and we become a valuable customer to our suppliers. We'll also continue to look to globally diversify our supply chain. We've talked in the past about diversifying elements of our supply chain from some concentrated positions in China in particular, and we'll continue to look at being a global sourcer. At the same time, we're looking to build the global commercial side of our business.
Matt, how do you think the pandemic has changed Yeti?
Yeah, I think it changed us in a lot of ways. When mid-March hit and most of the world really woke up to the reality of what the pandemic could mean, we set out with a mission to say we're going to do three things. We're going to protect our people, we're going to protect our brand, and we're going to protect the financial strength of the business. As growth started to come back to the business, as we reported quarterly, and then just today, we really took advantage of the opportunity to expand. And we had a mantra internally that regardless of what 2020 was going to give us, we were going to emerge and exit 2020 as a stronger, better business. More global, more direct to consumer, really strong balance across our product portfolio with a full innovation pipeline. And so we feel great about that. And then the consumer dynamic, with people having a lot of their lives disrupted, and they were parts of their lives that were important to Yeti in the past. Gatherings, backyard barbecues, sideline sports, commuting to work, an office-based culture. We were able to pivot and take and meet people where they were, which was getting outside and active. And so both those themes play well. And as the world evolves back to whatever normalcy or looks like in the future, we think we're well positioned to flow with it and tell great brand stories and bring great product to market.
Matthew Reinches, the Yeti CEO. Thank you so much for joining us. Appreciate it.
Thanks for having me.
All right, we're going to dig next into what's going on in the markets today. We'll be right back.
But things leveling out just a bit. Yahoo Finance's Jared Blickery joins us now for a look at how things are trading here about an hour and 20 minutes into today's trading session. Jared.
That's right. We got a record high for the Dow, so 1 out of 4 so far. Russell 2000 still the leader here, up about 0.75%. NASDAQ up over 0.5%. And just looking inside the NASDAQ 100, the mega caps are mixed right now. You can see Tesla's up about 1%, not a lot else going on. PayPal, a standout. That stock is up over 5%. Micron and Lam Research are each up more than 4% here. So the chip stocks really doing well. But I want to take a look at Bitcoin because that has been on quite the tear. Bitcoin is up to another record high, another 5%. Ether close to another record high, up 3%. And guess what? Even Ripple, XRP, that is up about 4%, recovering some of those losses from late last year, even though on a lot of exchanges, you still can't trade it. Another sector that's moving is the cannabis sector, except it's going the wrong way today. You check out Tilray, look at that on the bottom. It's down 31% over the last 5 days, though. And by the way, it's still holding those gains over 2 days. Over the last 5 days, still up 62%. But you can see the Reddit effect in flux with this right now in play. So here's Sundial Growers. That's up another 7%, up 175% over 5 days. Basically converting from a penny stock to a $3 and change stock, if you will. And finally, taking a look at the banking sector that had been under a bit of a pressure here. We see JP Morgan and Bank of America just barely climbing into the green. That's as we see the 10-year T-note yield a little bit elevated today, but not seeing a lot of big sector action or much action in the overall indices. You got to look beneath the hood, especially at those smaller names, guys.
All right, Jared Blickery with a look at markets trading here. Now, a name we are waiting to open is Bumble. Latest indications are the IPO set to debut later today. Set to open around $62 a share. Price last night at $43 a share. Brian Sazzi, I know it's a story that you've been following. Just I mean, we've seen what's happened with Match over the last couple of years, certainly in the dating space. What's your read on the company here? And I know that we're going to be talking to some of their executives later on today on Yahoo Finance.
Yeah, looking forward to that chat. But look, I wrote down 3 reasons why I think you're seeing the really good response here, potentially in the early going. One, it's a good story, a female-led brand. I think founder Whitney Wolfe Herd, she really has articulated and crafted a really good brand here and a really good brand messaging. So it's a name we can all understand and stands for something good, at least in the early going here. New business. They are also hatching new businesses. They've also started to expand into the business community, trying to be a job creator or a job matcher in this bigger view for the company called social discovery, which might be social media on steroids or social media industry 2.0, but also, too, the business is actually growing. The monthly active users are growing by a double-digit clip, and for the first 9 months through September 30th last year, the business was adjusted EBITDA profitable by close to $100 million. You put all that together here, and you have I mean, it's really not surprised to see this market indication, especially if you see a response to Airbnb's IPO. I mean, that company was losing money, and you saw that market response here. You have a business potentially making profits that has a good story and a good leader. Why not send it higher?
Yeah, and we should mention that leader, Whitney Wolfe Herd, now set to be a billionaire at the current price when the stock does begin trading. She's 12 months older than me, so what am I doing with my life? Basically nothing.
Keep on the grind, dude.
Nothing going on.
Keep
I'll tell you, not a billionaire yet. Certainly haven't found any revolutionary dating apps. But yeah, again, I mean, I think in this market, when SPACs come public, they have no business, and the sponsor's stock goes up 2x. As you mentioned, Sal, the company's making money in a space that what's happened over at Match has been borne out as favorable to investors. Investors certainly like that online dating story. So you would expect market sentiment to certainly help this one. And it does appear early on that is the case. We'll see where it opens. And again, coming up later today, Whitney Wolfe Herd will join Yahoo Finance. Expecting right around noon. We'll see how the timing works out as the company tries to, again, get this stock trading in today's market. All right, we're off for a short break. On the other side, a lot more here on Yahoo Finance Live. Coming back in just 2 minutes.
What's up is down, what's bad is good. Miles wrote about that in this morning's morning brief from Yahoo Finance. Basically that, the template for how investors have traditionally decided what companies to invest in hasn't been working lately. And in fact, just the opposite has been working. I mean, we talked about this a little bit, Miles, with Julian Emmanuel, when you asked him, have you ever seen a market like this? And he basically said, no, he hasn't. And that, when you're trying to decide if a stock is going to go up, basically, you're trying to decide if a stock is going to go up because people are going to buy it, not because it's worth buying. It's a really fascinating phenomenon.
Yeah, I think I'm probably going to write about his comments for tomorrow's morning brief, because all week we've kind of seen this evolution from, what you would call Main Street, Wall Street shops trying to figure out how you think about this market. So the note for this morning's brief was from Credit Suisse, and they went through a number of metrics. The one I found most interesting, not only the one we highlighted in the post, where stocks with high short interest have outperformed stocks with low short interest, not just around GameStop, but even before that. It's really been since the election results were known. But stocks that are further off their 52-week high than other stocks. So let's say a stock went down 70% from its high in 2020. Those stocks are up 30% as a group from November 6th, whereas names that were at record highs, you think about your FANG names, basically, they're up like 10% over that same period. So if your stock went down a lot, if the price went down, the price has now gone up. And to your point, Julie, investors, they're like, what about valuations? What about earnings? What about revenue? But in this market, it's about price. It's about what your college-age kids at home say everyone's buying on GameStop. It's about buying on Robinhood. It's about what happens on Wall Street bets. That's the market now. I don't know how long it lasts, but we've seen, whether it's Credit Suisse, whether it's BTIG, whether it's Goldman Sachs, they're all trying to work out how they fit into this kind of environment.
All right. On that note, as you said, we'll look ahead to tomorrow morning's morning brief for the thoughts on that. Thanks so much for being with us over this past 2 hours and this executive bonanza that we have been going through. On behalf of myself and Miles and Seth, thanks for watching. Keep it tuned right here on Yahoo Finance.
Welcome in to Yahoo Finance Live. Happy Thursday, everybody. I'm Zach Guzman alongside Akiko Fujita as we have the broader indices trading in the green, but just slightly right now as we cross the 11 a.m. Eastern Time hour. Taking a look at the major indices here, you can see the Dow up again, just slightly right now, up by about 3 points. We see the Nasdaq and the S&P 500 in the green as well. The big movers to highlight today were yesterday's big gainers. Today getting shellacked the big Canadian cannabis companies, including Tilray, seeing a 34% decline. As we've talked about, Reddit's Wall Street Bets had been giving that sector a bit of a boost, and we saw it yesterday with a 50% gain for Tilray, now switching to the other side. Tough day for wheat stocks. We'll break that down in just a bit. Also, take a look at this. Playboy returning to the public market through a reverse merger to trade as a public company for the first time in a decade, the ticker PLBY. The CEO of Playboy will join us to discuss how the company is looking to grow beyond its Hugh Hefner days. And the Bumble in the Jungle, Austin-based dating app Bumble, making more than just a buzz in its big debut. The dating company raising $2.2 billion in its IPO after upping its price one last time. We'll chat with Bumble CEO Whitney Wolfe Herd later on in the show as well. But first, big updates in Washington, D.C. as President Biden meets with senators to look ahead to infrastructure spending. Already a lot on the plate of congressmen and women with the impeachment trial and stimulus working its way through that. But for more on the infrastructure front, I want to bring on Yahoo Finance's Jessica Smith, who has the latest for us today. Jess?
Yeah, Zach, President Biden is meeting with 4 senators, 2 Republicans and 2 Democrats, all members of the Public Works Committee, to talk about his plans for infrastructure. Transportation Secretary Pete Buttigieg is also video conferencing into the call. You'll remember, or to the meeting. You'll remember he is quarantining right now. They did speak briefly ahead of this meeting. President Biden said that infrastructure is going to be an important piece of his administration going forward. He also says he thinks it should be nonpartisan. And he did say that last night he spoke to China's President Xi for 2 hours last night. We knew that they had a call, but we didn't know for just how long they actually spoke. He told reporters if we don't get moving, they're going to eat our lunch. He pointed to China's investment in rail and in cars with new technology. He says this is why it's important for the U.S. to invest in its infrastructure. This meeting is still going on right now, so we'll keep you updated on what we hear from the actual infrastructure meeting. But we should note reporters also briefly asked him about impeachment. He told reporters that he did not watch those proceedings live, but he did catch the news coverage, and he thinks that some minds may be changed. Zach and Akiko.
All right, Jessica Smith bringing us the latest there in Washington, D.C. Appreciate that. Meantime, we're still waiting to see where shares in Bumble are going to begin trading. We got the latest indication just a moment ago at $62 per share. Of course, they price shares in that IPO at $43. And Akiko, this is the latest name that we've been watching on the IPO front. Going to give us, I guess, a temperature check on where things stand. But of course, you know, a dating app that's quickly growing here. What are you expecting to see? We're going to be chatting with the CEO later on, so we'll get the details around this. But clearly looking like a big pop.
Yeah, no question about it. And what we've seen with past IPOs, at least over the last few months, is some of these names that have a lot of brand recognition, especially with retail traders, have done significantly well. They've gotten a big pop on the initial day. Bumble, of course, the dating app that's known as the female-led company here. Women initiate the first move, and it's kind of been seen as more of a friendly environment, especially for women who have been on these dating apps, who have been subject to unnecessary comments, but also some bullying as well. And you know, what's really interesting about this company is sort of the narrative behind the founder, Whitney Wolfe Herd. She, of course, left Tinder in the early days. She has been very vocal talking about why she came about coming to this idea for Bumble after she herself was subject to bullying online as well. So this narrative of this being female-led, female-friendly certainly has led to significant growth for the company. And you look through the numbers here, we're talking about Bumble, the app, but Bumble, the company, of course, owns 2 apps, Bumble as well as Badoo, 42 million monthly active users in all. They're across 150 different countries, and they've seen really significant growth here in the last fiscal year, 35% growth year on year in terms of revenue. Main revenue sources looking at subscriptions, premium subscriptions on the app as well. So we will, of course, be speaking to her directly, potentially in the next few hours as soon as the stock starts trading. But it's going to be interesting to see how much strength and brand recognition this has. We'll see where it trades on its initial day.
Yeah, we saw that indication move from 63 to 67 too just a moment ago. But it is interesting, as you said, Bumble clearly differentiated in the dating space. But let's get into it a little bit more here because there's a lot to discuss. Obviously, it's a crowded space with Match Group. We were talking about that just last week, about what they've seen in this pandemic, kind of pointing to that being an issue. So where might this go on day one of trading? Let's break it down a little bit further here with Sarah Kunst, our next guest, Clio Capital Managing Director and a former senior advisor to Bumble. And Sarah, appreciate you coming on here to chat with us. I mean, you just heard us kind of walking through the storyline with Bumble. When you go back and compare, though, I guess, to Tinder and maybe some of the other companies in Match Group, it's interesting to compare the growth rates, which kind of seems slower than what we saw with Tinder back when it was equivalent age. So talk to me about maybe the direction this company is moving in being kind of that woman moves first dating app and how big that is in the space.
Yeah, I mean, I think we can all relate in our personal dating lives, right? We want quality over quantity, and I think that Bumble's really been able to bring that, you know, and they're offering a product that, while the UX might not be massively dissimilar from some of their competitors, the brand promise really is, and you know, I kind of liken it to the Teslas of the world. Tesla did not invent cars. It didn't invent electric cars. It just brought a brand and a form factor that, you know, users really, really love. And I think that that brand loyalty is going to be something that we see on display here today in their debut.
And Sarah, of course, we've seen with this online dating space, it's not necessarily a zero-sum game because users do, in fact, dabble in multiple apps that are out there. And yet it does feel like there are a lot of apps in the market. When you look at a company like Bumble, as it looks beyond dating right now, what are some areas for real opportunities, you think, real growth beyond its core space right now?
Yeah, I mean, you know, Bumble has made some awesome moves in spaces like Bumble Biz, which is focused on business connections, Bumble BFF, which is focused on friend connections. You know, it's really about empowering people to go out and connect with others in their lives, and they're doing that across several different facets, and there's a lot of traction there. They even have the ability to download the app and to turn off dating so that if you know, are happily in a relationship, but you want more friends, you want to meet people to talk with on a job front, you can do that. And so, you know, where do you want to connect with humans? And Bumble can help you kind of make those connections.
Yeah, that was an interesting question I had, and I'm sure we'll get into this later on when we chat with the CEO here on the show. But you think about BFF and maybe those business connections. I wonder how much more monetizable that becomes, because, you know, dating seems to be one of those things that more and more people have been paying. If you look at a Hinge or Match Group and the revenues on that side, seemingly easy to monetize. If it's guys out there, we know that men are more active on these apps when it comes to dating, and we know kind of the statistics behind that. So I'd be curious to get your take maybe on where monetization falls when we look at, you know, the last clip that they reported in their S1 was not profitable.
Yeah, and you know, I think that over time, there's certainly a path to profitability in these kinds of companies. And you know, to your point, dating is people spend a lot of money. It's digital goods. You're paying for a monthly subscription to get more features. You're paying for sort of immediate digital goods to tell somebody you really, really like them. They call it super swipe in the app. And you know, it's similar to video game economics in that, you know, the cost of goods on a digital good is incredibly low, which means the margins are really, really high. And so, you know, certainly in the core product, but then when you look at the other products, right, if Bumble BFF is finding you a roommate, right, how much is a good roommate worth? How much is, you know, finding your new best friend worth, right? And the ability to monetize, you know, and recently they were running a promotion for Valentine's Day around Airbnb experiences. So if you layer in, you know, even some advertising revenue or affiliate revenue, there are a lot of opportunities. Most of the money we spend on experiences is with other people. And so if Bumble's helping you meet those other people, the ability to you know, regain some of that income, I think is pretty strong.
Yeah, it's interesting if you look at the S1 filing, because retention was one of the risks that was mentioned. And sort of the irony being here that on the one hand, Bumble gives you an in to dating, and yet they list as a risk factor, if you find a relationship, well, then you don't need the app anymore. So some of those avenues you pointed to certainly would seem to offer sort of more traction with users. But going back to just how crowded this space is right now, do you anticipate more consolidation there? Bumble sort of created their own narrative is female or ladies first, women first. But I wonder how many of these apps are able to survive on their own.
Yeah, and I think that historically the narrative was there's only room for one, and that was not even Match, it was IAC inside of Match, and now we're seeing that there's certainly room for two. So in 5 years, will it be that there's room for three? Certainly seems like it. The vast majority of adults are in a romantic relationship at some point in their lives. The majority of Americans still get married, right? And we know that younger demographics are changing that a little bit, but the desire for connection hasn't gone away. And, I personally much more enjoy being able to limit my dating to when I have a few minutes in an app versus spending, an evening at a bar pre-COVID looking around to see, is there anyone there I should meet? And I don't think I'm alone in that. The success of Bumble, the success of Match as a standalone company says people are still out there looking for people to date. And we're increasingly moving, online to do so.
Yeah, I don't know. I mean, I'll interject with my own personal take here as well. I don't know if Kiko has anything to add, but using both Hinge and Bumble over the last couple of years, experiences just seem to indicate much more interaction on Hinge, leading to actual dates. And I'm not sure how much of that stems from, the woman first aspect of Bumble versus some of the other dating apps. But I would be curious to kind of get your take on maybe some of the other things we've been talking about, specifically dating apps in a pandemic. And I think that's strange for the way in which we're seeing Bumble. The timing of all this is difficult for investors to kind of weigh this out because they were profitable in 2019. We've heard about issues of dating on these apps in the pandemic, the risks associated with it. It's kind of difficult to tease out the trajectory that Bumble has here because of that, I think, and what kind of boost might be there on the other side. Clearly a lot of demand. We saw Bumble up their price range for this IPO twice, and now the indication at $70. So maybe project out if you can, and I know it's difficult, where the space goes in general on the other side of the pandemic.
When the pandemic is over, I think that the things that people miss, right? Most of us, watching right now, we can still afford to pay our rent. We can afford to buy food. We miss having fun with other people. We miss touching other people. We miss going places. We miss a bunch of things that you kind of naturally aren't going to do alone. And the other reality is that pandemics are really hard on relationships. And so, we will also have on the other side, a lot of people who are already coming out of it or come out of it and look around and say, maybe that person that I was with during this pandemic wasn't the right one for me. So what's next? And so, I think there's a ton of pent up demand because to your point, it is somewhat risky right now to date during a pandemic. A first kiss could literally kill you, right? So that is a risk factor. On the other side of the pandemic, we're not going to have that.
Yeah, I don't know. That sounds a little scary if you put it that way. But Sarah, it's good to talk to you today. Sarah Coots, Clio Capital Managing Director and former Senior Advisor to Bumble. And we, of course, will be speaking to the CEO of Bumble, Whitney Wolfe-Herd. She'll be joining us on the show a little later. Coming up, new guidelines for the CDC signaling changes in mask wearing, the latest efforts to slow the spread of COVID-19. We'll discuss that after the break. The CDC out with new guidelines on Wednesday, recommending that Americans wear double masks, now 2 masks, a cloth mask over a medical mask to slow the spread of COVID-19. This coming as we see the number of case counts go down nationally. Let's bring in Dr. Patrice Harris. She's eMed CEO and former president of AMA. Dr. Harris, it's good to talk to you today. Let me just get first your reaction to these guidelines we got from the CDC. It feels like things are really evolving as a result of these new variants that we have learned about over the last several weeks. The 2 masks itself, is that a significant development?
Well, for many of us, I can tell you that I have been wearing 2 masks for a while. But here again, it is so critical to have the data to support recommendations. And so this new guideline from CDC, I think, will be more helpful. We already had plenty of data that masks wearing was very helpful to prevent the spread. And now here's just additional information that we can go even further, and 2 masks are helpful.
Yeah, and we saw, the difficulties and trouble in trying to get people to wear 1 mask. I hope that it's a little bit easier for people to wear 2. But Dr. Harris, when we look at the vaccine rollout, obviously that's been the big story in trying to outpace the number of new cases in the U.S. Luckily, we've seen the number of cases continue to fall here. When you look at the vaccine front, though, it's interesting here to hear Dr. Fauci talking about moving to that next threshold, right? Looking at the data to see when kids will start to get the vaccine. Now saying that we could see first graders potentially getting cleared to get that by September, he says, presuming that we see trials go well. What's your take on maybe that next step and where we're at in the vaccine front?
Well, that is welcome news. As a child and adolescent psychiatrist, I receive a lot of questions from parents as to when they might be able to get their children vaccinated. So we have been awaiting this data, and I was so glad to hear that from Dr. Fauci, because the key is getting vaccines in arms. When we get to that critical mass, to herd immunity. We don't know the exact percentage, but here's what we do know. The more people who have vaccines in arms, the less this disease will spread, the less we even have to worry about viral mutations. So certainly that is welcome news. However, note the date. We may not see that until the fall. And so that means that we need to continue to wear a mask. And now CDC is telling us that per the data, double masking is important. We still and have always needed a robust testing, comprehensive testing strategy. So that's still in place. We still need to watch our distance, and we still need to wash our hands. I have been fortunate enough to receive both of my doses of Moderna. Last Friday was my 2nd dose, but I will still continue to wear my mask and abide by all the precautions that we know work.
And Doctor, you were talking about kids. There's been a lot of debate about whether, in fact, schools should reopen. President Biden has sort of made it pretty clear he wants that to be one of the priorities. We're expecting additional guidelines from the CDC on that front now. But what does the latest data suggest in terms of how safe it is to bring kids back to school, and what needs to be done in order to make this reopening as safe as possible?
Those guidelines are going to be helpful because we do need that national leadership on these issues. Now, to date, there have been several studies that said the risk of transmission at school is lower. But of course, as always, we have to get beneath the headlines. Those studies show that the reason the transmission was lower was because there was appropriate mask wearing. They were able to make sure that they were keeping children at appropriate distances from one another. They had improved air ventilation systems. And so that means that schools need resources to make sure that we mitigate as much as possible. No such thing as zero risk, but it's about resources. But the data thus far show the risk was low. But of course, you had to make sure you had that level of mitigation. This is welcome news. We need our children back to school. And by the way, I think there's universal agreement that children need to be in school. What we've not had is debate, or we've had a debate, but we've not had the resources necessary to do that. And it's more than just getting kids back to school, it's keeping them there. And that does mean you need testing and tracing and mitigation and bottom line resources.
Yeah, almost worse to have a bunch of families go through this start-stop process out there with sending their kids back and forth and having to deal with the concerns around that. But Dr. Patrice Harris, eMed CEO and former president of AMA, appreciate you stopping by to chat with us today. Thanks again. We're going to take a quick break here on Yahoo Finance Live, but when we return, checking in on the state of the U.S. consumer and small businesses through this pandemic, how they're faring according to a new survey. We'll chat with Santander's head of small business banking right after this. Welcome back to Yahoo Finance Live. Of course, we are still waiting for the final numbers and details to come out of the Biden administration's $1.9 trillion COVID relief package in this latest iteration. And Americans are waiting to see what kind of stimulus check might be waiting for them, as well as what kind of relief for small businesses might be there. So it's worth checking in on the latest survey to kind of gauge where we're at in this pandemic. And for more on that, I want to bring on Patrick Smith, Santander's head of small business banking, joins us now. And Patrick, the survey results are pretty interesting. I'm sure a lot of people out there can relate to at least one of the findings. More than 1 in 3 consumers reporting that their personal savings and home life have been negatively impacted by the pandemic. What else were you guys able to find out?
Well, thank you, and thank you for having me. The macroeconomic indicators are very clear that the pandemic and the associated recession has caused a lot of disruption and pain for both consumers and for small businesses. What we wanted to do is to really go a level deeper to understand, more of the sort of specific impact around for both households and for small businesses, the specific impacts we're seeing on people's financial well-being and on their social lives. And what we found is effectively that while for sure there's a real financial cost to this, that the interpersonal costs are as high. So on the financial side, we've seen small businesses saying that they've, about 56%, saying that they've reduced business expenses pretty dramatically. Almost 30% have had to delay major investments, and then almost 20% have actually gone through the painful process of laying off or furloughing their staff. But the real impact, I think, is on the human side, where we found that 32% of consumers and 46% of small businesses reported that the pandemic and the recession has had an adverse impact on their home lives, and 25% have said it's had an impact on their relationship with loved ones. So it's been, both a financial challenge, but also it's been a real time of personal struggle for both consumers and for small business owners.
Yeah, Patrick, from the business side, to what extent did the Paycheck Protection Program, or has the Paycheck Protection Program really helped keep some of these businesses afloat? What did you find on that front?
It has. Businesses have reported that the assistance has really come in handy and helped, and we've seen that in our own client base, where we were able to last year, support nearly 13,000 businesses, $1.2 billion in PPP funds, and support in total 126,000 jobs being sustained. And so that has been a real and material benefit to both small business owners, their employees, and their communities.
Yes, I mean, your numbers here point to about half of small businesses seeking out or plan to seek out financial assistance, which is kind of surprising considering, the amount that we've seen out there being done to maybe help in all this. But also your numbers, I guess I'll focus in on the ones that show the hope that things will improve. We talk so much about small businesses facing insurmountable odds really against some of the big players in the space, but I'm always shocked by how resilient those small business owners are in the face of all this.
Yeah, it's that I think is maybe the most remarkable and heartening part of the survey, because you would expect small businesses to be on the balance pessimistic about what's happening in the near-term future. We found the opposite. There's still very real pain, so I don't want to underemphasize or underplay that, but there's real optimism, and this is the small business owners themselves are saying that nearly half are saying they expect their finances to improve in 2021, and even for folks who report really struggling, more than half expect their finances to recover in the course of a year. And so there's real optimism, and again, we've seen that in our own clients. We've seen clients quickly adapt their business models to be more effective in this environment, whether that be, opening, you've seen more account openings online. We've seen a spike in small business owners using our digital platforms to service their accounts. And then we've seen an increase in digital payments and contactless payments. So, small businesses really have been behaving differently as a consequence of this. And they are, as a result, I think, feeling, that they can weather this storm, and they're feeling optimistic about the future.
Patrick Smith, Santander, head of small business banking. It's good to talk to you. Some optimism coming through from that study. It's good to see that. Let's turn our attention back to the markets. We are still waiting for dating app Bumble shares there to begin trading, the company making its big public debut. We're now seeing shares there indicated to open at $73. Remember, the IPO priced at $43, so they could be in for a significant pop when it begins trading. And of course, just a reminder to our viewers, we will be speaking to the CEO of Bumble, Whitney Wolfe Herd. That's coming up a little later in the show. Coming up, the return of Playboy, the iconic brand, coming back to the public markets today as well, this time through a SPAC, though. We'll talk to CEO Ben Cohen after the break. Bitcoin seeing a big pop in the session, inching closer to that $48,000 handle. This coming on the back of news that BNY Mellon is just the very latest to get in on the cryptocurrency space. Let's bring in Jared Blickery, who's tracking all the moves for us. And Jared, this is certainly very significant given that it's America's oldest bank.
It is. And you think Bitcoin, you don't think stodgy custodial banks, but that's exactly what Bank of New York Mellon is. So it makes sense that they're getting into crypto and not just getting into it, really integrating it into their platform the way no one else has, so that people will be able to manage custodial assets in digital form as well as traditional stocks and bonds, all on the same platform. Also, I should point out MasterCard is investigating stablecoins. So it looks like things are really proceeding with the institutionalization of these markets. Now, Bitcoin just hit a record high. Akiko, you mentioned 48,000, but I don't think we're going to have too many 48,000 hats. I think we'll see Bitcoin 50,000 hats, but we might have to wait a few hours for that. But you can see over the last 5 days alone, up over 20%. And Ether, this should be good for a record high. If not, it's very, very close. Looks like it's just off, but that is up 5% today, 7% over the last 5 days. Also want to highlight the cannabis sector, because this is the opposite of what we saw yesterday. Tilray down 40%, Afria down 30%, so giving back some of those gains. But just check out what it's done year to date. Still seeing gains of 371% for Tilray, Afria up 175%. And finally, looking at the IPO space, we're still waiting for Bumble to trade, and it looks like it's indicated at $73. It IPO'd at $43. In the meantime, I'm going to tee up the Playboy CEO, because that SPAC has come to market under the ticker PLBY today, guys.
Okay, thanks for teeing that up for us, Jared. Well, as you mentioned, Playboy is returning to the public market after a decade-long absence. The media and now lifestyle company listing today through a reverse merger with Mountain Crest Acquisition Corp. Let's bring in the CEO of Playboy, Ben Cohn, along with Yahoo Finance's Brian Sazi. Ben, it's good to talk to you today. You know, the company's gone through quite a bit of a transformation since you went private back in 2011. Why come to the market again now, and why through a SPAC?
Yeah, for a few reasons, and thank you again for having me. The capital that we raised, over $100 million, provides over $100 million of unrestricted cash to really accelerate our growth. We've had a massive transformation of the business over the past 3 years. In 2020, our revenues were up over 75%, EBITDA up over 100%, but we did that in a cash-strapped environment. The capital that we raise will allow us to accelerate both our organic as well as our inorganic growth moving forward.
Ben, we've talked a few times in the lead up to your debut today about the sales momentum you do in fact have in your business, and that you had last year too. Has that continued into this year?
Brian, nice to see you again. Look, we're continuing to see growth across all facets of the business. We have a ton of white space that we have created moving forward, both by cleaning up old licensing deals as well as entering new categories. And so, again, this capital moving forward will allow us to continue to accelerate the growth. But so far right now, I feel very confident where we sit, only 6 weeks into the year.
What new categories have you gotten into? I still think a lot of people, they see Playboy, they think you're making magazines. I know that is not the case. You know that is not the case. What products have you gotten into lately?
Yeah, Brian, we've returned the company to be a lifestyle brand, which is really, I think, the core to the DNA and how the brand was founded. So we're organized around 4 key categories that are multi-billion, fast-growing categories: sexual wellness, style and apparel, gaming, and lifestyle, beauty and grooming. We've launched Playboy Labs, which is off to a great start, which is our streetwear brand. We have great things planned for color cosmetics and ancillary products around that. We've cleaned up our gaming business, so we have the ability now to enter iGaming in the United States, sports gambling moving forward. And so when you look at it, the growth has come across all facets. Sexual wellness is obviously growing. We launched our CBD products at the end of last year. 3 of them, we have more coming this year. When cannabis is legal in the United States, we do plan on entering the cannabis space as well. This brand has been around cannabis for 40 years. But again, the growth has come from all facets of the business. We do believe the sexual wellness industry It's a $240 billion industry today, projected to be $400 billion in 2024. It's highly fragmented. We believe it's right down the middle of the fairway for us as a brand, and it's something that we're focused on becoming a market leader in.
Yeah, Ben, that was a lot of stuff. It's quite a bit that Playboy's working on here. It's come a long way, obviously, from kind of, the adult background that people might have remembered it in the Hugh Hefner days. But what about, which one of those looks most promising when you point to that growth? Because you say you're seeing 100% growth in terms of where you guys were. Profit, of course, what was it? It was under 300,000 not too long ago for, the year. So what is going to be most substantial when you think about branding Playboy into some of these areas? Because that seems like quite a bit of other entities to get into when you're talking about CBD, cannabis, and all, and sports gambling. Which one's most important?
Yep. Look, they're all important. I think what's most unique about this company and why I took this job, and I thought it was the biggest opportunity I had seen in my career, is the value of the brand. This brand today generates over $3 billion in consumer spend. Products are sold in over 180 countries. And when you looked at this cluttered consumer environment that we all live in today, it's the brand that's truly differentiated. You think about other companies that are trying to launch products, people that are entering the telemedicine space, they're spending tens of millions of dollars trying to build a brand. We have a brand that reaches over 50 million people every day that generates over $3 billion to spend. And so when we look at these categories, although it's not easy, the amount of categories that this brand has historically played in its 68 years is amazing. And so that gives us really unlimited runway moving forward. I will say that the first area that we're very focused on is the sexual wellness space. There is no market leader. It's highly fragmented. And we believe globally we can become a market leader.
I mean, if you think about the Playboy brand, sexual wellness, certainly, I think people can see the direct tie there. But what's the play on sports gambling? A little surprising to hear you raise that. What specifically do you have in the works?
I can't comment on anything that we have in the works today. What I will say is this brand has been in the gambling business for 40 years. We have a casino in London in partnership with Caesars, or what is now El Dorado. We have great partnerships internationally with microgaming, with Scientific Games domestically. We've had in the past some of the best Super Bowl parties, Kentucky Derby parties, and others. And I believe because of the fan base we have, we can activate that fan base around other gaming assets. And so it's something that's been core to our business for 40 years. It's something that we are focused on moving forward, and wait and see.
And how do you think the pandemic has changed your business?
Look, there's no doubt there was a benefit in 2020 on our direct-to-consumer business, but we also lost revenue in other areas. I believe that the strategy that we set upon 3 years ago to move the domestic business to D2C and potentially follow that internationally down the road was the right strategy. We saw those trends internationally before the US had caught up. And so I believe that will continue to benefit us moving forward. We have over 3 million people that we're advertising or marketing to today. If you look at the business in 2020, over 50% of our revenues came from the D2C environment domestically. And when I think about long-term internationally, I believe that we can drive superior average order size and lifetime value of the customers by controlling our e-commerce on a global basis. Now, that's not to mean it's going to happen overnight. But long-term, should we be able to execute on that, we can capture more and more of that $3 billion of spend around the world.
Clearly a lot on the plate there, but now for the first time in a decade, investors having the ability to play that out with Playboy now publicly trading. The CEO of Playboy, Ben Cohen, appreciate you coming on here alongside Yahoo Finance's Ben Sazzi. Thanks again and be well. I want to spotlight again the latest updates. We're waiting to see Bumble shares, that dating app, coming to market, indicated to trade at $73 a share, but we are still waiting to see that come out. Also, we saw their shares priced at $43 a share yesterday, raising $2.2 billion. We'll see where they trade, and we will be discussing all of that with the CEO of Bumble, Whitney Wolfe Herd, coming up later on in the show. Coming up right after the break, though, we're going to be discussing Getaway, a company that a lot of people trying to escape the city in this pandemic have probably heard of. A company building mini cabins in the woods with no Wi-Fi. We'll chat with the CEO right after this. Stay with us. Welcome back to Yahoo Finance Live. In today's Startup Spotlight, we're featuring a company that you probably heard of if you've been looking to book a trip to unplug. For that, a growing number of people have been turning to Getaway, a company that rents out tiny cabins in the woods without Wi-Fi for a totally and completely unplugged getaway. Joining us is the CEO of the aptly named Getaway, John Staff. And John, good to have you on here. We had your co-founder, Pete Davis, on before, but the big news this time around is that bookings are up huge and you just raised more than $41 million in funding. So how busy has it been in the pandemic?
We've been super busy. With all due respect to all the pain that's happened in the world, it's been a wild year for Getaway business-wise. So prior to the pandemic, we were historically about 90% occupied. We had an up and down March and April and early May, like so many folks did, but from about mid-May, it came back with a vengeance. And so we went from about 90% occupied to literally 99.5% occupied everywhere. So we have been very busy.
Yeah, it's interesting to see your growth, John, because if you think about a company like Airbnb, for example, they have seen significant growth because people are sick of staying in the same home, but they still need to work somewhere else. Your proposition is no Wi-Fi, plugging out, completely sort of not being tethered to your phone or your email. I'm wondering who's booking. What more do you have in terms of insight on where you're getting that demand from?
It's really the same folks that have booked Getaway from when we started the company 6 years ago. It's folks that are feeling stressed out, overconnected, overcrowded, people that hopefully love their jobs but know it's not good for us to work all the time, people who recognize the power of technology but know that we have to have boundaries between us and our devices. And early on in the pandemic, it was suggested that Getaway find a way to add Wi-Fi because many folks could now work flexibly, and we drew a pretty hard line and said, no, we still need a time in a space where we can go and really disconnect from our day-to-day grind. And so we never did that. And as we all became familiar with the idea of Zoom fatigue, I'm pretty happy we decided to stick to our guns.
Yeah, I kind of love that because, it's a way to distinguish yourselves against kind of the Airbnbs and just kind of book whatever, because they have cabins too. You could probably get a cabin, but drawing that hard line is very interesting to see in today's digital age. When it comes to raising money, obviously very different than an Airbnb because you guys are building these cabins. So I imagine that's the 41 million that we're talking about here. How much of that is going to go into the growth of expanding beyond? Because I myself was looking at Getaway. Things got very pricey in the pandemic, and even booking one became difficult because so many people were chasing you guys.
Yeah, we're fortunate for all the demand we've seen this year. It is therefore incumbent upon us to bring more Getaways to more folks and in more places. So all of that capital basically will go to expanding. So we just opened a new location, Catskills, that we call Western Catskills. We're under construction, about to open outside of Chicago. We're under construction, about to open outside of Seattle and Nashville, and hopefully we'll be opening several more beyond that even this year. So we will be busy trying to fill in the map with more Getaways.
John, what do you see beyond these current bookings and cabins? It seems like you've got a lot of opportunities at hand here to go beyond just these getaways, but potentially move into lifestyle. I mean, what's sort of the grand vision as you see the company grow at such a significant rate?
Well, the first thing to say is I'm a believer in the entrepreneurial kind of 101 lesson of focus, focus, focus. And so right now, it's all about open more outposts, which is what we call these locations where we put our cabins, make sure each one is better than the last one, learn as rapidly as we can, and as I said before, bring it to more folks. But you're absolutely right that the Getaway brand is not about tiny cabins in the woods. It's about having more balance in your life, about carving out the time and space to do nothing, to be off, to be with the closest ones in your life. And over time, while we don't have any plans immediately, we hope that we'll be able to bring balance to folks' lives in lots of other ways. But nothing to announce yet, as we're sticking to our knitting and have a lot to do in the core business.
Okay, well, I may need to look into some of these bookings soon as we look to try to unplug once in a while. John Staff, CEO of Gateway, it's good to talk to you today. Thanks so much for your time. Coming up, we're taking a look at shares of PayPal getting a big pop in the session. What's behind that big move? There's a hint. Bitcoin has something to do with that. Inez Frey is going to walk us through the moves on the other side of the break. Welcome back to Yahoo Finance Live. We're seeing a bit of a split picture in this session right now. The Dow trading pretty flat after hitting a new high in this session, and the Nasdaq and the S&P 500 firmly in the green. Let's bring in Inez Frey for the latest on the market action. And Inez, you've got your eye on PayPal getting a huge boost in the session.
That's right. PayPal at new highs, up more than 5%. And PayPal has really been moving in tandem with Bitcoin. Every time that we see Bitcoin surge, PayPal does as well. PayPal's invested in cryptocurrency. It offers Bitcoin trading for its wallet users. Right now, we're seeing on our Wi-Fi Interactive board, PayPal up more than 5% today. Also sticking with some of the NASDAQ 100 components, we're looking at Tesla up more than 1%. There's a new report out from Electric saying that Tesla and GM will be getting access to a tax credit, perhaps of $7,000 on some 400,000 vehicles. That's more vehicles, because remember, this is part of a federal program, and this would be part of a reform of that EV program on the federal level. Remember those tax breaks that Tesla had been getting for up to 200,000 vehicles, and then those would phase out. So this could be some good news for Tesla, although it may prompt buyers to maybe delay until they see that credit go into effect, if it does. And then taking a look at the Dow components, we're seeing Cisco up more than 1%, gaining back some of its losses from yesterday. We're also taking a look at Chevron, one of the laggards on the Dow, because if we just take a look at the sector action, what's happening is energy is lagging right now. We are seeing technology, which is outperforming, Akiko.
Okay, thanks so much for that, Inez. Let's turn our attention now back to dating app Bumble. Shares there indicated to open at $76. That is well above the $43 a share it was priced at. Let's bring in Melody Hom, who has been covering this company for us. And Melody, we were talking earlier in the show about just the storyline behind this. This is female-led, really female first, but also you said, you know, it's pretty significant. She, as in Whitney Wolfe Herd, the CEO, one of 3 female founders to take a company public this year.
Yeah, out of about 530 companies that have gone public in the last 12 months, She is one of only 3, as you are alluding to, and I think she may be the only female billionaire of that bunch. According to Bloomberg, the latest results or this public offering would actually value her net worth at about $1 billion. Her stake alone is 900 million, and she's 31 years old, Akiko. So for this to be a feat and for her to be sort of a serial entrepreneur already at this point is pretty remarkable. If we recall, going back to 2014, she had a really bitter, acrimonious exit from Tinder, which was the company that she co-founded and was the head of marketing for. And she ended up filing a sexual harassment lawsuit against them, ended up settling it for about $1 million. But it was a very public divorce, right? I mean, excuse the puns, but lots of dating metaphors can be said from her sort of uncoupling from that relationship. And that very same year, she founded Bumble. She moved to Austin and she started this company. So it's a pretty interesting story and inspiring for a lot of female entrepreneurs out there.
Yeah, and I mean, when we talk about the day one success here, we're still waiting to see how high shares will go when they begin trading, but clearly looking like things are moving in the positive direction. Melody, one of the other things too we've been talking about is kind of how Bumble differentiates itself from the space. Not only is it kind of the woman moves first model in the dating side, but also building out BFF and the professional side as well. A lot of different endeavors here that this company is chasing.
Yeah, BFF, Biz. I know you were speaking to an analyst prior who was an advisor to Bumble, really saying that there's unlimited opportunity. I think we have to take that with a bit of caution, right? When you think about LinkedIn, why is there necessarily a need to go on Biz, right? When you think about new apps like Clubhouse, there's tons of networking that's happening organically. I think the swipe fatigue can be a real phenomenon, right? So would you actually be using Bumble for 3 different activities to find friends and business partners and investors? I'm not quite sure. I'd love to speak with Whitney about that. Of course, our interview with her is coming up. But to your point, Zach, I think this model of women being empowered, right? And they did open in markets like India, China, Mexico, where traditionally speaking, it is very much a male-centered culture when you think about dating and men asking women out on the first date in hetero couples. I do have to say that your anecdote, I've heard from many people, right, that they end up getting less sort of traction on apps like Bumble because maybe women don't feel inclined to make the first move. Maybe they won't be as aggressive. And whether that's a good or bad thing, I'm not quite sure, but that is a reality, right?
Yeah, I'm glad that it's not just me that we're hearing that from, because, you know, it's the same profile on multiple different dating services. So before Akiko jumps on me and says it's just me, thank you for highlighting that, Melody.
Oh, Zach, this has led to some very good conversation, Melody, I should say, about Zach's dating life at his expense. But
Yes.
This is going to be an interesting one to watch. Again, shares of Bumble indicated to open at $76 right now. And of course, it was priced at $43. And Melody already mentioned this, but we will be speaking to the CEO of Bumble, Whitney Wolfe-Herd. That is coming up shortly here on Yahoo Finance Live. We're going to take a quick break here. We'll be right back. Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Zach Guzman. And as we do a quick check of the markets right now, we are seeing the Dow trading pretty flat after hitting a new high in this session. The S&P 500 up 4 and the Nasdaq up 58. Initial jobless claims pointing to little relief in the labor market, with 793,000 Americans filing for unemployment insurance for the first time last week. Ladies first, female-led dating app Bumble making its public debut. Founder Whitney Wolf Herd joins us this hour to discuss the IPO and the growth in online dating. But we begin this hour with Uber. Shares slipping in the session after the company missed quarterly expectations on revenue. Now, the good news here, Uber did narrow its loss in the quarter with significant growth on the Uber Eats side. We saw that more than double in delivery bookings. Let's bring in Dan Halley for a walkthrough of those numbers. And Dan, a bit of good news and bad news here. The core business on ride sharing continuing to be an uphill battle, just given the trajectory of the pandemic. But the Eats side, which Uber has doubled down on, has really helped provide a big cushion.
Yeah, and just to give you a kind of a look at how they've been doing in the past few quarters, let's see, Q2, they had missed by a much wider margin. They had seen a 75% decline year over year in rides gross booking. And then in Q3, they had a 53% decrease year over year. This past quarter, they had a 47% decrease in rides year over year booking. So you can see that trajectory kind of going back up for them. As far as the Eats business, 130% increase there as far as people looking to get delivery food. And that's really been kind of the crutch they've been leaning on throughout the entire pandemic. It's been their one area of growth. Interestingly, though, Dara Khosrowshahi says that they will still hit their profitability goal in 2021. And so that was something that people were looking at, whether or not the pandemic would actually impact that. Don't forget, they've also made a lot of investments in the delivery space. They picked up Postmates, obviously, that closed in December. And they just announced recently that they're going to be acquiring alcohol delivery service Drizzly. That will end up being part of Uber Eats, but also continue to be its own app on the side. So they'll be able to kind of get both sides of the equation there. So they really are pushing deeper into that. It's a matter of just when people will feel more comfortable going out and driving. We had Dan Ives over at Wedbush saying that it would be around 2022 that they would return to pre-COVID levels. But obviously, they're starting to see some comeback as more people are feeling a little bit more comfortable going out. We'll just have to see how the recent spike in cases we saw at the holidays impacts that.
All right, let's dive deeper into the numbers here with Ali Mogharabi. He's Morningstar Research Senior Equity Analyst. Ali, let me just start with your take. What stood out to you in the numbers that we got after the bout?
Well, I think the main thing that stood out was basically progressing towards profitability on the delivery side of the business. So lower EBITDA losses, I think, was pretty positive, while at the same time, of course, maintaining that very, very strong top line growth on the delivery. And you combine that with the fact that these guys can still keep mobility business profitable, again, based on an adjusted EBITDA basis. And that's pretty impressive. It makes it more likely that at least one quarter during this year, the delivery side and overall the company will be able to generate positive adjusted EBITDA. So I think those two pretty much stood out. The other thing that stood out was that these guys are actually trying to increase the volume of their delivery services by tapping into various different products, various different types of deliveries. So as you mentioned previously, the acquisition of not only Postmates, but also Drizzly, but also remember, they bought Corner Shop in 2019. So they're basically trying to expand further in order to continue to remain with the growing demand for on-demand delivery. But I just want to mention one thing to keep in mind is that once the economy basically recovers, we are going to see a return to higher demand on the mobility side, but at the same time, it could somewhat negatively impact the delivery side of the business. So you should look for revenue deceleration on delivery.
That was going to be my question because, it's kind of crazy how fast that Eats side of the business has grown. And I think it's exactly to what you're pointing to, more people staying at home, ordering delivery, eating at home, not going out to restaurants. And of course, we'll see rides come back. That's what we've heard from Lyft and Uber once the economy starts to reopen. But how does that, maybe on a profitability front, how does that shift things for Uber if you do expect more of that rides business to come back, maybe at the expense of Eats?
Yeah, I think to certain, well, I think it will mainly impact the top line. I think on the bottom line, they will still progress towards profitability, because one thing to keep in mind, based on the Q4 numbers, is that the take rate on the delivery side actually was stabilized. So it remains still at around 13%. So that pretty much is an early indication that pricing, when it comes to food delivery only, that pricing has stabilized. So if that's the case, when you've got basically the top two dominating the market, DoorDash, of course, number one, and Uber right now, number two, then you could expect, combine it with the pricing stabilization, maybe a slight deceleration in demand, then you could actually see these guys creating some operating leverage and actually become profitable. So I don't think it will impact profitability that much.
Ali, when you look at where Uber's trading right now, we saw it slipping yesterday and after hours, but it has hit a new high in the session today, up about 0.7%, 63.66 a share. What does it trade on? Is it still on the ride-sharing side of the business, just how significant the footprint is there? Or is it time for investors to maybe shift their attention more to sort of value it as a food delivery company?
Well, I think it's actually both still, because remember, there will be a turnaround in the economy. The pandemic will end at some point. The timing is still very unclear. But once that happens, then you're basically looking at a company with pretty much a diversified revenue base. So on mobility and on demand. And in terms of on mobility and delivery, and in terms of the delivery, it's not going to completely go away once the economy recovers. So, I mean, I think one of the changes that we're seeing due to the pandemic is the consumer behavior to basically be focused more on on-demand delivery of various products in addition to foods. So that change in behavior could actually be sustainable for a long time. So I think. And again, to answer your question, I think it's a combination of both. It's a combination of recovery and ride sharing, and also the continuing growth, although decelerating, but the continuing growth in the delivery side of the business.
Ali, it's always good to get your take. Ali Mogharabi, Morningstar Research Senior Equity Analyst. Let's turn our attention back to the market right now as we await shares of Bumble to begin trading. Remember, this is a stock that was priced at $43 a share. It's now indicated to open at $76 a share. CEO Whitney Wolfe Herd standing by with Brian Sazi and Melody Hom. Melody.
Yes, thanks so much, Akiko. As you mentioned, after pricing at $43, shares are now indicated to open at $76. That's 77% higher. Let's bring in Whitney into the conversation. Thanks for joining us today, Whit.
Hi, thanks for having me. Appreciate you.
So when you think about, the company on Wednesday sold 50 million shares, you had planned to originally sell 45, and that was even a boost from the original S1. Give us a sense of how you're feeling today on this pretty iconic day.
Yeah, I'm very humbled and grateful to be here, and we're very excited about celebrating this milestone for the business, but we are so focused on the long term, and we're so excited about what we're building. And so our global team is taking a moment to celebrate, but then it's back to work, and we're excited to prove out our long-term vision and mission.
Whitney, let's focus in on... Go ahead, Melody.
Go ahead, Brian.
Yeah, let's focus in on what you are, in fact, building here. You wrote in your letter, and I really like the founder's letter in the S1, Bumble has the potential to become a preeminent global women's brand. Where else do you see Bumble going?
Yeah, so when we think about Bumble's opportunity, we look at the woman's life cycle or the person's relationship journey, right? And when you think about all the different touch points you have in your life that are really a derivative of your relationships, whether that's the quest for love or once you find love, how you embark on the next chapter, engagement, marriage, fertility, everything thereafter that comes with those journeys. And then as you navigate that life cycle of looking for friends and community, people to go do the things you love with and to really connect on these shared interests or even find support on common struggles on that relationship journey. And so when you think about both our vertical opportunity to go deeper into love and the extension opportunity in the love category alone, that's massive. And we have not even embarked on this global footprint yet. And so our focus right now is really expanding our dating category to the rest of the world and innovating the technology and the offerings within the dating category, and then to really build out this TAM and this LTV opportunity of connecting people across all their relationships and for anything they're looking for. And with that, always staying committed to engineering accountability and equality online, and to really lean into this moat that we've built, which is a woman's first brand.
When you think about that woman's first idea and female empowerment here, how do you imagine that sort of playing out? As you say, you want to really create a portfolio of brands. Right now you have Biz, you have BFF. Are there other things in the works? Are you going to have one exclusively for new mothers? I know you are a new mother yourself. Curious how you're thinking about that.
There are so many opportunities ahead of us, but as I said, we started this business to rewrite the rules of love and relationships more broadly, but dating is where we saw the highest demand in the immediate term. And the unfortunate reality is too many relationships across the globe are still unhealthy. They're not rooted in inequality. And so we're really focused on proving out this way of putting women in the driver's seat and giving them a safe, accountable platform to engage with others, and then really going deeper from there. So yes, we're very focused on our LTV opportunities, on our other offerings, but we are a team that knows how to focus and prioritize, and we are staying very, very focused on the dating opportunity for now, but there is a long road ahead of us, and you will see a lot of opportunity come from those adjacencies.
Whitney, one thing that has been made clear during the pandemic is loneliness is sort of a byproduct, right, of what everyone has been going through during this time. When you think about how you have filled in that space and people are swiping, even if they're not able to end up meeting in person with these people, you mentioned that you had some of your best revenue generating weeks during the year 2020. Can you speak to the overall business and how it's flourished during a time of economic crisis and despair?
Absolutely. Well, first of all, our hearts go out to everybody that has been negatively impacted by this pandemic. And I think the one thing we have all seen through this is the importance of our relationships. Loneliness is not how we were meant to exist in this world. And we are really focused on connecting people on a deeper level digitally to give them that strong foundation to then take it offline once they're ready. And the pandemic has created this very unique opportunity for a slow date approach, an approach to really get to know each other virtually by video, by audio, by deeper levels of communication. And then you understand if you're compatible. This saves you so much time and energy and risk. It creates a safer experience when you're engaging with dating. And we have seen this become the norm. And we also believe that this is here to stay. The ease and the willingness to date online is here for the long run. I think stigma surrounding online dating has been significantly depleted throughout this chapter. And we think that that has accelerated our opportunity far ahead of where we had expected to be in terms of people being willing to join our product.
Whitney, I would make the case that just the enthusiastic response here, and the stock right now is indicating $76, in part is the market doesn't view you as just a dating app. You know, you talk a lot in the S1 about this new social discovery platform, and perhaps you might be some form of social media platform. Is that the right way for investors to think about you?
I think the right way to think about it is we are not just one relationship as human beings. We are so much more than just love. We are our friendships. We are our community. We are our business opportunities. There is no reason why that will not translate online. The world has recognized the power of online dating, and the world is about to recognize the power of finding community and connections around whatever you're looking for on the internet. And we have been meticulous about building a brand that protects women and engineers accountability and kindness into the internet. We have passed legislation or been part of passing legislation to really make sure that we are doing things differently, that we are building a place you can come to find anyone you might be looking for. And long term, we will be a platform much wider than just love. But that does not mean we're not laser focused on love right now, because as I said, there's huge opportunity ahead and the dating TAM is very wide.
Well, love, Whitney, seems to be profitable because unlike a lot of tech companies that we have talked to over the past year that have come to market, you've actually made money on an adjusted EBITDA basis. Through the first 9 months through September 30th, you've pulled in $98.9 million, again, on an adjusted basis. What is the secret sauce of this model? Why are you profitable on that basis?
We are profitable because of our commitment to engineering an authentic and genuine experience, and because we looked at the market and we recognized that nobody, not in the physical world nor the digital world, had ever built a technology platform or brand fully centered around women's wants and needs. We identified this massive white space, and it has proven to be an incredible business model. And so this just proves that passion, purpose, and profit can coexist.
Whitney, I think what Brian was mentioning, especially in regards to the social component, we've seen social media giants really get hammered, right? Because of censorship issues, because of this whole debate about whether whether folks are allowed to post freely on platforms. I understand that Bumble has a zero tolerance behavior for hate and toxicity. Can you speak to whether you've seen an increase in bad actors on your platform, especially as you have diversified your offerings during this time?
So we are not scared to take a stance for what we believe aligns with our values and our mission. Historically, we've banned guns from our platform. And just 2 weeks ago, we have banned any form of body shaming. This is not going to be tolerated on our platform. We are going to take the lead on really engineering a more accountable experience. In the real world, there are guardrails, there are laws, there are consequences for your behavior. There is no reason why consequences should not exist digitally. Now, we're not trying to, censor people, but we are trying to tell you that if you want to behave poorly, you cannot do it here.
When you talk to us about M&A, the whole dating industry is it's rolled up seemingly into a couple different companies. The bigger keeps getting really bigger. What are your thoughts on M&A? Are you an acquirer?
So my vision from day one was build a platform and a brand where you can have extensibility opportunities, and then you won't need to rely on M&A down the road. And when we think about M&A, we will not approach M&A from adding more brands and adding more audiences and more scale. We can scale within. We have the trust, we have the brand, we have the technology platforms, we have the innovation, we have all the ingredients we need to scale with our core brands, but we can always approach M&A to support that. So through technology initiatives or product initiatives, or if it's an acqui-hire, there's a lot of opportunity ahead. But that is really the more theoretical, high level way we're thinking about it.
What is happening on the ground and is not theoretical these days is this influx of folks you're seeing from Silicon Valley to places like Austin. And I know you set up Bumble in Austin in 2014. When I covered South by Southwest years ago, you would always open up your space for reporters and for lots of hobnobbing. Tell me about what you're seeing on the ground there. You were sort of an early mover in that sort of tech going to Texas. Are you seeing more of your colleagues doing the same?
Absolutely. Texas is the friendship state. It's a great place to be, and it's obviously very attractive for technology businesses. And I will attribute a lot of our early success to being here. We were able to be with our everyday customers. We were not getting caught up in the mix and the noise of Silicon Valley, with all due respect to that area, but we were able to branch out and do our own thing and to beat to our own drum. And we're very grateful to the state of Texas and to Austin and to our community here who has supported us and helped us thrive.
Thanks so much, Whitney Wolfe-Herd, the founder and CEO of Bumble, going public today. Now back to you, Zach Guzman.
Yeah, I'll pick it up here in Texas. Shout out Texas. Appreciate that interview, guys. We're going to take a quick break here on Yahoo Finance Live. And of course, we're still waiting to see where Bumble shares will officially open. We'll bring that update to you as we get it, but much more coming up right after this. Welcome back to Yahoo Finance Live. In this week's tech support, our own Dan Howley is taking a look into the struggles of trying to unlock iPhones while wearing a mask. That now getting easier. And Dan joins us now with a look at that. Dan?
Yeah, you can see I'm wearing a mask right now. A lot of us are very used to doing this. My beard looks ridiculous sticking out of it. And one of the big issues for people with iPhones, especially newer iPhones, is that you can't use Face ID when you have a mask. So that means constantly having to enter your PIN number multiple times. I know on the big list of first world problems, this is probably number one, but it is an issue for a lot of people, especially if you're at the grocery store and you're trying to bring up your shopping list. So Apple has a new way to unlock your phone using sort of Face ID while bypassing that annoying number pressing action. And so what you need to do is in the upcoming version of iOS and watchOS, there will be a feature where you can go into the settings menu. You would go to your privacy or your Face ID area, and you would turn on a feature called Unlock with Apple Watch. Now, that's the big caveat to all this. You need to own an Apple Watch as well because it's Apple, so of course you do. And once you're able to do that, what you'll be able to do is just simply look at your phone, swipe up, and you'll get a notification on your watch saying Unlock with Apple Watch. Mine just went away. There we go, just unlocked on its own there. And basically, it's coming to phones in a future release. We'll do that again. So see, it's locked, swiping up, check it out on my phone, and it's unlocked. So what you can do is basically do this anytime you're wearing a mask. And obviously, if you're trying to follow mask rules, it's the most important thing if you're out in public. So this will make it a little bit easier. And again, big time first world problem, but a lot of people complained loudly, including myself. And here's the kind of solution to that problem.
Yeah, I guess it is a solution. I suppose it is when we talk about these inefficiencies around all this, because it is something that has infuriated people around the masks. But Hallie, I mean, I guess maybe that kind of speaks to the overall reason as to why we're seeing devices take off, right? It's part of that whole ecosystem thing and saying, look, Apple is here. If you have a watch, it makes your use case for using a phone easier. And that's kind of the whole thesis around why they've invested so much in that space.
Yeah, and look, I mean, this is something that they've worked really hard for, and you can expect they're going to have probably the fingerprint sensor return in future iPhones, just because, I mean, look, this has been a problem, and people still also like to use the fingerprint scanner, so I think that'll return. This may be just a quick fix for people who have phones that don't have that right now.
Apple always finding a way to pair those devices, right, Dan?
Oh, yeah.
It's all a strategy here between the phone and the watch. I have the watch. We'll have to check out that feature a little later. Thanks so much for that, Dan Howley. Much more coming up here on Yahoo Finance Live. We are still waiting for shares of Bumble to begin trading. We're going to take a quick break here, and we'll be right back. Welcome back to Yahoo Finance Live. We are still waiting for shares of Bumble to begin trading there. Shares are priced at $43, now indicated to open at $76 a share, I think at last check there. So we're expecting a significant bump there. Just one of many companies that have seen a huge bump, at least on the initial day of the IPO. Let's bring in Ted Smith. He's Union Square Advisors co-founder and president. Ted, it's good to talk to you today. I imagine you've been having a lot of conversations with some of the companies that you have invested in about just this red hot environment around IPOs, whether it is through a traditional listing or through a SPAC as well. What's the feeling right now on the private side of things?
Well, first of all, Akiko, thank you for having me on today. I really appreciate it. And you're absolutely right. We're having a lot of conversations with our later stage private clients about how they think about ultimately achieving an exit. And there are so many more options today than there ever have been. There's the traditional IPO, which is obviously still available to companies of size and certain financial performance. There's this incredible surge in SPAC we've seen over the course of the last 12 months. And there's a very active M&A environment as well, both from strategic acquirers as well as financial acquirers. Sponsors, private equity firms have never been busier, have never had more capital at their disposal. So really, it's a terrific time to be a high-flying, later-stage private company, just in terms of the amount of capital that's available for those businesses and the opportunities they have to either go public as a way to achieve an exit or to achieve an exit through a sale to a strategic or financial partner.
Ted, just to follow up on Akiko's question there, I mean, how worried maybe should people be when we talk about this drawback in comparison to the tech bubble? Because we have seen valuation stretched here, and we'll see where Bumble goes. But it seems like we're seeing more and more, whether it's SPAC deals or IPOs, more and more enthusiasm, shall we say.
We are seeing a lot of enthusiasm. I do think this is different. I mean, I'm old enough that I've been doing this and was part of the environment in 1999, with which the current environment is often compared. I think the major differences are at least twofold. One is I do think that companies that are going public today have much better longer-term business models than a number of the companies that were able to get public in the late 90s, early 2000 timeframe before kind of the original tech bubble burst. So I think there's a difference there in terms of the long-term viability of these businesses, their capital consumption, and ultimately their ability to generate profits. So I don't think there's an apples to apples between the types of businesses that are getting public. I also think that the markets are significantly more liquid these days. And as I mentioned before, significantly more options for companies to achieve some form of liquidity event. It's not the IPO or bust or IPO with maybe an M&A as a backup plan option that was really in vogue or dominated kind of the late 90s, early 2000s scene. There's so many more options at this point that I do think that that's also a difference between the two markets. That being said, there's no doubt that we have an incredibly hot valuation market right now. What we've witnessed over the course of the past 12 months as we entered into the pandemic, we saw the markets in near free fall, late in the first quarter of last year. They stayed there not very long as optimism surged, and as at least in the tech space, as there was a view that technology companies were going to be part of the solution to how we were going to address the pandemic as opposed to part of the problem. And we've seen those valuations continue to climb then over the course of the last 9 months. And we expect that, frankly, to continue. So I think investors in this environment do need to be cautious about the valuations that they're paying for any company in any particular construct, just given the fact that those multiples that are out there are really at all-time highs in many cases. But we also see these businesses continuing to grow, continuing to intelligently consume capital to bring on new customers, whether those be enterprises or consumers. And so we think there's still a long path for these companies to continue to succeed. And that's why they've achieved these incredible valuations. And frankly, we'll probably continue to have those.
Ted, you mentioned the huge growth that we have seen in SPACs, and I wonder how that has affected things on the VC side. We've heard about just how competitive it is, where investors are pitching these companies saying, please let us take you public. Does that ultimately lead to a significant disruption for VCs?
Well, I think it gives VCs one more arrow in the proverbial quiver with which to think about their exit alternatives, and certainly VCs that have companies of scale in their portfolios are evaluating that. Also, companies that have perceived high growth prospects that aren't yet of scale clearly are interesting to some SPACs at this point. Given the difference in the way SPACs are ultimately marketed to investors and the opportunity for companies to get public earlier rather, by merger with a SPAC, we are going to see some more VC-oriented companies get public this way. I think the one thing I worry about in that world is we haven't yet seen sort of a major meltdown of a tech company that has gone public by a SPAC, an entity that wildly misses the projections with which they went out to the market and talked about these tremendous growth prospects and ultimately their profitability prospects. We haven't seen that happen. And obviously I'm not hoping for that, but I think history would indicate that we will see that happen at some point over the course of 2021, and then it will be interesting to see if the SPACs sort of take a step back and say maybe we push that envelope a little hard. Maybe we should not be thinking quite so aggressively about some of these earlier stage companies becoming public, because there is a reason that through the traditional IPO markets these companies would not be going public just yet. And ultimately, I think we'll see a convergence in the standards by which companies can go public through the variety of means, regular way IPO, direct listing, and SPAC, such that companies of a certain size and growth and profitability threshold do get public, whether they go whichever one of those routes they choose.
Ted, let's talk about your investment thesis right now, some areas you're focused on over at Union Square Advisors. Obviously, we've heard a lot about the growth in the AI space and the cloud space as a result of the pandemic, but you've also sort of looked at some of the verticals that are likely to get a big bump on the back of this global vaccine distribution. What's catching your eye on that front right now, and what are the opportunities for you?
Yeah, so Union Square Advisors primarily helps later stage private companies and public companies raise capital and also advises them on their M&A exit alternatives. So you're absolutely right. We continue to focus a lot on AI in its various forms. We think its applicability to a broad range of verticals, places like human capital management. We're certainly spending a lot of time with companies that have next generation AI for security purposes. AI at the edge being used in smaller devices like cameras and other devices that are not full-blown computers, we see as being incredibly important and also relevant to how we communicate and how we interoperate during a pandemic. Having that AI at the edge, which can replace a human being doing a wide variety of tasks where we're trying to keep human beings from congregating, is incredibly important. I see there on the graphic, and we've talked a lot about digital transformation, which we think the pandemic has only accelerated. So as large enterprises finally get around to reducing their paper-based footprint using a combination of robots and technology to be able to manage their massive paper factories and convert those into digital use cases, we think is an enormous business. We're tracking a number of really interesting companies in and around that space as well.
Yeah, it's been fascinating to see which sectors have really thrived throughout the pandemic. And Ted Smith, Union Square Advisors co-founder and president, it's good to talk to you today. I appreciate you stopping by. Let's turn our attention back to the markets right now, and shares of Tilray specifically diving in the session down more than 40% right now. Zach, I know you've been watching this one very closely, and there is an element of the Reddit trade in here.
Yeah, and I want to get into that in a sec too. I just want to piggyback off of what we were hearing from Ted there, because we keep talking about SPACs, and I just feel like it's worth putting out maybe some warnings on those, just because Nikola came to mind when he was talking about companies that have kind of done exactly what he's talked about in terms of maybe being a little bit riskier than going the IPO price. That's a company that's down 72% since its peak in the summer, also getting investigated when we talk about the investigations from the SEC and the Justice Department. So there are warnings on SPACs we should note. I raise that because we have seen increasingly SPACs come out in the cannabis space as well. And I think, we're seeing right now Bumble shares opening to trade, Akiko, and that's something we've been waiting for, opening at $76. So I'll continue my discussion on cannabis in a second, but let's first talk Bumble here open for trade.
Yeah, I mean, $43 a share is where it priced at. $76 is where it's trading at. So you see on the board right there, we're talking about a near 80% pop in its initial debut here in the market. There's a number of threads I think that's going to be interesting to watch with this company. Obviously, the online dating space, one that we have seen significant growth in. And Bumble comes to the market with a very unique proposition in the space, being that it is the app that allows women to make the first move. And Zach, yes, you've mentioned that leads to maybe not as much engagement, at least on the male side. I thought it was interesting, though, when we spoke to CEO Whitney Wolfe Herd just a short time ago, how she was talking about this company growing beyond its core dating right now. And it does really feel like she sort of see these growth opportunities kind of following the trajectory of where women are in their life, sort of get in on Bumble on the initial dating interest, and then from there sort of moving on to Biz, which is sort of connecting businesses to businesses, sort of being at every corner here as women build out their own individual brands. So it's going to be interesting to see where the growth opportunities are for the company, but you see it right there now, up more than 80%, Zach.
Yeah, from an investment point too, I feel like we should stress, as a user of dating apps, the knock on them is that they're not really there for you. And we heard, Whitney talking about the idea that they're there for love. If you use it, obviously, and if you're an investor in this space and you've traded a Match Group and you know what Tinder's all about and you know what Hinge is trying to do, the monetization question is obviously there. And monetizing users and seeing what they're going to be willing to charge or pay for is an important piece of this if we're going to focus in on profitability for Bumble and where they go from there. And I think it's going to be interesting to watch as this company progresses on those endeavors, how monetizable something like a BFF is. If that is going to be the way they differentiate themselves in the space, how much money can you really make from charging from people trying to make friends on a digital platform like this, particularly when you start to see things open back up and you might not need a Bumble BFF as much anymore. And to Melody's point, when we were talking earlier in the show, how much importance is going to be there on the professional side if you still have a company like LinkedIn growing? I think that those are two big questions that we don't necessarily know as this company debuts. Of course, a big pop here, but there are opportunities to maybe reflect and go back to the growth rate that we saw from Tinder. When you look at a Bumble and match up, this is something that was talked about in the Wall Street Journal. If you match up where their growth rate was at back to where Tinder was, it's still about half of where Tinder was when they were at this growth stage in the company. So, I mean, you can make the case that, sure, there's stigma that's now gone around dating apps and people are much more comfortable with that. But if that was the case, you would expect Bumble to be seeing a quicker growth rate, and that necessarily has not played out. So I think there's still a lot of questions about where Bumble's going to fall in the category, but obviously early on yet, and shares on day one popping as per usual.
Yeah, that's an important point, I think, to make here when you put it sort of side by side with other dating apps. Bumble may be sort of that place where a lot of female users feel a little safer. But to your point, from a business standpoint and engagement, it still lags behind where Tinder was at this point. And of course, Whitney Wolfe Herd came from Tinder. That's a big part of her story, which is just how contentious the experience was for her within that company. She's now started Bumble, and of course, seeing a big pop on the initial day. Much more to come here on Yahoo Finance Live. We're going to take a quick break here. We'll be right back.
Welcome back to Yahoo Finance Live. Today's big stock to watch in their debut. Want to spotlight shares of Bumble. Opening trade at $76, trading right now just a little bit below that. Of course, they priced shares at $43 a share in the IPO that raised $2.2 billion, a big step up from where we were seeing prices just a couple weeks ago. The target that was earlier set at $28 to $30 a share got boosted to $37 to $39 a share, opening a trade at $76. So quite the step up here in just a short matter of time for that Austin, Texas-based dating app. And we'll bring you highlights on that later on the show, something people are going to be talking about for quite some time. I want to shift gears a little bit, though, over, since it is Thursday, to our series here led by Yahoo Finance Editor-in-Chief Andy Serwer. In Influencers this week, sitting down by Grow Intelligence founder and CEO Sarah Manker to discuss the challenges of food insecurity and how that's been exposed here in the coronavirus pandemic. Take a listen.
Last year, COVID exposed how fragile our food systems really are, how they're built on very short-term thinking, right? So the breaks that we saw in the supply chains were a function of the fact that, you know, if you think about food and agriculture, it's an industry that's been around for over 12,000 years. However, if I find oil in the ground and I want to go sell it 20 years forward, I can do that. If I want, most food transactions are still done on a week-to-week, month-to-month, day-to-day basis. And so that means that, like, something goes wrong, the system breaks. And so, you know, a huge part of the crisis we were warning against was driven by the fact that it is a global market. And so a global market means that you have sort of supply centers and you have demand centers. And if there's these deep imbalances that are built, you could have, you know, the areas where you have the largest growth in sort of demand could have a complete mismatch from the areas where you have the largest growth in supply or have the largest pools of supply, and the cost, right? So it's a function of trade, it's a function of demand growth, and then it's a function of cost. And what we're seeing happening this year, and it's a story that no one's really talking a lot about it, I think it's going to only manifest itself more and more, is that the local cost of food in so many economies has skyrocketed over the past year. Because again, you have net exporting countries like the US and Brazil, Argentina, Russia. But outside of the US, every one of these net exporting countries are having currency crises due to COVID, right? And very weak macroeconomic structures. And what that is leading their governments to do is to start curbing exports as a mechanism for protecting local inflation, because food inflation is your worst form of inflation. And so in a world where you have commodity prices and food prices that are going up, which is what's happened over the past year, because of demand coming out of China, Chinese demand hasn't slowed down. You have countries that are exporting countries with currencies that are down 20%, which means that if your price of a product is up 15% and then your local currency is down 20%, inflation is just skyrocketing. So you're having a lot of countries now curb sort of exports and lead to protectionist policies that I think can lead to all sorts of effects.
What countries are you referring to, Sarah?
So Russia, Ukraine, these are very large consequential economies that also play massive exporting roles, and South American countries like Brazil and Argentina, right? So big countries play a very big role in agriculture, but actually play a large role in like global sort of economic dynamics as well.
One thing you didn't mention as a threat, and I know you're concerned about this as well, is climate change. How does that factor into your thinking?
Well, it factors in a huge amount, right? So if you think of how we ended up with, our platform currently ingests over 40,000 different data sources from around the world. Think of it as data that comes from public agencies, NGOs, companies that we partner with and license their data, and we redistribute their data. So it's a wide range, and then data we generate ourselves. A huge amount of understanding agriculture means understanding your environment and ecology. Like if you think of sort of the climate change conversation is this natural tension between ecology and economy, right? There's this tension, like economic growth has come at the cost of ecological decline. And agriculture kind of sits in the middle of the two, because agricultural demand is very much a function of economic growth. and economy, and agricultural supply is very much about ecology. And because of that, our platform had tons of economic data and tons of climate data just naturally in it. And so we were able to sort of model and look at the role that climate change has in agricultural supply, and then extend that to many, many other industries, everything from infrastructure to mining to utilities, et cetera. And one of the things that we saw, in a year like last year, the US alone experienced wildfires in the West Coast, experienced floods in the early part of the season, then drought, then like unprecedented derecho winds in the same little microcosm of the Midwest, right? And so you're having multiple types of disruptions happening much faster than they ever did before. And that's going to impact industry in sort of an unprecedented rate. And it is already, right? The number of billion-dollar plus climate disasters that the US had last year was 22. It had 22 billion-dollar plus climate-related disasters. This is everything from hurricanes to droughts to wildfires to storms and whatnot. Now, if you think of the trajectory, if you look at the last 40 years, the last 5 years have had record numbers year after year. The second record after the 22 we had last year is 17. The pace at which this is growing is just huge. And this is happening everywhere in the world.
Grow Intelligence founder and CEO Sarah Manker there talking to our editor-in-chief Andy Serwer. We're going to take a quick break here. On the other side of the break, we're taking a look at the cannabis space. Some unusual moves in those stocks. Zach is going to break it all down for us. We'll be right back. Welcome back to Yahoo Finance Live. All three indices right now trading lower in the afternoon session. In terms of sectors that are seeing the biggest moves, really tech, the only one that's in the green, up about 0.5% on the S&P 500 there. Let's bring in Jared Blickery for the very latest on the market action. Jared.
Well, yes, we're looking at all the majors plus the Russell 2000 in the red, and the Russell 2000 off about 0.9% right now. So want to track that. That has been the source of strength for most of the week and most of the year. Now, looking inside the NASDAQ 100, and as you said, Akiko, tech is the only sector in the green right now, but you wouldn't know it from the mega caps because look at this. Apple, Amazon, each down about 0.8%. Facebook off almost 1%. Tesla bucking the trend up 0.75%. And just looking at the biggest winners and losers here, it's really the chip stocks that are in the forefront. We got KLA 10 Core in the upper left. That's up 6%. And a lot of these names, by the way, are at or near record highs. You can see kind of going sideways for the last month in KLA, but we have chip earnings intermixed throughout the entire earnings season. So lots of potential catalysts there. Similar situation for Lam Research. And then I'm not going to show you Applied Material, Western Digital, and all the others, but they are up there. Also, Kraft Heinz finally going to divest those peanuts. Warren Buffett must be happy about that, unlocking some value there potentially. To the downside, it looks like O'Reilly, that is down 5%. O'Reilly Automotive down about 11% over the trailing month. Now, here's the sector action for today. Only green is in tech, and the biggest red spot, sore spot, is energy, crude oil, off a little bit here. XLE down 3%. So let's take a look inside the energy sector and see exactly what's going on. Now, Exxon is down nearly 4%. That's in the upper left. And we have Chevron that's down 2%. So really the big majors, those are big underperformers of the day. And then Halliburton, that's down 5%, Occidental down 4%. So really giving back some of those gains. But take a look at year to date, much different picture. Sitting on some nice gains, there's Exxon still up 19%, guys.
And Jared, we're also seeing some big swings in the cannabis space. Tilray getting hardest hit in this session, down more than 40%. What's behind the moves there?
Well, I don't think it's anything in particular other than some of these stocks, a lot of these stocks, maybe all of them went too far, too fast. Let's take a look at our heat map on the Wi-Fi Interactive again. And indeed, this is a year-to-date look. So let's go to the intraday. We can see Tilray off 40%. You look at what it's done over the last 5 days alone, still at 40%, but well off these highs here. Maybe a little bit reminiscent of something that happened before. This would be 2018. Zach, I know you got some thoughts on this too. My personal feeling is, although the Wall Street Redditors have, or Redditors, Wall Street Bets Redditors have kind of glommed onto this trade here, there's a lot of fundamental strength in the sector. It's not just Tilray. We can look at some of the other names, but also the ETFs themselves. A lot of these stocks are still under those highs that we saw from a few years ago, but a few have broken through. And I just think it speaks as to the fundamental story behind the space. The incremental moves that we get towards legalization in the U.S., plus some positive earnings news that's coming out. I think is it Tilray reports early March? No, might be one of the others. But nevertheless, over the next few weeks, we're getting a bunch of earnings. So I'd be interested to hear Zach's take on this.
Yeah, I think
well,
that's
Jared,
one of
let's
the
ask
things.
Zach, because Zach, I have to wonder if Tilray CEO there having a little bit of PTSD a few weeks ago when we were talking about the big short squeeze on GameStop. He was, on air saying, "Look, I know how this goes because I experienced it back in 2018."
Yeah, and a lot of focus has been on Tilray for good reason, because it's, we were talking about it this week. It was up more than 400% year to date in just 40 days. So we had seen a big run up, and to Jared's point, that's one of the biggest losers today. But the other names being mentioned in Wall Street's Reddit bets, there is a piece of that to the story, because it wasn't just Tilray, it was also Sundial, another Canadian company out there that had dropped precipitously from its $13 range we saw it trading when it came out publicly years ago. But I think, to the point that Jared's making, you're kind of tossing out an entire sector here in today's sell-off. Even Canopy Growth is off 23%, and that's a company we were highlighting in our discussions with CEO David Klein this week about the profitability targets that had been moved forward because of U.S. laws changing here. That's a company that, it hadn't run up necessarily the same way that Tilray and some of these others had, and has real numbers to point to. So, I mean, right now, it looks like a lot of panic selling spilling over from some of those names that had detached from fundamentals and run up in the excitement. But when we talk about the U.S. operators, that's another piece of the puzzle here too, because those are the companies that are going to see the biggest benefits if we do see those changes. And that's kind of where this thesis started in today's in this week's price action, talking about potential efforts to legalize cannabis at a federal level. If that happens, it's going to be a big boost to the names on the screen here today, also getting hit hard in today's sell-off. So I think right now investors would be wise to take a step back, look at which ones had run up the most, which ones had not. The U.S. operators didn't necessarily catch a rally in this wave. And today seems like one of those opportunities, rare opportunities to maybe, if you believe in the long-term thesis around the cannabis space, to maybe start to enter here, because there's some irrationality trickling through here, Kika.
Yeah, and we've seen it swing in the opposite direction, right? I mean, we were talking about this at least post-election about just the optimism around this space because of the state legislation. So what we're seeing, the shifts at the local level, but also the expectation that now there's a new administration, the federal legislation can shift in a significant way, even if it's not going to happen immediately here. Going back to the short squeeze though, Zach, I mean, when you look at some of these names on the board that we're looking at right now, who's most vulnerable on that front?
Yeah, that's a good point to raise here too, because that's kind of the other underlying piece that connects it back to the Reddit trade, which of course triggered the GameStop moves, because we saw that in terms of short interest on GameStop, we were talking about 140% of float. A similar story was playing out with names like Tilray and Kronos. Those were two of the most popularly shorted names in the space. But S3 Partners in their data highlight that we saw the float interest come down since January, falling by about 9.4% since the beginning of the year, down from 24% to 14%. So I think some of the price action in that run-up may have been short covering, and that boost not there today, and that could be the reason why we're seeing kind of that top tick and reversal now playing out in the cannabis space, because there's just not as much fuel to that short squeeze playing out like what we saw in GameStop. It's not the same thing at all.
Although you could argue for those who have been invested in the space for a while, you get a little accustomed to some of these swings, right? The volatility that comes with the space. Let's do a quick check of overall markets, though, before we move on to the next hour here. We are seeing red across the board. The Dow in the session hitting an intraday high early, but right now it is down about 121 points. The Nasdaq down 11 and the S&P 500 down 9 points. That does it for Zach and I in the 11 to 1 p.m. hours. Kristen Myers is going to pick up our coverage on the other side of the break.
Happy Thursday. Welcome into the 1 p.m. hour here on Yahoo Finance Live. Taking a look at the market action right now. As you can see, all three major indices are in the red. The Dow down over 135 points right now. The Dow is pulling back from its record intraday highs that we had seen a little bit earlier in the trading session. S&P 500 and the Nasdaq also in the red. The S&P 500 down about 0.25 percentage point. On a sector basis, we are seeing pretty much every sector right now in the red, except for tech. Tech right now is leading up over 0.5 percentage point. Energy right now, the laggard, down over 3%. Now we have seen a nice rally for the month, especially as we have a strong earnings season. But over the last couple of trading sessions, we've seen markets taking a bit of a pause. Investors right now digesting some economic news, at least when it comes to the labor market. So let's look at some of those jobless claims. Came in at 793,000. That is worse than what analysts and economists had been expecting. 760,000 had been the number that they had been anticipating. Continuing claims came in at 4.545 million. That is compared to the 4.420 million that had been expected. So while these jobless claims did come in higher than expected, I want to note it is, however, a fall from the prior week, which had been upwardly revised to 812,000. So we are seeing those jobless claims still continuing to come down. Let's take a look over at some stocks. Let's start with Bumble. They did open today, priced at $43 a share, opened at $76 a share. That stock right now receiving a nice pop on its open. As you can see, they're up over 67%, coming back a little bit from that opening price, but still a nice pop from that original price offering. I want to take a look over at Restaurant Brands. Disappointing earnings from that company. Shares of that stock now are taking a leg lower, down just under 3.5%. We'll be hearing from the CEO of Restaurant Brands International a little bit later in the show. I want to take a look at a stock right now that is, however, in the green, and that is Zillow. A nice pop there, up over 13.5%, almost up 14% today. They had a strong earnings report as they handily beat on both top and bottom lines. But I want to start with the latest that is happening on the Hill. The impeachment trial is continuing as the Senate watches videos from those riots on January 6th. We have Yahoo Finance's chief political correspondent, Jessica Smith, here with us now. She's also got some more information on the president's meeting on the country's crumbling infrastructure. Hey, Jess, so starting on that impeachment trial, where do we stand?
And managers are again trying to make their case today to the Senate. They are trying to show a pattern with the president of inciting violence. Today, they've talked about his tweets targeting the Michigan governor and then his response to the plot to kidnap her. This comes after they did show some never before seen video yesterday of the riots. It was security video that was just chilling to watch. It showed Vice President Pence and his family being rushed from the chamber minutes before the mob made it in. It also showed Officer Eugene Goodman steering Senator Mitt Romney away from the rioters. It showed Leader Schumer running away and then having to turn around, run back, and quickly shut doors before the mob got inside. There were just very emotional, disturbing moments that the senators watched play out. And some of the senators, you could tell, were affected by this. Some of them were saying that it was just hard to watch all of that play out again and watch this video that they had never seen before. Some of them didn't realize just how close of a call it actually was. The managers are also trying to show that President Trump was central to all of this. They are showing his old interviews, his tweets. They are showing how he spread the lie that the election was stolen. He riled up his supporters, sent them to the Capitol, and then when violence broke out, he did not stop it. But still, there is little chance at this point, it appears, that there will be 17 Republican senators who vote to convict. We have heard from several of them who say they just are not convinced. We should note, Kristen, we did hear from President Biden this morning saying that he didn't watch the trial live yesterday, but he saw news coverage and he would guess that it could change some minds. So we'll see if he's right on that one.
Yeah, we'll all be waiting to see if that changes any minds. As I mentioned, you are also keeping an eye on President Biden's meeting on the country's infrastructure. Give us a little bit of an update from that meeting.
Yeah, he did meet with 4 senators today, the top Republican and the top Democrat on the Public Works Committee, which really plays a central role in any infrastructure plan. Transportation Secretary Pete Buttigieg called in by video as well. And they were talking about how they can get started on this plan to rebuild the nation's infrastructure. President Biden has made it clear that, yes, he wants to do the rescue package. That is first, but then he also wants to do a recovery package that would focus on creating jobs through infrastructure and clean energy. He said that he talked to China's President President Xi last night for 2 hours. And if the U.S. doesn't step up on infrastructure, he said that China's going to eat our lunch. He says China is investing in rail, they're investing in autos, they're investing in a whole range of things, and the U.S. really needs to step up. I talked to the U.S. Chamber of Commerce about this, and they said Biden has a point. Let's watch.
The longer we delay having a national infrastructure initiative, the more we're going to lose productivity, the more we're going to have a decrease in our quality of life. And other countries are doing it. We need to make sure we have modern infrastructure that connects rural areas with urban area centers. We need to have our highways connected to our airports and our rail. And we need to do it and that's why we have to have a federal bill.
The chamber is hoping to see that bill to get it done by July 4th. They are urging the White House and Congress to act quickly. After that meeting, the White House did say there would be more meetings in the future. Kristen.
Yeah, Jess, I think infrastructure is a huge area of bipartisanship because I think you'll be hard pressed to find anyone in this country, politician or otherwise, who doesn't agree that the country's infrastructure absolutely needs some work. Chief Political Correspondent Jessica Smith, thank you so much for bringing us all those updates as always. And let's keep the conversation going now on market action. The NASDAQ just flipping into the green, trading fairly flat right now. We have Bumble's IPO well underway. So let's bring on Daniel Morris, Chief Market Strategist and co-head of Investment Insights Center for BNP Paribas Asset Management. Daniel, I want to start with Bumble's IPO. It is retreating a little bit from where it opened at $76 a share, but still a nice pop over that IPO price of $43 a share. So to borrow my coworker Zach's love of puns, I'm curious to know if you love some of these dating apps. Some folks had been saying that Bumble's valuation was a little bit high. 43 was above its expected range.
Well, I think it goes to the broader question when we think about valuations within the technology sector, valuations across the market. If you look at forward PEs for the S&P, particularly for the tech sector for NASDAQ, and you compare that to historical averages, you inevitably, I think, come to the conclusion that things do seem quite high. I think what we need to remember, though, when we do historical comparisons with PEs or earnings yields, is the difference today versus the environment 10, 15, 20 years ago when interest rates are much higher. So in aggregate, multiples do seem high, but we think that's at least to some degree justifiable by low interest rates. But of course, that doesn't exclude the possibility that you have individual stocks, that you have particular sectors where things are more extreme. So it kind of always comes down to the importance of being able to pick the stocks, pick the right stocks, hopefully, to avoid those scenarios where the multiples really do seem stretched.
That point on valuation is a well-noted one, particularly in the sector of tech. And I do want to circle back to that in just a moment. But I want to ask you about another piece of economic data that we do have out today, which is the jobless claims, worse than expected. However, still coming down from the prior week, which had been revised upward. That was a huge, nice drop that we had gotten in the prior week's numbers. Do you really just take this as, you know what, all signs really seem to point that the labor market is continuing to improve?
Well, I wish it were were so easy to conclude that. I think if we look at the non-farm payrolls data that we got a week ago, there was improvement. I mean, you did have job creation, but it was primarily temporary. Permanent job creation still quite weak. You still have several sectors where you had a decline in jobs. So I think it's quite mixed, frankly. Even if the number was down from the previous week, it's relatively elevated. So what we really need to think about, though, is what's driving those struggles in the labor market. And it still comes down to the level of restrictions in the economy, either imposed by states or by cities, or just people's reticence because of the pandemic to pursue the activities that they normally would. So the healing of the labor market is primarily going to depend on the level of those restrictions, as opposed to, frankly, necessarily any fiscal stimulus.
Over the last couple of trading sessions in the markets, we've seen a little bit of a seesawing where we're touching these intraday highs, and then we see the markets essentially turn tail and start to retreat. All three major indices right now are in the red. The NASDAQ had flipped into the green just a moment ago. I'm wondering if you think that a correction is coming up imminently, and if there is, would you view that as a buying opportunity or the beginning of the markets really starting to take a leg lower?
I think would be more the first scenario that you laid out. We actually are cautious in the short to medium term about the market, really for the reasons that you highlighted. One, there are concerns about valuation. Secondarily, at this point, we've had the good news, I think, around the vaccines. We've had the good news priced in around earnings. We've had the good news priced in with the stimulus package, and you ask yourself, well, what's going to be the next bit of news? And the concern clearly that it's going to be negative, either around the pandemic, around variations, mutations of the virus, or concerns perhaps that we don't get as much stimulus as the markets are expecting. So I think the risks are tilting a bit to the downside here. That's why we are a bit cautious and kind of hoping for a better entry point if we do get a bit of a step back in the markets.
Now, we've kept continuously mentioning valuation, so I want to kind of circle back to that because it makes me think, of course, about the tech sector. I'm wondering how you're approaching that sector in 2021. There's a little bit of a difference in that sector. We have the big tech names like Zoom, like Facebook, like Amazon, but then you have other pieces of the tech sector which folks are saying you need to pay attention to them, especially when it comes to cloud computing, for example, that will perform well this year. So how are you approaching, and how do you think investors should really approach that sector this year?
Well, you mentioned the mega caps, and when you think about what that does when you look at multiples for an index or even for the sector, because of the size of these companies, which is so dominant relative to the other ones in the index, really it's those PEs that give you the impression that the PEs are high for the whole market. So what you do need to do is go to the individual stocks. And if you look at the dispersion of valuations at a stock level, and if you look instead at, say, the median PE within the index, then you actually find numbers that are much more reasonable. If you look, say, at what you have within the 25th percentile of the dispersion of PEs, there's still plenty of attractive stocks there. So for our portfolio managers that are, again, picking the stocks, it's not necessarily so difficult to find opportunities, to find attractive stocks, probably not at cheap valuations, but certainly something that they feel warrants an investment given the growth prospects that they see. So I think, really not only in general do you need to look at the stock level as opposed to the index, but even more so with tech and the dominance of the mega caps that I think really distorts the valuation impression that you can get.
All right, Daniel Morris from BNP Paribas Asset Management, thank you so much for your insights today. And coming up, we will be chatting about the ongoing coronavirus pandemic. Welcome back to Yahoo Finance Live. Let's talk about the ongoing COVID-19 pandemic. Concerns continue to grow over the coronavirus mutations, which might reduce the effectiveness of the coronavirus vaccine. We're joined now by Dr. Uchi Blackstock, CEO of Advancing Health Equity and Yahoo News medical contributor. Doctor, great to see you. It's been a little bit of a time since we last talked. So as I was mentioning, those mutations and those strains, and it seemed as at first everyone was saying, listen, don't worry, this happens to viruses all the time, which is true. We know that viruses do mutate, but I feel as if the news around these mutations has been getting more and more alarming as the days and the weeks go on. So I guess the question I want to ask you here, how concerned should we be about these viruses, these mutations and these new strains?
Well, first, thank you so much for having me. And I agree. I think that as we've been learning more about these variants and we've seen them spread to a further extent, it definitely the situation seems a little bit more grim. But what I would say, just to put everything in context, that this means that we really have to double down on our public health measures. That we're at this point where we don't have enough vaccine supply, and then the variants are on the horizon. And by March, the 117 variant is supposed to be the predominant type. And so we're in this really difficult place right now, but then we have cases going down. And so what I would say to people is, yes, we should be humbled by these variants, but know that public health measures prevent their spread, and that we have to really get organized on creating that robust vaccine delivery infrastructure so we can get shots into as many arms as possible. But I will say that the next 1 to 2 months are going to be pretty difficult and challenging months for us.
How would you more broadly describe the pandemic right now? Because it seems a little bit like hypocrisy. I shouldn't say hypocrisy, but it seems a little bit strange, right? That we continue to hear that these mutations are out there, that they might be more contagious. But as you mentioned, we do have the case counts coming down, the hospitalizations coming down. So I guess, which is it? Where are we right now in this pandemic? Right. Are we rounding this corner or are we not?
I think that we could be rounding the corner. And the fact is that what we've seen is many of the restrictions put in place by states, they actually work. So these mask mandates, restricting large gatherings, restricting indoor dining, it actually prevents the spread of the virus. And that's why we're seeing these reductions in cases, hospitalizations, and even deaths somewhat as well. But I think, again, we need to be humbled by these variants because all of this hard work that we've done not only could go to the roadside, but we also know that many states, such as my own here in New York State, we're starting to reopen a little bit more. We're starting indoor dining here in New York State again this weekend. And so my concern is that states are going to reopen too quickly, and we're going to see that case count go back up again just in time for the variants to be the predominant strain around.
So speaking about that, I'm also here in New York, and Governor Cuomo saying, obviously not are we only going to allow indoor dining to happen again. They're thinking about reopening arenas, which I personally, I don't know if I want to be in an arena with thousands of other people. Are calls like that bad ones to make? Do you think that we are not quite there yet to be making those measures?
I would say that we should halt on any big decisions in reopening until there is not only enough vaccine supply, but that we have a critical mass of New Yorkers, Americans being vaccinated. This idea of opening up stadiums or indoor arenas, which really are probably the most dangerous places because we have people yelling, shouting, screaming, sitting closely together and indoors. We don't know what the ventilation status is. It could actually be potentially very dangerous. So again, I think that this reopening is happening too soon, especially given the fact that we don't have enough vaccines and we have the variants on the way.
I have about a minute left with you here, Doctor. I want to ask you about a move that Massachusetts is taking, which is that if you accompany an elderly person to their vaccination, that you yourself can also receive the vaccine. I'm wondering if that's a move If you have someone, for example, who's immunocompromised in your house, if they're eligible for a vaccine, if we should start maybe perhaps vaccinating entire households?
I think that it actually is, a decent idea. I think that it will help encourage more elderly people who may be shut in to come in for their vaccinations, especially to have someone who is either a loved one or well known to them. So I think we could actually see more elderly being vaccinated, and it's very likely that they'll have other people who are higher risk or in some of the other priority groups, and they'll be allowed to be vaccinated as well. So I don't think this is a bad idea, and I think it'll help encourage us to help get more elderly people out there, because we know accessibility is definitely an issue.
All right, Dr. Uchi Blackstock, CEO of Advancing Health Equity and Yahoo News medical contributor, thank you so much for giving us your insights as always.
Thank you.
Coming up, we are going to be bringing you our Black in Business segment. Welcome back to Yahoo Finance Live. We want to bring you our segment now about Black owners in business. Today, we're going to be featuring Jazz Jackson. She's the CEO and founder of J Sculpt Fitness. And she's tapped into a market of women wanting to get fit, but also maintain their curves. Let's watch.
Everything that I learned about J Sculpt and running a business was done on the ground floor. I do not have a background in entrepreneurship. I do not have a background in business. The cool thing about learning as you go, you make these huge mistakes, but it prepares you for what's to come. I always have to make sure that I'm okay with being a student, even though I'm the CEO. Hey Yahoo family, my name is Jazz Jackson. I am the founder and creator of J Sculpt Fitness. J Sculpt Fitness is a fitness apparel line. We were introduced back in 2017. What we launched was called the J Sculpt Fitness Belt. It looks similar to that of what the industry calls a waist trainer. As a Black woman, we love to keep our curves and keep our figures. Same thing for Latina women. I wanted to provide something that spoke to that, but was still safe to wear. The outline of J Sculpt was to give you the silhouette of a waist trainer, but to provide you the flexibility of just a regular sweat fitness belt. Prior to launching my company, I was diagnosed in 2012 with depression. I went through many different ups and downs with the type of medications that I would take. My doctor did tell me that a way for me to combat my depression was to go through a holistic approach. And so what I decided to do was to work out. I completely changed my diet. And while I was at the gym, I was wearing many different belts. I wanted to introduce something new to the market that worked for women like me who were more curvy. That's how J-Sculpt was launched. When I first started with J-Sculpt and just my own fitness journey in general, I was a gym rat. I did not wake up and lose 50 pounds, by doing some fad diet. It took me well over a year. I started off as an influencer, and so I would review many products. And so just based upon my own experiences and then the experiences of my audience and saying what they wanted and needed within a new belt, I just implemented what they were asking for. Since then, we have amassed close to 300,000 followers on Instagram, and we really have like a tight-knit community of like-minded women who want to learn and grow within the health world or health industry. And we are a true community of what we love to call our J-Sculpt babes. I am very fortunate to say that we do not have any financial backing. We are a Black-owned business. I am a Black woman, my entire staff, an African-American team. And so we just use the resources that we have. We were very fortunate during the pandemic. People wanted to work out. And I'm very proud to say that in the month of April, for the very first time, we had over $1 million in sales, but we were not prepared for the influx of orders. I decided to make sure that we were always fully in stock. I'd rather have a ton of inventory on hand than not, and not give my customers the experience that they deserve. I am really excited. 2021, we will be launching apparel. We have a size range from extra small to 4X. And we are just speaking to, the everyday woman, the woman that loves to wear athleisure. I'm really looking forward to launching and showing what we've been working on. When I decided to battle my depression, that wasn't for me. That was for other women to make change within themselves. I could not have asked for a better role.
And we're joined now by Jazz Jackson, J-Sculpt Fitness CEO and owner for our Business in Black segment. Jazz, thanks so much for joining us today. So, you say in that video that you didn't take entrepreneurship courses. You don't have a background in business or in finance. You just essentially had an idea and a dream. So where did you start? How did you begin?
Well, first of all, thank you so much for having me. I really got my start on YouTube, and I learned a lot from the perspective of an influencer, learning about what companies would look for in influencers when seeking to sell a product, and learning the behind the scenes of what it would take to sell a product via those means. And also, I had like some background in sales, just, regular customer service and things of that sort. And so I took those tools that I learned throughout the years and used it to launch my own brand.
What were some of the biggest challenges that you faced?
There were many, many challenges. I mean, I think probably the most significant challenge was just the complete learning curve of running a business. There's a saying that the customer receives the actual customer service after the sale. And so it's not just to provide a product, but to give the customer something that will keep them coming back. That was one of my greatest learning curves of providing them stellar customer service, making sure that we had the best shipping options to our customers, and to provide them after service if they had follow-up questions and things of that sort.
Jazz, during Black History Month, and also, frankly, at every other point of the year, I talk a lot with a lot of Black business owners, and we talk often about the struggles and the hurdles, to be a Black entrepreneur or a Black CEO. But really what struck me about your story, and I would love for you to comment on, is how you being Black was an asset and really helped you tap into a market that I don't think a lot of other people were paying attention to. So let's turn this on its head and let's stop talking about how many struggles we face as Black women. I would love to know how you found being a Black woman actually a point of empowerment for you as you went forward in business.
Well, I'll say that, I mean, we are doing such a phenomenal job as a culture, as a Black woman. There's so many of us that's taking this opportunity to become entrepreneurs via e-commerce. And so just like myself, taking the opportunity and seeing that I had a built-in audience through my social media platforms, and using a product to our culture, we love to keep our curves. And I don't think that should be shied away from. And so instead of shying away from that, I just decided to lean into it, and my life hasn't been the same since.
What piece of advice, would you give to other Black women founders that are watching this, that hope to start or launch their own business?
To have the courage to start the business. I know that in any place that you would decide to work inside of, the market is said to be oversaturated, but there's always room for you. I would just encourage every woman, be it a African American woman or not, to just have the courage to do so. And if it doesn't work out, you can dust yourself off and try again.
Another thing that I noticed as a part of that video was you talking about, how you came into this first as an influencer. And I'm curious to know, given that background and kind of what we see in terms of like the pictures that we're bombarded with, the kind of women that we're being told are especially beautiful, I'm wondering where you think the next big thing is going to be, at least when it comes to the fitness clothing industry.
Well, I think that we're right in the middle of it. Athleisure is just everything. I mean, I cannot go anywhere without seeing a woman in leggings. I remember that there was a time where wearing leggings without a long blouse or shirt was just so faux pas. But there are complete companies that's built on the athleisure model. So that's what we'll continue to see. I think we'll continue to see new variations of sweat belts as well. But we'll also continue to see at-home workout activities, because that is what we're doing right now dealing with COVID.
Yeah, I'm really grateful that that fashion rule changed, because especially in COVID, I'm in leggings now. I live in leggings all day, every day. So I'm glad it's actually finally viewed as a real piece of clothing that I can wear. Jazz Jackson, J-Sculpt Fitness CEO and owner, thank you so much for joining us today.
Thank you for having me.
Coming up, we'll be hearing from restaurant brand CEO Jose Sill. That's next. Welcome back to Yahoo Finance Live. Our editor-at-large, Brian Sozzi, spoke with Restaurant Brand International CEO Jose Sill after their fourth quarter earnings. Let's take a listen.
We saw sequential improvement in the fourth quarter versus Q3 and Q2 before, which were kind of the height of the pandemic. We were excited and encouraged by progress that we made with each of our brands in our home markets, as well as our international business. On the home market front with Tim Hortons, we saw some of our best performance since the onset of the pandemic, especially in our drive-through business in December. We've made a lot of investments in that business around the quality of our coffee with fresh brewers. We've made investments on the quality of our core offerings at breakfast. We launched fresh cracked eggs and a new dark roast blend, all of which is aimed at addressing what the consumer in Canada is asking for, which is, hey, we want Tim's to do what it's been famous for decades, which be great at the basics. And so we've been making investments with our owners in Canada, and we're beginning to see some progress on guest satisfaction. We're seeing progress in certain day parts from a market share standpoint. We have a long way to go, and obviously the restrictions in the market have an impact on our performance. But we feel confident and encouraged about the long-term prospects of our business in Canada. And the same goes for Burger King and Popeyes in the US. We had some positive performance and improvements in our core offering. Lunch day part in particular was really strong. And we have exciting news and exciting initiatives that we have for the business for both Burger King and Popeyes, especially in the digital side for 2021, which we think will have a big impact long-term.
Jose, when do you think Popeyes and Burger King US, when will they get back to same-store sales growth this year?
Yeah, so with Popeyes, we, quarter four 2019 was when we launched the now famous chicken sandwich. We elevated the game as it relates to chicken sandwiches, and we drove a 38% same-store sales lift in Q4. So the performance in Q4 2020 was really just a function of lapping over an incredible Q4 2019. The nominal sales continue to be very healthy. We've reached 1.8 million in average restaurant sales for Popeyes in the US over the last 12-15 months, which is an incredible amount of growth from 1.4 before the launch of the chicken sandwich. Our four-wall restaurant profitability has reached record levels at Popeyes. So the momentum continues. We had an incredible run with Popeyes, and we think we're going to have continued growth in 2021. We just launched we elevated the game on chicken sandwich, and now we've launched a fish sandwich that we think will be a game changer in the quick service restaurant space. It's a flounder it's a fish sandwich with a Cajun twist, a Cajun flounder, and we think it'll be an incredible limited time offer for the business as it takes hold now during the Lent season. And with Burger King, we made some important improvements and kind of long-term investments in the business around value, around our core offering, the Whopper. We launched the 100% real Whopper. We continue to invest in digital. We've now started to test our loyalty program for the Burger King brand here in the US, and we think the combination of all these investments and initiatives we'll see some really good growth in 2021 and beyond.
Yeah, Jose, I think our Miles Ellen is good for 3 of those Cajun flounder sandwiches for breakfast. But I do want to go back on the chicken. We've seen a lot of fast food players really come out with a lot of new chicken offerings, new chicken tenders. Hardee's, Carl's Jr. come out with these giant chicken tenders. You have had a special promotion on chicken tenders. How concerned are you about maintaining your position with Popeyes in that chicken sandwich?
Look, it's not a surprise. The chicken protein has been a big part of growth in the chicken QSR space, but really for others in the QSR space. So we're not surprised, and we welcome, all competitors to go out there. But more importantly, we welcome our guests and new guests to come out and try the Popeyes chicken sandwich, and they can choose for themselves which is the one that they want to go to. We have an incredible everyday value proposition with that chicken sandwich at $3.99 a la carte. So we feel confident with the Popeyes chicken sandwich that it'll continue to be kind of the standard bearer, if you will, for chicken sandwiches in the space. And we think there's opportunities with Burger King to continue to invest in and expand its chicken offering as well, and be part of what's a growing category in the quick service restaurant space. We also think, as it relates to Popeyes, a big opportunity in handheld chicken. with nuggets, tenders, continuing to grow that part of the business, which is one of the fastest growing parts of the chicken QSR space, handheld chicken beyond the bone-in, which we already do quite well with.
Jose, it's Julie here. I want to ask you about input costs, specifically labor costs. As you know, there's been a debate in the U.S. Congress about raising the federal minimum wage. It doesn't seem like it's going to be in this stimulus bill, or if it is, perhaps not as high as some Democrats would have it. There's been a lot of academic papers on the effect of higher minimum wages. I'm sure that you all have studied it. What would the effect be on your business of a $15 minimum wage?
Hey, Julie, and thanks for the question. Look, we've been seeing increases in minimum wage across the country in many markets and many states. Just recently, Florida voted it in a staged approach over the next several years to get to $15. So it's not new. I think the new idea here is that there may be federal oversight on that, and that that might bring a little more consistency to the discussion and to the topic. We've been working on it for a long time. We're in several states already. Probably, I think it's north of 20 states today that have minimum wage statutes that are staging their way to $15. Our business has been accustomed to dealing with labor inflation and commodity inflation for decades. It's part of the business. The focus we have is to continue to work with our owners and our franchisees to ensure that they have really good teams, that we have productivity tools that help them be more efficient with their labor in the drive-thrus. We've introduced the mobile apps, pre-order mobile order and pay, which has helped from a labor standpoint as well. We continue to be more efficient in the drive-thrus and in service modes, which helps productivity and throughput, all of which help drive the top line and help ensure a balanced flow through to the bottom line. So we'll continue to work with our teams on that and keep working on tools to help ensure that we continue to serve great food and do so efficiently and productively, so that our franchise owners can continue to make a profitable living with the business that they have.
Jose, I liked your annual letter that you wrote this morning, also out with your earnings release. I actually tweeted part of it, but what's the biggest challenge your leadership team has on its plate this year?
Look, I think we've made, Brian, some incredible advances in 2020 in the face of unprecedented challenges. Our team has come together incredibly well. I think we're collaborating better. Any walls that might have existed beforehand, I think everyone's putting everything aside and working more closely together and more focused on priorities that we think are critical for the long-term health and growth of our business. My focus and my prioritization is around ensuring we have great teams. We keep investing in our tech teams. We're investing in our marketing teams. We're investing in our operations teams, our development teams. We continue to invest in the business on the people front as well as on the technology front, because we think it's critical for the long-term health of the business. So I'm focused on teams, and I'm focused on engagement. I'm focused on our franchisees, ensuring that they have the tools and they have the clear vision of where we're going, so that they can focus on the guest, which is ultimately the most important aspect of our business. So people, investment in those areas, as well as focusing on engagement and keeping everyone energized. That's my focus. That's what keeps me up at night. And I'm excited because we've got great brands, great opportunities in front of us, and we're excited about heading into 2021 with aspirations for growth for the long term. So looking forward to keeping you updated on our progress, and we're excited about what's to come.
And that was Restaurant Brands International CEO Jose Cil, again, talking about that disappointing earnings that they did have for the fourth quarter. Looking over at Restaurant Brands, that stock right now is in the red, down about 2 7/10 percentage point. Now, that full interview is available on yahoofinance.com. And coming up, we will be talking with one restaurant owner about the difficulties of operating during the pandemic. That's next. Welcome back to Yahoo Finance Live. Let's talk now about what it's like to operate a restaurant during the pandemic. Let's bring on George Gates, COO of Gates Barbecue, and Yahoo Finance's Reggie Wade to chat about being a Black restaurant owner during this pandemic. So, George, your company has been around for 75 years, and I'm sure that the company has seen rough times before in that long history. How would you classify this pandemic, given that context of that long history that you guys have?
Are you trying to measure from 1 to 10, or how is this going to be measured?
Can you even put it on a scale of 1 to 10? Where would it be on that scale?
Well, this pandemic is a little different than the other challenges we had in the past. But again, we have 3 basic things that we stay with, and that's the product, the service, and the facility. And with restaurants, if you have those 3 basics in place, you normally can just outrun the rest of the challenges you have. But we have had challenges.
George, Reggie Wade here. I could see over your shoulder that the community looks like it's supporting Gates. What has it meant during this pandemic for the community to come out to support you?
Oh man, it's been wonderful. The community, the city itself has been great. There's been a lot of excitement in Kansas City just because of the Kansas City Chiefs, which brings people out. And when people are out, they feel better. When they feel better, they buy more. And so we've been recipients of those things that happen throughout the city. The community itself, for the last 75 years, has been supporting us through the good times, the bad times, the fat times, and the lean times. As you see behind me, we have people here now, and it's 25 degrees, and we have people out eating lunch, and we appreciate that, and we're thankful for that.
George, a number of restaurants have applied for PPP loans. Has Gates applied for any of these loans or any other state or local assistance during this time?
We have applied for help and assistance just to get over the rough times.
And what was that process like? Was it an arduous process? Was it quick and easy?
It wasn't as difficult as a lot of processes have been in the past. We have good people working with us in the financial field and with our banks and our lenders and our accountants. So with all those people in line to help us, it was pretty simple for us to mull our way through that mess.
You know, George, we've been talking a lot to a lot of Black business owners and, throughout this Black History Month. And, even here at Yahoo Finance, we like to talk about this throughout the year, highlighting sometimes some of the hurdles and the difficulties that face Black business owners in particular. And as I was telling our last business owner a little bit earlier in the show, I would like to change that narrative and not talk so much about the struggles, although we do know that they exist. But I would love to know how you view being a Black man really an asset as you've built Gates into the company that it is now, 5 locations around the Kansas City area.
Yes, and you have to realize it's been 75 years. I'm the 3rd generation. I have nieces and nephews and daughters and sons that are in the business. That's the 4th generation. I have a grandson who's working in the business now. That's the 5th generation. So we've been doing this struggle for a long time, and it has been good to us. We have been able to eat every day, pay our bills. So we're happy about those things that happen from being in this business. But working in the community and being a part of the community, I think is a great advantage. People tend to, when they say barbecue in Kansas City, normally they say, I'm going to Gates. And we know that's barbecue. And so those things over 75 years of hard work and community involvement and just came to be what it is. And it's a struggle. Yes, it is. It's a struggle for everybody. But I think because of the fact that we've been stable in the community for so long and been steady, that people tend to gravitate to us because they know we're going to be here.
George, I have to ask, what's on the menu today? I was looking a little bit online, and it all looks so good. So what we got today?
You know, our menu is pretty set. We have a set menu. We're a specialty house. We barbecue everything. But we barbecue lamb, we barbecue chicken, we barbecue beef. Whatever meat there is, we barbecue it. We don't cook it, we don't smoke it, we barbecue it. And that's what we do. So today we have the same menu that we have almost every day. In the 5 locations, we have different items that may be special to that store. In the downtown area, we have a location, 12th and Brooklyn. We have chili, we have a Georgie burger. It's not named after me. It's named after my grandfather, who passed away in 1960. He was the first generation. He's the one that initiated all this. But we have Georgie burger. We have other specialty items. But on the menu, our signature item is our pork spare rib, natural drop. It's hard to find those anywhere because most people use the baby back or the St. Louis cut. We give a natural drop pork spare rib.
Thanks a lot for that question, Reggie, because now I'm hungry. George has been talking through the menu, and now I want to eat. I'm hungry. Right. And now listening to that, I want to go get some barbecue. I've had some in St. Louis, and I was told at the time that I needed to go to Kansas City if I wanted to get some good Missouri barbecue. So next time I'm in Kansas City, I'll definitely have to drop by. George Gates, COO of Gates Barbecue, Yahoo Finance's Reggie Wade. Thank you both for joining us for this conversation.
Well, thank you
coming
very much.
up, markets right now are a bit of a mixed bag. The NASDAQ has flipped into the green, up about 0.2 percentage point. We'll be bringing you our final market check next. Welcome back to Yahoo Finance Live. One last look at our markets right now. The NASDAQ, the only major index right now in the green, up over 0.1 percentage point. The Dow down over 100 points, however, pairing some of its losses from earlier in today's trading session. Taking a look over on a sector basis right now, we have tech, the only sector right now in the green, up about 0.75 percentage point. I want to take a look over at a stock that we have been talking about a lot today, and that is Bumble. Bumble did go public today. It was originally priced at $43 a share. Now, that was a bump from its expected range of $37 to $39 a share. It it did open at $76 a share. So while we are seeing a nice pop there, it has come back a little bit slightly from where it opened, sitting at just over $74 a share. Now, it raised more than $2 billion in its IPO, with a valuation of up over $8 billion. So we'll be continuing to monitor Bumble on its first day of trading throughout our coverage here on Yahoo Finance. Now, I'll be staying with you throughout the next hour, and I will be chatting with Trivago CEO Axel Heffer next. Welcome into the 2 p.m. hour here on Yahoo Finance Live. Alexis Christoforous is out today. Taking a look at the market action right now, we have the S&P 500 and the Dow both in the red. The Dow down about 130 points right now. Still, however, paring some of its losses. It had seen record intraday highs earlier in today's trading session. The Nasdaq right now, the only major index in the green, up about 0.1 percentage point. On a sector basis, tech is the only sector right now in the green, up about 0.7 percentage point. Investors digesting news on jobless claims. So let's take a look at those. They came in at 793,000 for the week ending February 6th. That is compared to the 760,000 that was expected. So worse than analysts had been anticipating. However, they did fall from the prior week, which had been upwardly revised to 812,000. Taking a look over at the continuing claims for the week ending January 30th, we came in at 4.545 million compared to the 4.420 million that had been expected. I want to take a look over at some stocks right now. Let's start with Bumble. We have been keeping an eye on them after they went public today. Originally priced at $43 a share. They opened at $76 a share, as you can see there. A nice pop for Bumble from its IPO price, up about 73% right now. However, it has come down a little bit from where it opened at 76. Want to take a look over at some cannabis stocks. Those stocks are in the red, reversing a rally that we saw, especially as Reddit traders piled into those stocks. Tilray right now getting walloped amongst them all, down over 41% right now. Canopy also in the red, although they did say that they were optimistic about continued revenue growth over the next 2 years. Want to take a look over at Kraft Heinz. Kraft Heinz in the green right now, a nice pop there, up about just about under 5.5%. Now, they did beat on both top and bottom lines for the fourth quarter, and the company has also announced that it's going to be selling its nuts business to Hormel Foods for more than $3 billion in cash. We will be chatting that a little bit later in today's show. Now, I want to bring on Yahoo Finance's Jared Blickery for some tickers that he has been watching today. So, Jared, let's start with Uber. They did report a decline in fourth quarter revenue.
Yeah, it was a decline, but I would say the overall mix of their business is really interesting as delivery has just taken off as you would expect with the pandemic, but also ride sharing remains profitable, at least on an adjusted basis. Going forward, I don't know that the unit economics for delivery are working out just yet, but that's where the action is. So let's get to some analyst commentary here. And by the way, you can see the stock is off about 3% today. Over the last 5 days, it is still holding on to gains of nearly 6%. But here's what Citi is saying. They said the results were, quote, solid overall with some put takes, but nothing unexpected. Near-term visibility is not ideal, although Uber will return stronger due to cost cuts, shifts away from public transportation, food delivery business, and electric vehicle deployment. And also saying that the results, this is Wedbush here, Dan Ives, friend of the program, says the results were a step in the right direction as EBITDA and gross bookings beat expectations. So again, stock is down today by about 3%, but maybe the company has turned the corner on a longer term basis, looking up for ride sharing here.
Now, Jared, of course, when I opened the show, I did mention those cannabis stocks, which had been of interest to a lot of those Reddit traders, which brings us to the second stock that you are looking at, which is GameStop, because those Reddit-based traders loved GameStop, although GameStop right now not doing too well, down about 5.5%.
Yeah, you look at the volatility on this, and it's just been incredible, as we know, but it's tamped down quite a bit. There's your 3-month chart. Here's that huge blip. And now we have the CFTC and the SEC and the DOJ probing the retail traders here. So we know that we're going to have hearings on the 18th, and we just got some breaking news that representatives from Citadel are going to be there along with Reddit. So they have agreed to testify at that House hearing. But news of the day, really just that the Justice Department is looking into this, CFTC probing the silver trades. And I got to say, that was never really part of the Reddit phenomenon that I could determine at the time. There was a little bit of chatter about silver, but if you want to know who the biggest manipulators of the silver market are, you just need to go back to September of last year, where JP Morgan paid $930 million in $920 million, largest amount of monetary relief ever imposed by the CFTC for metals market and treasury futures manipulation.
And next up, I know that you're tracking Yahoo Finance Premium's investment idea of the day, which is a buy call on Pfizer. So what's behind that bullish outlook?
Well, let's take a look. This comes by way of Argus Research. This is a fundamental report on Pfizer. And you can see there the stock really hasn't done much over the last year. It's down about 5%. But let's take a look at some of their reasoning here. So they're saying they're maintaining their $55 price target with the reasoning that Pfizer is scaling up manufacturing to meet its commitment to deliver 2 billion doses of its coronavirus vaccine by the end of the year. Management projects approximately $15 billion in 2021 revenue from the vaccine, making it by far the largest product in their portfolio. However, we think the market is underestimating the sustainability of the COVID-19 vaccine franchise and its revenue contribution beyond 2021. We believe that this revenue will prove sustainable based on the company's ability to use the mRNA platform to develop vaccine booster shots and address new virus variants, as well as to create treatments for other conditions. So there you have it there, Kristen.
And I'm excited about this next one, which is Bitcoin, because we saw Bitcoin really at record highs. It's up over 47,000 right now for one Bitcoin. A lot of interesting news going on there.
There is a ton of news in the space today. First of all, let's take a look at the chart, because Bitcoin is at a record high. Over the past 3 months, up 203%. So the price has tripled, heading very close, inching very close to that $50,000 mark. So get your hats ready there. But that's not all that's happening in the space. If you take a look at some of the crypto stocks, the derivative plays, lots of green there, and not the least of which is PayPal, which is up 2% today. In fact, PayPal is having an investor day, and And we just got some news from the head of their Venmo unit that they're going to expand, they're going to add crypto to Venmo while in the first half of the year. They're also going to expand their crypto offerings to the UK in the coming months. And this also comes the same day as we got some news this morning that the oldest bank in the United States, Bank of New York Mellon, they are a custody bank. They are going to be working digital assets into their entire platform. The first big company to do this, and I think it really speaks volumes about the crypto space. And then finally, MasterCard liking those stable coins, not Bitcoin yet, but it is a step in that direction, Kristen.
All right. Thanks so much, Yahoo Finance's Jared Blickery, again, with giving us the lowdown on all four of those tickers. I want to keep this market conversation going with Michelle Schneider, MarketGauge.com partner and director of trading research and education. I'm so excited to chat with you, Michelle. It has been such a long time. A lot to get to today. I do want to start on Bumble's IPO. It is essentially having a nice pop here, up almost 70% from that original price offering of $43 a share. Now, I saw a lot of folks saying that they were overvalued. Their CEO, of course, saying that, quote, love is profitable. I'm wondering what your thoughts are.
Well, we do have Valentine's Day coming up. I'm not surprised to see the outperformance here based on what the valuation was coming into the first day. It's a really great idea. And obviously, it's been a trend with Tinder, I think, is the one that started a woman-driven dating app. So it's really part of the whole generation of women coming to play. So I think that's great. In terms of the actual stock, I look at it like all IPOs, really, is that you might see a really great first day, but I like to look at some historical information. So I can't really make much of a judgment. We have a range for today. As you mentioned, it's about, I think 73 or so was the low, and it went up over 76 or maybe 79 was the high. So now that gives us a range to look at for tomorrow. And then we can have a further idea of what to do with that. But the IPOs and the SPACs have been all the rage for this whole year so far. So it's right in line with that, with a pretty good premise fundamentally.
And even beyond that, I feel like there's been a huge, speculative frenzy in the markets lately. We heard Jared just talking about Bitcoin, and we also heard him talking about GameStop. I mentioned at the top of the show, the cannabis stocks. I'm wondering, as we saw, especially throughout 2020, a lot of these companies running up well past their valuations. I'm wondering if you think that's going to continue in 2021. What are you anticipating? Because a lot of folks are talking about this bubble that they see forming right now this year.
People love to use the word bubble, and there's always bubbles all around us. I mean, really, we're always like one watershed event away from a potential bubble. Of course, last year was the pandemic. This year, what is it? So that's really what I'm thinking about. Fundamentally, what would create a bubble? Could it be no more stimulus? Well, possible, but that doesn't really seem to be happening right now. And are we talking general market or Bitcoin? Because there are two different types of bubbles here. But in terms of the general market, we are looking like we're coming back from the pandemic. Businesses are opening. I know here in my own town, we are finally went from red to yellow, so we're allowed to go indoor dining this weekend. We have vaccine rollouts coming out. The oil market is certainly showing some hope for more recovery and people going out again. So I don't see the bubble unless there's something coming from what we don't know about at this point. And then in terms of Bitcoin, same thing. I don't see where there's a bubble when each day, like Jared pointed out, you have more institutional interest. Like today, for example, on top of the MasterCard, we have the BNY Mellon, which is trying to create a secure infrastructure using a digital asset unit based on cryptocurrency. So this is legitimizing the whole space as far as I'm concerned.
I'm wondering how you think market performance is going to be this year, and if there's any sectors that are of particular interest to you in 2021.
Well, you and Jared talked about cannabis, and I'm definitely all about the cannabis stocks. We've been long for much lower levels. And yeah, I'm not surprised to see the GME curse with the hearings that Jared talked about coming up. Yeah, I mean, that's what happened to Tilray, right? It got way over bloated based on the speculation of the retail investors. And now they're all liquidating ahead of the hearings that are going on. Excuse me. But overall, I still think that we are going to have a much more friendly environment legislatively from the federal government in cannabis. Look at Tilray. You've got France, Portugal, and now the UK looking into medical marijuana. So we're branching out globally. So that's one sector I like. I still like the whole idea of EVs. They may have gotten rich, but I'm also really more interested now in the electricity distribution part of the EVs, because Tesla, Musk had said that the electricity demand is going to double, and I think he's absolutely right. So we're looking at some of the lithium battery companies as well. One that's been totally beat up and undervalued because of legal issues has been QS, QuantumScape. So that's one we have a little skin in the game. And then generally, I'm looking at manufacturing, industrial, and hopefully the recreational side of life to come back as potential opportunities. Some of the other stuff we're already in. And
now,
there's one
Michelle,
more.
Oh, what's the other one?
Yeah, this to me is the hottest thing to be looking at right now, and that's agricultural tech. Ag tech. That's really where I have our eyes right now. So we're already in App Harvest, and I know he was a guest actually on your show last week, the guy who's the CEO. I think that's really future thinking. And then also Origin, which is a Chinese company, the symbol is seed. These, I don't have skin in that game yet, but we have put our clients in App Harvest and it's gone up. So I think that you got to look at the future in terms of what's the new technologies that are going to help people live better and cheaper, because everything has gone skyrocketing, obviously, through the pandemic.
All right, absolutely. Some great insights from Michelle Schneider, as always, MarketGauge.com partner and director of trading research and education. I'm going to have to try to hop in here and do the 2 p.m. more often so that you and I can chat. Thanks so much for joining us.
Thank you.
And coming up, we will be talking to the CEO of the travel company Trivago. Welcome back to Yahoo Finance Live. So what is the future of travel this year? Well, it's looking up, according to our next guest. We're joined now by Axel Heffer, CEO of the travel company Trivago. So Axel, in your earnings report, Trivago wrote, quote, "We are optimistic that by the second half of 2021, there will be a strong recovery in travel activities with an initial focus of users on nature destinations, which we have already observed in the summer of 2020. So I want to dive into that a little bit. Why are you so optimistic about the second half of the year, despite the fact that at least when we look at it globally, vaccine rollout is still going slowly.
Yeah, I mean, there are basically two reasons. I mean, the first reason is that no matter who you talk to and no matter which research you look at, there is a huge desire to travel right now. Obviously, a lot of us have been for months and some even for a year in very restricted situations and lockdown situations, and traveling, connecting with friends and family is on top of almost everybody's list. So there will be a lot of demand on the ability to travel. You have two factors. One is that you have the warmer weather kicking in the northern hemisphere that has helped actually last summer, but then more importantly, you've got the vaccination rollout, and there the infrastructure seems to work. So Israel, UK, and also the US, to a lesser extent, have shown that it is possible to vaccinate a lot of people, and it's basically held back by the availability of vaccines, which will ramp up now basically every month. So by the second half of the year, we are confident that there will be the ability to get a vaccination for the vast majority of people in the northern hemisphere, and that will lead to return of travel.
Now, for anyone that doesn't know, Trivago helps essentially users search for and compare prices for hotels and lodging. And I'm curious to know, as you guys are seeing it, when travel does start to pick up again, is it going to be international or will it be more domestic?
Yeah, I mean, the best data point that we do have is the behavior that we've seen in 2020. So when the travel restrictions were eased in summer, we've seen in almost all the markets a very strong demands for local travel, and local was predominantly domestic or neighboring countries. So US, Mexico, or in Europe for Germany, for example, Netherlands and Austria. And there, the destinations that were more classical summer family vacations, so the beach or the mountains, were extremely popular, whereas city destinations that you would think of more like a culture trip or a trip to experience the cities were not really popular.
What kind of travel do you think a lot of folks will be taking? I mean, domestically here in the United States, a lot of folks have been using their cars. Cruise lines were doing really well until the pandemic hit. Do you think that folks will want to go back to that, especially since the cruise lines is really where we started to see those breakouts of the pandemic first?
Yeah, I mean, for sure, travel where you can control the transportation will be the very first to recover. Again, we've seen it last year. So where you can control and drive to the destination, and even more importantly, if anything is changing, quarantine requirements are changing on a short notice, a new variant is breaking out, you can actually return home. So that is the safest trip that travelers have on their mind. But then flight connections into safe destinations will be second. Cruises are not a business that we are into, to be honest. So I'm a bit skeptical that cruises will return at significant scale, as will as intercontinental travel will also struggle in 2021. But yeah, it all depends on how certain travelers will feel and how stable the situation will be, both in the country of origin of the traveler and the destination.
What are some of the biggest changes, that you're anticipating for the entire travel industry? We hear, some folks talking about requirement of vaccines or, almost like a vaccine passport in order to get on a plane. Do you see that coming down the pike?
It's a political decision whether you will allow for these kind of rules. My personal opinion is that you should allow travel when it is safe, and to have a vaccine, have vaccinated people traveling perhaps without testing could make sense, but to allow exclusively vaccinated people could lead to quite some problems if there is a certain sequence of receiving a vaccination. So you would basically give preference to a certain part of the population that might not be politically wanted. But generally speaking, by the second half of the year, I think that most people will have had the opportunity to get vaccination.
I'm curious to know how you see things changing, at least when it comes to some of the search engines. We talk a lot about how companies like Google are, at least here in the United States, going to be facing some regulatory headwinds, especially over these antitrust and these monopoly allegations. I'm wondering how you see that impacting Trivago going forward, especially as a search engine like Google is huge in the travel industry and business as folks search for hotels and flights.
It is, and the way we are thinking about it, that is more a gradual change in sentiment, which has started really a few years ago, but you can see that by now, most of the governments around the globe do see that there is an issue with monopolies in the digital world, and with a lack of competition in certain products and certain verticals. And you just had a new antitrust law being passed in Germany. The European Commission is also looking into the issue. And in the US, as you mentioned, there is also a wide discussion about it. So it is more a gradual process that it is seen more as a problem. And politicians around the world will need to decide how to deal with these issues. And we as a business have obviously to operate in the environment that politicians set, as we've done in the past. And right now, we are in heavy competition with Google, in particular, in the hotel vertical. And until there is a change in regulation, that dynamic will stay the same.
All right, CEO of Trivago, Axel Heffer, thank you so much for joining us today. And coming up, Playboy is going public again. We're going to be hearing from their CEO next. Welcome back to Yahoo Finance Live. Yahoo Finance's editor-at-large, Brian Sozzi, spoke with Playboy CEO Ben Cohen about their decision to go public again. Take a listen.
The capital that we raised, over $100 million, provides over $100 million of unrestricted cash to really accelerate our growth. We've had a massive transformation of the business over the past 3 years. In 2020, our revenues were up over 75%, EBITDA up over 100%, but we did that in a cash-strapped environment. The capital that we raise will allow us to accelerate both our organic as well as our inorganic growth moving forward.
Ben, we've talked a few times in the lead up to your debut today about the sales momentum you do in fact have in your business and that you had last year too. Has that continued into this year?
Brian, nice to see you again. Look, we're continuing to see growth across all facets of the business. We have a ton of white space that we have created moving forward, both by cleaning up old licensing deals as well as entering new categories. And so, again, this capital moving forward will allow us to continue to accelerate the growth. But so far right now, I feel very confident where we sit, only 6 weeks into the year.
What new categories have you gotten into? I still think a lot of people, they see Playboy, they think you're making magazines. I know that is not the case. You know that is not the case. What products have you gotten into lately?
Yeah, Brian, we've returned the company to be a lifestyle brand, which is really, I think, the core to the DNA and how the brand was founded. So we're organized around 4 key categories that are multi-billion, fast-growing categories: sexual wellness, style and apparel, gaming, and lifestyle, beauty and grooming. We've launched Playboy Labs, which is off to a great start, which is our streetwear brand. We have great things planned for color cosmetics and ancillary products around that. We've cleaned up our gaming business, so we have the ability now to enter iGaming in the United States, sports gambling moving forward. And so when you look at it, the growth has come across all facets. Sexual wellness is obviously growing. We launched our CBD products at the end of last year. 3 of them, we have more coming this year. When cannabis is legal in the United States, we do plan on entering the cannabis space as well. This brand has been around cannabis for 40 years. But again, the growth has come from all facets of the business. We do believe the sexual wellness industry, it's a $240 billion industry today, projected to be $400 billion in 2024. It's highly fragmented. We believe it's right down the middle of the fairway for us as a brand, and it's something that we're focused on becoming a market leader in.
Yeah, Ben, that was a lot of stuff. That's quite a bit that Playboy's working on here. It's come a long way, obviously, from kind of, the adult background that people might have remembered it in the Hugh Hefner days. But what about, which one of those looks most promising when you point to that growth? Because you say you're seeing 100% growth in terms of where you guys were. Profit, of course, what was it? It was under 300,000 not too long ago for, the year. So what is going to be most substantial when you think about branding Playboy into some of these areas? Because that seems like quite a bit of other entities to get into when you're talking about CBD, cannabis, and all, and sports gambling. Which one's most important?
Yeah, look, they're all important. I think what's most unique about this company and why I took this job, and I thought it was the biggest opportunity I had seen in my career, is the value of the brand. This brand today generates over $3 billion in consumer spend. Products are sold in over 180 countries. And when you looked at this cluttered consumer environment that we all live in today, it's the brand that's truly differentiated. You think about other companies that are trying to launch products, people that are entering the telemedicine space, they're spending tens of millions of dollars trying to build a brand. We have a brand that reaches over 50 million people every day that generates over $3 billion to spend. And so when we look at these categories, although it's not easy, the amount of categories that this brand has historically played in its 68 years is amazing. And so that gives us really unlimited runway moving forward. I will say that the first area that we're very focused on is the sexual wellness space. There is no market leader. It's highly fragmented. And we believe globally we can become a market leader.
I mean, if you think about the Playboy brand, sexual wellness, certainly, I think people can see the direct tie there. But what's the play on sports gambling? A little surprising to hear you raise that. What specifically do you have in the works?
I can't comment on anything that we have in the works today. What I will say is this brand has been in the gambling business for 40 years. We have a casino in London in partnership with Caesars, or what is now El Dorado. We have great partnerships internationally with microgaming, with Scientific Games domestically. We've had in the past some of the best Super Bowl parties, Kentucky Derby parties, and others. And I believe because of the fan base we have, we can activate that fan base around other gaming assets. And so it's something that's been core to our business for 40 years. It's something that we are focused on moving forward, and wait and see.
And how do you think the pandemic has changed your business?
Look, there's no doubt there was a benefit in 2020 on our direct-to-consumer business, but we also lost revenue in other areas. I believe that the strategy that we set upon 3 years ago to move the domestic business to D2C and potentially follow that internationally down the road was the right strategy. We saw those trends internationally before the US had caught up. And so I believe that that will continue to benefit us moving forward. You know, we have over 3 million people that we're advertising or marketing to today. If you look at the business in 2020, over 50% of our revenues came from the D2C environment domestically. And when I think about long-term internationally, I believe that we can drive superior average order size and lifetime value of the customers by controlling our e-commerce on a global basis. Now, that's not to mean it's going to happen overnight, but long-term, you know, should we be able to execute on that, we can capture more and more of that $3 billion of spend around the world.
And that full interview can also be watched on yahoofinance.com. Coming up, we'll be chatting the future of the podcast industry with Pod CEO Doug Imbruce. That's next. Welcome back to Yahoo Finance Live. Let's check in now on oil and the energy sector. We have Yahoo Finance's Jared Blickery back with us. Jared, we see that we have crude settling at just over $58 a barrel.
Yeah, down 1%. This is the first down day we've had in 9 days. So snapping that 8-day winning streak that we saw before. And the energy sector is by far the worst performing sector of the day. Excuse me here, it's down about 2% right now, but you can see some of the majors down more. In your upper left, that's ExxonMobil, that's down more than 3%. So is Royal Dutch Shell. Chevron down a little bit less, a little bit more than 1%. But I want to get to a chart here because crude oil has had just an incredible run over the last 3 months. You can see it's up about 40% over this time period. And we have reached territory that we haven't seen since last January. Given all of that and the extended nature of it, not surprised to see a little bit of a pullback. The reason today the International Energy Agency came out with a reduced demand forecast because of the increased lockdowns. But if OPEC Plus is doing what they say they're going to do, and they have done it so far, probably see higher prices. I think it was one analyst yesterday, we were talking about this, seeing Brent at $70 by year end. Kristen?
All right, Yahoo Finance's Jared Blickery again with that update on oil and the energy sector. Thanks so much, Jared. Now let's turn now to that conversation on podcasts. We're joined now by Doug Ambrose, founder and CEO of Pods, and Yahoo Finance's Melody Hom. So Doug, I don't want to spend too much time because there's so much interesting stuff to get into here, but I'm hoping for everyone at home, if you can explain a little bit how Pods works.
Yeah, sure. So it's funny, Melody wrote the other day about sort of the golden age of audio. And while it is a golden age, and we're seeing more podcasts being produced than ever by these really thoughtful, incredibly knowledgeable creators, for consumers, it doesn't feel much like a golden age because the process of discovering podcasts and using these decades-old directories, it hasn't changed. And if you look at the data, it sort of supports this gap. We're only more than about 1% of podcasters reach more than 5,000 listeners. And so at Pods, we thought we could sort of transform the discovery of podcast content with a really modern experience that basically matches the kind of experience you have when you use apps like TikTok and Instagram and Snap and automatically transforms podcasts into a personal feed of highlights that you can enjoy and save full episodes to listen later. So we're just trying to grow the audience for podcasts overall and help people fit this amazing medium into their busy digital lives.
Doug, there is this humorous component to this moment, right? Because it's basically radio, what we're listening to. And Pods is essentially curating snippets of compelling conversations, and you can go deeper, right? You can choose to listen to a full episode in-app. What do you make of kind of this structural shift back to perhaps the 80s when podcasting first started, and that it feels like perhaps the innovation has actually been stunted and that there isn't any new territory to really explore?
Look, it's a great point. If you look at every other medium, it has been digitally transformed. So, right, when text was brought online, Twitter basically took the idea of long blog posts and transformed it into these short 140-character tweets by building a platform around creative limits. TikTok did the same thing in video. Instagram via their photo filters. But to your point, that same transformation has not happened in podcasting, and we think it's limiting growth.
Doug, looking at the space with a lot of this consolidation that's happened, Spotify is the player to beat, right, when it comes to content creation and also the pipes as well. As I understand it, Pods now hosts about 5,000 podcasts. You've been able to aggregate some of that manually, some of that with big data, but you don't have original podcasts on the platform. Believe it or not, I'm sure everyone watching knows that, Joe Rogan, from the Obamas to Brene Brown, the Duke and Duchess of Sussex, they are all Spotify original podcasts. How are you able to make sure you can have all of, the premium high quality content on the platform when there seems to be more of this race to get creators to be sort of tied to individual platforms?
Yeah, it's it's unfortunate that everybody talks about the big names in the space with these incredibly lucrative deals who typically have either pre-existing platforms, either they're sort of media personalities or existing celebrities that Spotify pays to create original exclusive content that goes behind Spotify's paywall. Because as sort of we dig into the industries ourselves as a company that wants to disrupt the experience of podcast consumption, there's just so many other incredible creators that nobody is talking about, and we hope, similar to the way, again, companies like TikTok and Instagram and Twitter created platforms that allowed creators to be elevated and built these incredible network effects through these really modern experiences, that we can bring that same approach to podcasting. And hopefully next time we speak, you'll be talking about, the long tail of incredible creators. And we don't have to, keep people's attention focused on Joe Rogan, because I don't want to live in a world where everybody listens to only Joe Rogan every day.
So that brings me to a question that I have to ask you, which is about Clubhouse. Melody and I were listening to a chat that you were doing yesterday on that app. I mean, as you were mentioning, there's so many content creators out there that are inking those really big deals, but there's, as you said, tons of content creators that no one has even heard about. So how does an app like Clubhouse really turn that industry on its head and kind of change the game for the audio only industry?
Yeah, I mean, it's unfortunately in Clubhouse, I think you're seeing a lot of the same dynamics sort of take shape, because while Clubhouse is an incredibly powerful tool for live broadcasting, the discovery experience inside an app like Clubhouse, where you load the feed and sort of the most popular rooms appear first, it just seems like kind of an echo chamber, similar to, you see the same kind of personalities that are appearing, in traditional podcasting. Again, apps that really help us discover this long tail. Again, Twitter, TikTok, those to us are models that are far more exciting. Not to mention that, we're living through a pandemic and everybody is sort of this incredibly captive audience now, right? And so these live events, they create urgency. And certainly, they drive traffic, but the internet is an on-demand medium, and so we're excited to introduce a platform that conforms to the way that people, traditionally experienced their content, which is on demand and asynchronicity, and again, really focus on elevating that long tail. Because as exciting as it is to hear what Elon Musk has to say, again, you don't want to listen to the same kind of folks every day.
So, Doug, when you were talking about, Twitter taking text and shortening it, and then you mentioned, of course, TikTok, which, of course, everyone thinks about, Vine, which took video and decided to make content in just a couple of seconds or less. I'm wondering if you see that also coming in the podcast industry, where we might have an audio-only Quibi coming up soon.
Quibi, yeah, look, I think that the great thing about audio is how deep and how thoughtful the content is. But because the average podcast is over 40 minutes in length, again, in kind of today's world where everyone's trained on not just consuming short form content, but also sharing it, these longer audio files get left behind. And that's why we've invested so much time in this layer of digital transformation, where we can actually evaluate the contents of every podcast, surface the most engaging 60 seconds through machine learning, and then deliver those highlights in a feed that allows you to, as Melody mentioned, then go deeper. And so we see, pods almost as a lead generation engine for time shifting the consumption of these longer form shows that are really deep, really thoughtful, really interesting, but that you just don't always have time to consume in the moment.
I'm super new to podcasts. I literally only listen to 2 right now. So I'm definitely going to have to check out pods to see what other podcasts are out there that I would be interested in. Doug Ambrose, Pods founder and CEO, and of course, Yahoo Finance's Melody Hom. Thank you both for joining us for this conversation.
Thanks.
And coming up, Broadway might be reopening soon. We'll be chatting with one Broadway performer next. Welcome back to Yahoo Finance Live. Now, Broadway has been closed for nearly a year, and New York City is hoping to reopen theaters soon. So let's bring on Broadway performer Robert Hartwell now to chat about the future of the industry in a post-pandemic world. So, Robert, for your friends and colleagues that are still on Broadway, at least, until everything was shut down, I'm hoping you can really tell us how tough this past year has been.
I think it's been a huge navigation because you spend your entire life training to be a part of this industry, and you never see a day or a time that Broadway could be shut down. And then, within a matter of hours, your entire industry is gone. You're not able to, be in space together and do this thing that you've said you wanted to pursue your entire life. So it's been really hard for Broadway performers to then be able to find truly income.
Now, you started a company called the Broadway Collective a few years ago, not during the pandemic, where you trained the next generation of performers, so to speak. I'm wondering how well it has done throughout the pandemic.
That's so kind. What's so interesting, when we opened the company in 2016, people said to me, how are you going to train students across the country online and singing, dancing, and acting? And also, why online education? And to me, it was about access and inclusivity and the ability for people, regardless of their zip code, to be able to connect with who it is that they wanted to be and where it is that they wanted to be. So to now be able to have this platform, it has been the biggest gift, not only for our students and our parents, especially because so much has just been closed for them in their local arts training, but also for the Broadway performers that we are able to employ right now, who serve as their mentors and coaches.
As you're talking to, some of the folks that unfortunately lost their jobs because of the pandemic, but were able to pick up some work through the Broadway Collective and help train a lot of these students. And as you're talking to the students themselves who are coming to your classes, which is such a important lifeline, I think, for so many young children that are stuck at home, don't get to see their friends. I'm curious to know if a little bit of that, or some of them, are a little bit negative or pessimistic about the future of performing, if they just aren't interested in going back to Broadway.
I would definitely say that performers are ready to get back to their calling. And I know that that sounds so woo-woo, but there is something that is inside of you as a performer, especially when you have been on Broadway, that there is nothing like the feeling of walking through one of those stage doors and being able to share your gifts and your purposes and your purpose with an audience, and also with the cast. Like, it truly becomes not just a community and, coworkers, but truly a family. So although it has been so hard, it has been so rewarding to be able to connect so many performers who, by all intents and purposes on their taxes this year, are completely out of work with our students, because it is showing these Broadway performers like, hey, don't lose hope. Continue to believe that it's going to come back, because it is, and it's going to be different. But these kids are more excited than ever to get back and see shows and to one day get here to New York City. So I have definitely seen it be a huge support for our team, but also a huge plus for our students, because so many people that they weren't able to work with before, they now are.
I have about 35 seconds left with you here. Unfortunately, Robert, I wish I had so much more time. Wanted to quickly ask you how you imagine Broadway in a post-pandemic world.
I think it's going to be more focused, and I think it's going to be more kind, and I hope that it's going to be more inclusive.
No, I know I'm excited to get back to seeing folks like yourself perform. I love attending Broadway shows, so I'm excited when it is reopened safely, however, and especially to allow some of these folks to get back to work. Broadway performer Robert Hartwell, thank you so much for joining us today.
Thank you.
And coming up, we're going to be talking about Kraft Heinz. Kraft Heinz up over 5% right now. Welcome back to Yahoo Finance Live. Let's talk Kraft Heinz now. They reported their fourth quarter earnings. We have Yahoo Finance's Emily McCormick for more details on that earnings report and what the company is going to be doing next. Hey, Emily.
Hi, Kristen. And taking a look at those fourth quarter results, those coming in much better than expected here for Kraft Heinz. That company really getting a boost from the fact that consumers are mostly eating at home. And so the retail side of the business is really surging, even as they have seen some demand declines on the restaurant side of the business. Now, we saw organic revenue beat expectations, growing 6% year over year. That was well above the 5% growth expected, and also more than reversed the 2.2% sales decline that the company posted in the same quarter of last year. We also saw adjusted earnings of 80 cents per share, better than the 73 cents per share expected. But I will say the big news out of this morning's report was actually the fact that the company is going to be selling its nut businesses to Hormel. This is going to be Hormel's largest deal to date, and it is valued at $3.35 billion, and it is an all-cash transaction. Now, Hormel, in acquiring this part of the business, is going to be adding to its portfolio brands including the Planters nuts and trail mixes, Nutrition, and Corn Nuts. So that will supplement the brands that Hormel already has in its portfolio, like Skippy Peanut Butter, as well as some others like the Justin Nut Butter brand that it actually purchased back in 2016. Now, this is really a bet here for Hormel on continued growth in packaged food, again, especially because that retail consumer has been so strong here during the pandemic. I will highlight, though, that we are seeing shares of Hormel under some pressure, perhaps a little bit of concern about that more than $3 billion price tag, although we are seeing shares of Kraft Heinz up more than 5% in intraday trading. Kristen.
All right. Thanks so much, Yahoo Finance's Emily McCormick. Let's take one last look at the market. We have the Nasdaq remaining in the green right now, up over 0.1 of a percentage point, while the S&P 500 and the Dow continue to remain under pressure. However, the Dow paring some of its losses from earlier in the trading session, down about 83 points right now. We had seen that well over 135 points earlier in the day. On a sector basis, tech and healthcare now now, both in the green. Tech, the leader, up about 0.7 percentage point. We have healthcare coming in at 0.06. When I look over at the laggards, we have energy down about 2.5% right now. Coming in behind is utilities down over 0.6 percentage point. Want to take one last look over at Bumble. They did go public today. They were priced at $43 a share and opened at $76 a share. Right now, Bumble holding steady at about $72 a share. A nice boost there from that IPO price, up about 67.5%. I want to toss it over now to the 3 p.m. show. Shauna Smith and Adam Shapiro will be talking to former Defense Secretary Leon Panetta. That's coming up next.
SPACs generated $82 billion last year, and this year, well, January just saw a record number of listings, and can you say 26 billion? We've got the former CEO of Angie's List, who is now the executive co-chair of Z-Work Acquisition, here to talk about his $230 million SPAC and the kind of business he hopes to target. Then we will speak with former CIA Director and Defense Secretary Leon Panetta about the Biden administration's plans with China, as well as the historic Trump impeachment trial underway in the Senate. And in the 4 o'clock hour, former Secretary of Health and Human Services Kathleen Sebelius scores the latest efforts to fight COVID-19. To say that Amazon is an unconventional company is an understatement. I stole that from their book. Colin Breyer and Bill Carr, 2 former Amazonians, know that better than anyone else, and they will share some of the keys to Amazon's success as we get a preview of their new book, Working Backwards: Insights, Stories, and Secrets from Inside Amazon. Go ahead and place your orders. There's an hour left in the trading day. I'm Adam Shapiro.
And I'm Shauna Smith. And Adam, taking a look at the market action today, we're looking at a mixed picture. The Dow and S&P both in the red with just under 60 minutes to go in the trading day. You can see the Dow pulling back from that record close that it recorded yesterday. Dow off 81 points, S&P off just around 0.1%. The Nasdaq, though, holding on to gains up just around 15 points. Investors looking at that worse than expected jobless report that we got out this morning, trying to figure out what that means exactly for the U.S. economic recovery. Taking a look at the sector action today, energy by far the laggard here, off just over 2%. A couple of names, though, that we are closely watching. First, I want to take a look at Bumble, the IPO today. We're seeing shares soar on their first day of public trading. You can see it up at $71.84 right now. It priced at $43 yesterday, opened at $76 a share, trading under the ticker symbol BMBL. Now, following its debut earlier this morning, its market cap over $8 billion. In the S1 filing, Bumble saying that it generated revenue of $376 million during the first 9 months of 2020, a net loss of $84.1 million. Looks like investors, though, are very excited about this debut, with shares jumping, as you can see, in the first day of trading. Flipping over, though, to Disney. Disney will likely post the third straight quarter of year-over-year sales declines after the bell. We're going to be bringing you those results as soon as they cross. So you can take a look at the stock, just barely in positive territory. Revenue is expected to fall 24% to $15.9 billion during the quarter. Adjusted loss per share is expected to come in at 38 cents. A couple of things going on with this company. Of course, its theme parks and its cruises remain under pressure in large part because of what's happening with the COVID-19 pandemic. But Disney Plus is expected to be a bright spot here in this report, Adam. Disney reported numbers of 86.2 million. That's how many subscribers they had as of December 2nd. So analysts will be very keen on what that number is today after the bell.
Shauna, let's redefine buzzkill. Weed stocks are under pressure right now, and in a big way. We were talking earlier this week about Tilray being up, Canopy Growth being up, all of them. Aurora Cannabis were up. Well, not so much now. We got Tilray down about 46%. You got Canopy Growth, which is down 22%. We got their earnings earlier this week. Also, Aurora Cannabis down about 22%. Here's what's going on. There had been a Reddit rally. There was a lot of chatter on the Reddit forum about buying these stocks. Apparently that chatter has backed off a bit. There's also concern, though, about the ability for legalization efforts to pick up momentum here in the United States. That was a big part of the story going forward, especially with the new administration. But there seems to be less guarantee that that will happen anytime soon. So the buzz is wearing off with the weed stocks. Not with Zillow, though. Everybody dreams about a new home, right? Well, the shares are trading higher now, about 15% for the real estate group. They were up 18% at the opening bell. Citi analysts raised their price estimate for this stock to $250 from $130. Jefferies increased their price target to $215 from $175, and they kept it at a buy rating. They say that Zillow, and this is a no-brainer, is a key beneficiary of the strong U.S. housing market, and they expect the housing market to remain strong. What about the markets in general? Let's go to Jared Blickery. He's got his eye on a lot of earnings and IPOs. A lot of news happening on this Thursday, Jared.
Yeah, you know what? I was just looking at the Wi-Fi Interactive as you were going through the cannabis space. I'm not going to dwell on this, but I just want to show the picture. Is that worth 1,000 words? Look at that. Tilray down 47%. But I'll tell you what, you look over the last 5 days and it is pretty much the inverse. So let's move on to cryptocurrencies, and we're going to go to Bitcoin right now at a record high, and got some news out of PayPal today that they're going to be adding Bitcoin to Venmo in the first half of this year. Got a bunch of other news from Bank of New York Mellon, MasterCard. Everybody's heading into the crypto space. But guess where else they're going? IPOs. We got Bumble today. Look at that, up 66%. You want a chart of this? Up from its $40, excuse me, I believe it's $45 IPO price. Nevertheless, big gains there for the Bumble, and its new CEO minted a billionaire today. Also looking at Signify Health, that's up 33% on its opening day after IPOing at $24 per share. And finally, Playboy Group, first day as a SPAC, ending probably in the red here, down about 2%. Did get a decent pop on the open here. Have to see what comes tomorrow. But also taking a look at Disney, because I want to give the numbers that we're going to be looking for after the bell here. Now, they're expecting a loss per share of about 38 cents. And this comes with revenue that's expected to be $15.92 billion. That would be a 24% drop year over year. There's going to be a lot of focus on Disney Plus, as Shauna was talking about. We're expecting 91, or at least the street is expecting 91 million subscribers. That is the number to beat, but also focus on parks and their theater, movies, studios, and also ESPN. Lots to dig into there. We're going to have that right after the bell in about 1 hour, guys.
Jared, thank you very much. Let's keep talking about the markets and where they are actually headed. We bring back into the stream a guest of this program. Jeff Klingelhofer, Thornburg co-head of investments, is joining us. And I want to jump into something that you shared with us in the notes. You were talking about the political wins with a Powell, Yellen leadership at both Treasury and at the Fed. But you put out as an example of the shifting winds, Reddit. Explain that, please.
It's incredibly confusing when you work on this side. Look, I think it gets into the shifting political narrative. The reality that central banks around the world have created an environment that have benefited asset holders, right? Central banks are supposed to create inflation. They haven't done that yet. We worry maybe they will, but they haven't been successful. But they've created a whole heck of a lot of asset price inflation, and that benefits folks who hold assets, which tends to be the higher income echelons, and it's left behind a number of other people. I think this is just a continuation that we've seen of the world fighting the inequality battle, and ultimately Redditors taking to the streets to force up the prices of some of these companies in hopes of squeezing out shorts. What it's done is it's continued to move unprofitable and some of the worst of the companies up. And created what I would argue are bubbles. And as you just showed, in many cases, as the Redditors move on, indeed were bubbles, leaving those unfortunate souls in their wake. So it's incredibly challenging. I think it's incredibly challenging for regulatory authorities, but also for professional investors, just given the world isn't operating perhaps as it normally does, and even perhaps as it should.
So Jeff, then the question is, have you changed your asset allocation or your approach here to the markets as a result of that? Just the fact that we have seen, as you're saying, some of these bubbles created in certain classes or in certain names?
And one of the things we continue to tell our clients, right, is when you are adequately compensated to take risk, there's a time and a place to step into risk. When you don't understand exactly what's going on in the market and they're not operating in reasonable ways, perhaps that's a time to take a step back. So to directly answer your question, no, we haven't had to adapt the way we ourselves are actually interacting with the market. It's been incredibly fascinating watching and trying to figure out and exactly where this leads. But we've taken a very disciplined approach and focusing on ensuring that we're after the solution, which at least for fixed income is having that right mix within the upside and downside capture, given the uncertainties of the market.
Well, we're getting through earnings season, and I think it was Credit Suisse pointed out that we have 80% of the companies that have reported have beat. But here's the question I wanted to ask you: is you don't like corporate balance sheets. You think there's a terrible picture out there with balance sheets, and it's getting worse. So, the two things in conflict. I realize you're not Credit Suisse, but what's going on?
Again, this comes back to central banks creating just an untenable environment. What they've done is they've created the perfect environment where corporations should take on significant amounts of leverage on their balance sheets. And they have. And if I personally was running a company, that's exactly what I'd be doing as well. But I'm not running the company, I'm investing in them. And so investors need to take a step back and understand that the uncertainties that this creates. Now, leverage isn't always and everywhere bad. You need to focus on debt serviceability. And so one of the things, again, we've been telling our clients and celebrating the successes that we've had has been ultimately when you focus on the debt serviceability, you benefit from central banks when they prop up the market, but you're not reliant on them. Right? The Fed can create liquidity, but they don't create solvency. And so by and large, yes, we're worried about corporate balance sheets, just given the significant excesses of debt, but debt servicing costs are low, and you need to focus on those companies that even when debt servicing costs rise or they hit challenging times, they still have the ability to service their debt. So that's what we're focused on, and that's not every company.
Hey, Jeff, real quick, we only have about a minute left here, but just first, your thoughts on the stimulus negotiations going on down in D.C. right now. I mean, how important is it really for investors, specifically for the market, that we do see a sizable package passed down in D.C.?
When I look at fundamentals, it's hard for me to really square current fundamentals, and we just saw this with the jobs report today, current fundamentals with current prices. I think almost unarguably, the market is looking through to the future, the end of COVID, significant amounts of stimulus and continued stimulus from fiscal and monetary authorities. So I think it's incredibly important for the markets, right? That's one of my biggest concerns, is that eventually, as we move on from the necessity of providing stimulus, the markets are going to have a hard time digesting, as eventually we have to walk that back, and we take out some of the things that have pushed the market higher.
Jeff, I think the way to sum up what you've shared with us is a new variation of the old saying, when the tide goes out, only this time we're going to see a lot of people when the tide goes out who've been doing their Zoom chats without wearing pants. Jeff Klingelhofer, Thornburg Co-Head of Investments, we appreciate your being here. Forgive my humor. Let's go to Jessica Smith. She's in Washington, D.C., has the latest for us on several issues, including the impeachment trial of President Trump.
Yeah, the impeachment trial continues again today, with House managers this time sharing personal accounts of what happened at the Capitol on January 6th. We have heard stories of how this impacted not only members of Congress, but their staff, other members like custodians in the Capitol, police officers who were in the Capitol. They're also trying to show that President Trump knew that his actions and his words could prompt his supporters to act. They used the example of what happened in Michigan, President Trump tweeting about the Michigan governor, and then there was that plot to kidnap her. And they talked about his response to that plot. And this all comes after the managers showed never before seen video yesterday, security video of the riots on January 6th. The video was chilling. You could see just how close this mob came to members of Congress. The video showed Vice President Pence rushing out of the chamber just moments before the mob made it inside. It also showed Officer Eugene Goodman steering Mitt Romney away from the crowd. He told them to turn around so he didn't run into the violent mob. There were several other close calls that were caught on camera, and many of these senators were shaken up as they watched this play out, realizing perhaps for the first time just how close of a call it was. And the managers are trying to make the case that President Trump is at the center of all of this because he spread the lie that the election was stolen. And then he urged his supporters to go to the Capitol. And when violence broke out, he did not stop it. We are hearing that this could all wrap up by Saturday. It's not for sure at this point, but that's what we're hearing from some senators. And we still have to hear from the president's legal team. They'll defend the president at some point. So we are waiting to see if these House managers wrap up today or if they continue or when they will wrap up. So we'll have to keep you updated on how this plays out over the next few days.
Just real quick, before the impeachment proceeding earlier today, President Biden, I understand, met with a group of senators to talk about infrastructure. What exactly was discussed and what can we expect to be laid out over the next couple of weeks?
President Biden said he wanted to meet with these senators, the top Republican and top Democrat on the Public Works Committee, which deals with infrastructure projects. He wanted to meet with them to see if they could come to an agreement on where to begin. We know that he wants to pass the rescue package, as he calls it, quickly, but he also wants to pass a recovery package later on that'll focus on creating jobs through infrastructure and clean technology. He also said in this meeting that he talked to China's President Xi for about 2 hours last night, and he said the U.S. needs to step up on infrastructure. Let's watch.
If we don't get moving, they're going to eat our lunch. They have major new initiatives on rail, and they already have rail that goes 225 miles an hour with ease. They're investing billions of dollars in dealing with a whole range of issues that relate to transportation, the environment, and a whole range of other things.
The White House press secretary was asked today what the price tag is for an infrastructure package. She declined to answer, saying they are not at this stage yet. The White House says there will be more meetings in the future. Adam.
Jessica, we're going to talk about China with Leon Panetta just a few minutes from now. So thank you for setting that up for us. When we come back, we've got the former CEO of Angie's List to talk about his new $230 million SPAC and the kind of business he hopes to target right after this.
Just around 45 minutes to go in the trading day, and you're looking at still a mixed picture, although the NASDAQ gaining a little bit, up just around 0.2%. S&P actually just flipping back into positive territory, although barely. Dow, though, under pressure, well off the lows of the day, but off just around 38 points. Well, January was a record month for SPACs, raising just around $26 billion. We want to bring in Chris Terrell. He is the former CEO of Angie's List, and he's now the co-chairman of the SPAC ZWork acquisition, which recently filed for an IPO. And Chris, it's great to have you on the program here. So you've got this $200 million SPAC. What companies, tell us about the companies that you're looking to target here and why you're seeing such a huge opportunity in that space.
Sure. Well, thank you for having me. We're really looking at companies that are focused on the future of work. We think this is an exciting area. You're seeing a real change in how workers are wanting to work, where they want to work, when they work, and you're looking at companies that are seeing this as an opportunity to, bring in a new wave of workers to, improve their efficiency, effectiveness, and we're just seeing some amazing companies at ZWork that are the brands of the future that sit in between workers and companies to bring them together and allow them to operate in a more effective, more efficient way. So this is an exciting time. We think there's some great companies out there. And, we really are excited to focus on the future of workspace and help a company go public.
Can you give us a hint I want you to slip up and tell us the name of who you're talking to. Short of that, can you give us an idea of the actual things these companies are providing? Because I already got Zoom and they're public, and Microsoft got its version and they're public.
Sure, it's a great question. So, you've got everything from marketplaces in between. There are so many marketplaces that are bringing together workers with companies. I know of a really interesting company that, is helping a large enterprise company with blue collar workers. There are other companies that we look at, one that is, providing high-end financial analysts to some of the biggest enterprise companies out there. So there's everything from tools and services for the workers. Could be portability of benefits. It could be, support in terms of insurance, et cetera. There are workflow management tools for companies. It's a really wide range of companies to go after. And ultimately, we're looking for, the future big brands that are going to define the future of workspace. So that's a, high growth company, great management team, really good unit economics, and is looking for, kind of support, the operational support that, we bring from ZWork. I think, a lot of SPACs don't necessarily have the operational experience, the public company experience we have. And so we think that's important for the types of companies we're looking at and for a good partner.
Hey, Chris, not so much the work from home aspect of this, but more so when we're talking about the gig economy. I guess, how would you say the pandemic has forever changed this space, and what are some of those challenges that are now facing these workers as we look forward?
Sure, and I want to say, I feel for everyone, be it gig workers or W-2 workers. These are really tough times, but you just look at, to your point, working from home, how much that has changed behaviors that were percolating, they were building, but COVID really accelerated them. And our thesis has been that we're seeing one of these big waves of disruption that comes every 50 to 100 years, and we're just at the beginning of it. And COVID accelerated these trends, and now we're all sort of forced to work in new and different ways. And I think everyone's been surprised at how effective remote work has been. And I don't think we're going back. Look, these things are here to stay. Remote work changes if you're a company, the types of employees you can have, if you're a worker, where you work, when you work, how you work. So I think that's just one of the indicators that the future of work has accelerated. We aren't going back, and these are exciting times. And there's some great companies that we're looking at ZWork that address this whole space.
Very quickly, looking at the executive team that you're putting together, alumni from Airbnb, from NICE, from Reuters, does that give us any kind of sense of who you might be targeting? Again, trying to get you to slip up and name some names.
Sure. Well, we had lots of people trying to get us to slip up, and obviously, as a SPAC, you want to hold your cards close. Look, we think we have a great management team, a lot of public company experience. Great operational experience, great M&A experience. Our board is very strong with public company experience, and our advisory team is as well. So, our goal was to go out and put a really good, strong team together. that could go and tap into their networks, help us find companies that we may not know about, reach out to others in the space that they know. And so, we feel really good about the team, the ZWork team. And we've already started having really interesting conversations, and we want to talk to those high growth companies that want to tackle the future of work space and the opportunities that lie ahead for all of us.
Chris Terrell, great to have you on the show. ZWork Acquisitions Executive Co-Chairman. Thanks for taking the time. Coming up next, 2 former Amazon execs are sharing some of the keys to the company's success and also give us some insight and maybe some secrets too. We're back with that in just 2 minutes.
Allow me to plagiarize from a new book. To say that Amazon is an unconventional company is an understatement. That is the opening line of Working Backwards, Insights, Stories, and Secrets from Inside Amazon. And the authors, Colin Breyer and Bill Carr, are both Amazonians. They were there for several years. And that's some insight for all of us about what ways to run companies and do it well. So welcome both. I'm going to start with you, Bill, because one of the things you talk about are the 14 leadership principles at Amazon. And one of those principles, bias for action. What is that? And how can a business person watching use it the way Amazon has?
Well, bias for action is one of the many leadership principles. And one of the clever ways that the company actually enacted that in the early years was by creating an award called the Just Do It Award. And the way you won this award was by identifying an important problem, taking the initiative to go address it. Your solution didn't even have to have worked. And in fact, you didn't even have to ask permission of your manager. But it was basically saying, for getting everyone to think like an owner and go and take action to fix important problems quickly. And the way you won this award, if you won this award, you got to yourself an old beat up, like size 15 Nike shoe handed to you by Jeff, and you'd be recognized at the Amazon All Hands meeting. So it was sort of part of that culture of that startup culture where we were getting big fast and having to move mountains to get there.
Colin, just describe to us what the culture is like inside Amazon, because I think that's such a huge question for so many people. We know we have read certain media reports that don't really shed a favorable light on the company, but I'm curious just to get your experience and I guess what exactly you wish people knew about working inside Amazon.
if you had to distill the Amazon's culture, it would really be four things: customer obsession versus competitor obsession, just a spirit of invention, and along with that is how you fail. So there are processes to handle failure within Amazon. Long-term thinking, beyond the quarterly revenue targets that you need to hit, thinking longer term than most companies do, and then just taking a pride in operational excellence of everything you do. Most of the work individuals and teams do won't make it out, and customers can't see it, but those little details matter, and that's what makes the customer experience a delightful customer experience, is getting all of the little details right. And so Amazon has processes inside to reinforce all of those, and it's an invigorating, fun, and challenging place to work, but you really make a material difference for customers.
So, Colin, let me follow up with you. Is that a Jeff Bezos thing, or did that evolve over time? And what do you think of Andy Jassy?
Jeff, from day one, has said that he wanted to create Earth's most customer-centric company, and spent a lot of time figuring out how to do that and instrumenting processes within the company. What I think of Andy Jassy, I think he's going to be a great second CEO for Amazon. He's well steeped in the Amazon culture. He's worked in very large organizations, but also is familiar starting with small groups. He built AWS from $0 to $10 billion faster than Amazon grew from $0 to $10 billion, starting in 94. So he's got all of the tools and knowledge, and I think he's going to do a fantastic job in this new role.
Bill, I want you to elaborate a little bit on something that you did touch on. I know you spent 15 years at Amazon. You're a vice president of their digital music and videos business. That includes Amazon Music, Prime Video, Amazon Studios. But this offhand remark that former Apple CEO Steve Jobs made, I think, led maybe to some of this digital creation that we saw at Amazon. So can you talk to us about that? And I guess just where you see that moving forward?
Well, the genesis of the digital media business really was at the end of 2003. Amazon, 77% of Amazon's worldwide revenue was all physical media products, books, CDs, DVDs. And Jeff had actually had a meeting with Steve Jobs around that same time, just before he released iTunes for Windows. And, the notable thing about that meeting was that Jeff didn't, run back to Seattle and create a fire drill to create an Apple copycat product. Instead, he tapped my boss and me to move off of managing Amazon's largest business to start a new business in digital media. And we spent, weeks, months thinking through how we could really create value for customers. And the first product we came up with to do that was the Kindle, which was a real breakthrough for customers. So Jeff really approached that problem differently than the way a lot of CEOs would have.
I think I owe you a thank you. I've got my Kindle. I'm going to pull it out of the drawer. I got my Kindle right here, and I'm loving the first season of Flack on Amazon Prime, but I got to let you go after that. Colin Breyer and Bill Carr, working backwards, insight stories and secrets from inside Amazon. We appreciate your joining us. Coming up, former CIA Director and Defense Secretary Leon Panetta on the Biden administration's plans with China, as well as the historic Trump impeachment trial underway right now in the Senate.
Time for your news on the move. Larry Flynt, the founder of Hustler magazine, has died at the age of 78. Now, Flynt built a $400 million adult entertainment empire. It included films, casinos, and websites. Taylor Swift announcing the first of her re-recorded albums. The album has 26 tracks and will feature 6 never-before-released songs. Now, Swift has vowed to re-record her first 6 albums after Scooter Braun bought the rights to the master recordings of those albums along with her former label, Big Machine Records, back in 2019. Now, icy conditions in Fort Worth, Texas led to a massive pileup involving more than 70 vehicles. There are some reports that involved up to 100 vehicles. Now, Fort Worth police have confirmed that 5 people were killed in this accident and at least 30 people have been transported to hospitals. Now, officials have asked residents in the area to stay home due to these extreme weather conditions. We want to turn to D.C. because it's day 3 of Trump's impeachment trial. We had the House managers making the case that Trump was responsible for the January 6th riots. So here to talk a little bit more about that and also the Biden administration's focus over the next couple of years and what we can expect on foreign policy. We want to bring in Leon Panetta. He's the former Secretary of Defense under President Obama and also the Panetta Institute for Public Policy co-founder. Secretary, it's great to have you on Yahoo Finance. Let's just start with the trial, because when it comes to the trial, I know you've recently said that it's important for the country to go through this process. My first question to you is, why is that the case? And what message do you hope this trial sends?
Well, for anybody who's been watching that trial, I just don't think there's any question that when the U.S. Capitol was attacked and our democracy brought to a halt in an effort to try to stop the vote count on the presidential election, that this was a major insurrection in our country, and that the president was responsible for that insurrection. The country needs to come to peace, really, in understanding what happened, who was responsible for it, and how is that individual going to be held accountable. We in our democracy can't just ignore what took place on January 6th. We have a responsibility to, under our system of government, to make sure that what happened will never happen again.
Secretary Panetta, we should point out to people you were also director of the CIA and oversaw the hunt for Osama bin Laden. When you use the term domestic terrorists, as you did in an op-ed with CNN, that's very serious. And you said terrorists will not accept the truth of why they are wrong, but they will accept the reality of overwhelming force. What does that look like within our own borders?
Well, I think we have to recognize that that what happened on January 6th is in many ways similar to what happened on 9/11. On 9/11, we were attacked and we recognized the threat from foreign terrorism. And we realized that we had to go after those who had attacked our country and bring them to justice. And I think the same thing is true on January 6th. We saw domestic terrorism in this country and what it could do in undermining our democracy and tearing away at the fabric of what our democratic systems are all about. And therefore, I think we can't underestimate domestic terrorism. We can't assume that somehow it will never happen again. So it means that we have to build the same kind of cooperation between intelligence and law enforcement and other law enforcement entities to try to make sure that we are keeping track of domestic terrorism and making sure that what happened on January 6th doesn't happen again. That is extremely important to the security of our country.
Well, and Secretary, talking about that, I guess taking it a step further, then how exactly does dealing with domestic terrorism, how does that differ then when you're dealing with terrorists from outside of this country? I mean, how does the approach on this differ from each other?
Well, on foreign terrorism, the real basis for our ability to go after those who are involved in the 9/11 attack was intelligence. We were able to gather important intelligence on who were those that were involved in the attack, where were they located, how are we able to go after them and make sure that they would not attack our country again. And we were largely successful in that effort. And it was a combination of good intelligence and targeted operations, particularly by special forces, to assist us in those efforts. And I think here in this country, it's going to be a combination of good intelligence, the ability to understand where these threats may be coming from, and then the ability of law enforcement and the FBI to be able to go after those that might be involved in conspiracies to bring down our country.
Secretary Panetta, we need to take a quick break, but we want you to stay with us. On the other side, we want to talk a little bit more about the Biden administration, what we can expect in terms of foreign policy. We'll be right back in just 2 minutes.
We're going to continue our discussion with former Secretary of Defense and CIA Director Leon Panetta. Let's talk about foreign policy, specifically China. We know that President Biden had a 2-hour phone call with the leader of China. And you have said in the past that Joe Biden recognizes the threats from China like we all do. He even said they could eat our lunch. What does that mean? What are the threats?
Well, I'm glad that the president had that conversation because while China is an adversary and is a competitor in the world right now, and we have to really understand the threats from China in terms of our security and what's happening in the South China Sea and Hong Kong and Taiwan and the other threats that are out there. I think at the same time, it is really important that we be able to have a dialogue with the Chinese in terms of trying to deal with many of the issues that confront, frankly, both of our countries. I think keeping that door open is important, but we have to do it from a position of strength. We have to maintain our military strength in the Pacific. We have to make very clear to China that we will not tolerate their violations of international law, particularly with regards to what's happening in the South China Sea. We've got to be very tough about the fact that there are lines we will not let them cross. If we are tough, then I think we can have that dialogue.
Well, Secretary, I know you've engaged with President Xi in the past here. I guess, what do you think would be potential areas of cooperation between the two countries?
Well, I really do think that in the area of trade, there's a lot of room here to be able to try to resolve some of the differences that have occurred. I think the problem with the Trump administration is they decided to go to war. We had a trade war with China. It penalized a lot of people in our country. We were hurt by it. It really kind of gave China the incentive to take even greater advantage of the absence of U.S. leadership, particularly in the Pacific. And so I really think that there's a real possibility here of trying to develop better trade relations. I think cyber is another area where we had begun, frankly, in the Obama administration to have conversations about how could we establish better standards to try to deal with the cyber threat. And they were willing to engage in those discussions. I think that's another area we could continue to have dialogue on and hopefully make some forward progress on what is, without question, the battlefield of the future.
I hear what you're saying, and I think one of the lessons you take from it is you stand up to a bully. We all learned that when we're kids in the fights we have in the schoolyard, and once you've stood up to the bully, then you can have a discussion. I'm using that to transition back to what's happening in Washington right now, because you talk with people on Capitol Hill. Why are there Republicans who will say one thing privately, but then publicly refuse to say what they are saying privately, that they think the president incited the riot, the insurrection?
Yeah, this is a moment when we really look for people who are profiles in courage and are willing to stand up and accept the truth of what happened and recognize the president's responsibility for what happened on January 6th and hold the president accountable. The problem is that, that trial, the impeachment trial, is a political process. And there are a lot of members on the Republican side who are worried about re-election, worried about the Trump base that's out there that could impact on their ability to survive. And so they're running in fear from that prospect. And so they're not going to vote to impeach the president because they're afraid that it may impact on their self-survival. I don't agree with that, by the way. I think if they stood up and did what was right for our country, recognized the truth of what took place, and recognized their responsibility as elected leaders to hold president accountable for what happened, I think that would be to their benefit. But unfortunately, there are too few that look at it that way.
Well, Secretary, it certainly is a very challenging time here for the country. We have a new president confronting a number of issues. I'm curious just to get your thoughts on what we've heard from the Biden administration over the last couple of weeks and what they have laid out just in terms of their priorities here during the first 100 days.
Well, I think it's kind of refreshing, frankly, for at least for me, to be able to wake up in the morning and not know that there's a tweet out there from a president that threatens the security of our country and is likely to produce chaos. It's been a disturbing 4 years, very frankly, and to have a president who is experienced and qualified, cares about the country, cares about the rule of law, that's kind of refreshing. And I think Joe Biden understands that his primary responsibility right now is to deal with COVID and the threat from COVID and the fact that people are dying, that we have to get this vaccine out, and that we have to provide assistance to the unemployed and to the businesses that have been impacted by this terrible disaster. That's the first priority that the president has, and I think he sees it, he understands it. That's why he's working on this aid package. There are other opportunities, obviously, to pass an infrastructure package. I think there's an opportunity to do something on immigration. I think there's an opportunity to do something on tax reform as well. I think there's an opportunity to be able to do something on healthcare reform. So there are some real opportunities for Joe Biden to be able to move forward on a policy basis to deal with some of the problems this country, frankly, has postponed for too long.
Leon Panetta has served this country as a Secretary of Defense, member of Congress, advisor to presidents at the Office of Management and Budget, as well as White House Chief of Staff, and of course, Director of the CIA. Thank you in so many ways, and thank you for joining us. When we come back, Bitcoin popping as America's oldest bank finally welcomes the cryptocurrency. We have more on that after this.
Taking a look at Bitcoin, it's getting closer and closer to 50,000 right now, just trading right around just below 48,000. We were above 48,000 just a few minutes ago. We want to bring in Yahoo Finance's Dan Roberts, who of course tracks every move of everything crypto here for us. And Dan, we have some news here today in the crypto space. Bank of New York Mellon announcing plans to hold Bitcoin and other crypto assets on behalf of clients. But just big picture, what does this mean for crypto and just bringing it more mainstream?
Well, it's the latest big name, you guys. In fact, just yesterday, I wrote a story on the site about the handful now of publicly traded companies that have spurred crypto adoption in some way or another. We knew about PayPal and Square. That happened at the end of 2020 and really accelerated this Bitcoin bull run. Then, of course, last week we saw Tesla, which bought $1.5 billion in Bitcoin last month. But in that story, I said more of their peers are going to come next. I mean, this is kind of a network effect. And now you wake up this morning, and today you've got BNY Mellon, as you mentioned, Shauna, and also MasterCard announcing today that it has plans to fully support cryptocurrencies for its clients and for its customers. So two more big names today. We know that MicroStrategy, which is also publicly traded and is a cloud services company, has bought up a ton of Bitcoin in the last couple of years. MicroStrategy holds more Bitcoin than Tesla does. But all of these names are adding up. Visa has given its sign-off to a number of Visa-branded Bitcoin debit cards. I think it's anyone's guess as to who is next. You know, yesterday the CFO of Twitter went on CNBC and said that Twitter is considering buying Bitcoin for its balance sheet. So it's anyone's guess, and the companies keep multiplying here. And of course, it's a rising tide lifts all boats effect.
Okay, but real quick, Sheila Bair, she actually said, don't buy Bitcoin. It's at nosebleed levels, and this is getting in the way of its usefulness. She's not opposed to it, but what do you think of what she said?
Well, it's anyone's guess, right? And you guys know my favorite caveat to give is to not listen to anyone who says with any certainty that they know what's going to happen next with the price. Of course, this could be the peak, and maybe in months we'll be looking back and say that, you know, fools rush in, or this could just be the beginning and it could be about to take off again and take a leg higher. I mean, it has more than doubled in a matter of weeks. So maybe she'll prove right, maybe she'll prove very wrong. But to her point, we should separate out the idea of the Bitcoin price right now and companies buying Bitcoin for their balance sheets with companies that are saying that they are going to allow their customers to pay in crypto, which is something that PayPal is going to launch soon and something that Tesla also says it wants to do. Those are two different steps. Some companies are taking both steps. Some are merely buying Bitcoin as an investment.
All right, Dan Roberts, thanks as always for hopping on here and joining us. We're going to take a quick break, but when we come back, we'll bring you the closing bell. And also, Dan Roberts will be joining us for Disney earnings. We're back in 2 minutes. Just around 3.5 minutes to the bell, we have the Dow off just around 26 points. S&P and NASDAQ, though, holding on to gains. We want to bring in Jim Bianco. He's a Bianco Research president there. And also Jack Manley, JP Morgan Asset Management Global Market Strategist. Jack, let me go to you first. We got that weaker than expected jobless claims number out this morning. You actually said that Friday's jobs report was better than expected. How is the market looking at the labor market at this point?
On the one hand, the labor market probably isn't as strong as it appears at first blush. If you actually kind of open up this story a little bit, take a look at what's going on with the participation rate, there are a lot of people that are out there on the sidelines, unable to get back to work. And so the numbers themselves may not be telling us exactly the truth. But the point, I think, is the direction. It's the rate of change, not the absolute levels. And the fact that the labor market continues to improve, that economic data continue to be reasonably firm, and the fact that the vaccine continues to get rolled out, I think, fairly successfully, at least when you compare it to what's happening in other countries. All of these things are moving in the right direction, and I think that there are reasons to be excited from a positioning perspective.
All right. Well, the direction that investors are looking for is up, up, up. And Jared Blickery is watching what's happening on the markets as we get ready for the closing bell. So, Jared, take it away.
Well, we got some action in individual names and industries, but the averages, as is the case recently, not doing a whole lot, although we're not seeing everything in the green has been the case. NASDAQ, by the way, is set for a record close, up about 30 basis points, as you can see on the screen here. Dow, Russell 2000, slightly in the red. S&P 500, slightly in the green. Well, let's take a look at some of the movers today. This is a NASDAQ 100 heat map, mixed picture for the mega caps. Apple, Amazon, Facebook, each down less than 1%. Alphabet, barely positive. Microsoft and Tesla, each in the green, less than 1%. But it's been a day about chips. On the news that President Biden is going to accelerate requests for chip investments and also to be able to get the much needed chip supplies and basic materials for chip producers to be able to make the necessary components that automakers, console makers, and everybody else is going to need into the end of the year. So if you look on the upper left there, that's KLA 10 Corp, followed by Lam Research. That's up 8 and 7% respectively, followed by Applied Material, Western Digital, Micron. That's the top 5, rounding out all in chip names. After that, you get to Kraft Heinz reporting after earnings, divesting itself of its peanut portfolio. Also taking a look at the sector action for today. Now, previously we had almost everything in the red except for tech. Tech still the outperformer by far, thanks to those chip names. XLK is up 1% to a record intraday high, except for a record close as well. Also looking at the downside, energy is the worst performer. That's down 1.5%. And peering into the heat map for our energy sector today, we can see some of the majors having a bit of a rough go, giving back some of those recent gains. Exxon and Royal Dutch Shell each off about 2.5%. Halliburton, by the way, off about 4%. Well, here's some of the big movers of the day in the cannabis space. To the downside, wrong direction admittedly, but here is the closing bell on Wall Street.
That does it for us today as we shake out the final trades. Looks like the Dow is going to close the day in the red, although well off the lows of the day. Looks like it's just off 6 points, so not moving too far from the flat line. S&P and Nasdaq, though, holding on to gains, and Nasdaq was the outperformer for most of the trading day, closing up just around 0.4%. The S&P up 6 points. Taking a look at some of those movers, Jared went over that a couple of minutes ago, but taking another look at it sector-wise, technology, healthcare, and materials are some of the outperformers in today's market. The worst performer is energy. We're seeing energy under pressure as oil closes in the red as well. Within the Dow, the worst performers in the Dow, Walgreens, 3M, and IBM. So some of the reasons there that we're seeing the Dow close in the red. We want to bring back in our guests. We want to bring back Jim Bianco and Jack Manley. And Jim, let me just go to you just in terms of the recent action that we've seen in the market. What's your take on it? And I guess, where are you seeing some opportunity right now?
Well, I think that the market has really been bifurcating itself quite a bit. There's been a big shift among investors. They have been moving away from the traditional products of active managed funds or even ETFs, and they've been going it on their own. We all know the Reddit story as well. But what we also have to remember is, for the moment, they're winning. They're winning pretty much everywhere that they go. Whether it was them buying airlines last spring after Buffett sold them, and then the airlines doubled after Buffett sold them, or running into all the non-profitable tech companies, or running up Tesla, or then with the short squeeze, I think that we're finding that there is a newfound investor out there, and that is the individual investor buying stocks on their own. And I think it's a twofold thing. One, there's a lot more risk tolerance there. I think the Fed might have something to do with that, telling them that they all have got their back. And I also think that there's a little bit of a frustration that the traditional products that they would buy aren't seeing the needs they are. They recognize there's a disruption going on. They recognize that there's going to be a big change in the economy, none bigger than the financial services business and the banking business is going to have a huge change. And they want to be part of that. And traditional investment products are just not giving it to them.
So, Jack, let's keep this going, because we talk about the Reddit retail investor phenom, but how do the markets, how do money managers and professionals, work that into your strategies? You got to deal with the high frequency crowd and the sharks in the dark pools. Now you got to deal with this.
Yeah, I mean, I think that's exactly the point, right? Is that this is just one more component to be added into the calculation, just as you had to add in those high frequency traders a couple of decades ago. I mean, 2020 created this monster, if it is a monster. You had a lot of idle time on the couch where you were pretty bored. You had barriers to entry when it came to investing being removed. A lot of these online brokerage services are essentially frictionless. And then you had a world kind of awash in money, ultra easy monetary policy, ultra easy fiscal policy, kind of the perfect storm for creating this retail investor. And their motivations may be a little bit different. Their access to information is certainly different, but their money's as good as anybody else's, and they're going to participate because they can. And so I think we need to just price this in moving forward. And the biggest takeaway, as you mentioned, is I think just structurally speaking, greater volatility in markets in the years to come.
So then, Jack, how are you hedging against some of that greater volatility, just because there is another factor out there where we are seeing risk?
Well, as Jim mentioned, a lot of the names that are getting bid up for fun. They're not necessarily based off of the fundamentals. And so what I still think we can do as longer term investors is focus on those longer term trends. And technology and healthcare, we continue to believe, are long term secular stories. I don't think anybody can make a good faith argument that tech will be less important a decade from now than it is at the moment. And at the same time, we can start to lean into some of those more cyclical parts of the market, some of the laggards of 2020. Energy, maybe to some extent, industrials, maybe to some extent. But as always, and you've heard me say this before, I continue to believe large cap financials may be one of the best opportunities in markets right now. So I think there are still opportunities as long as you position yourself for the long run.
Jim, we've had other analysts on who've talked about financials being a good bet this year, 2021. I'm curious what you've set your sights on to, because there is this concern of inflation. There's this concern that some stocks, some sectors are overvalued at this point.
Yeah, I think going into 21, I've been pretty steadfast that the story of 21 is going to be inflation. Now, I'm in the camp that it's going to return in the second half of the year. I think all the money we've been mailing to people, the stimulus, it's finding its way into the equity market right now. But eventually, when the economy reopens, that money's going to come back out, and it's going to come back out in the form of spending, and it's going to push prices higher. Now, that's my story. If the other side of the equation is, look, we're going to send all the stimulus money out, and there's not going to be inflation, that could actually be a bigger story. Because then the monetary theory crowd wins, the universal basic income theory wins, and we have to go back to the basics of finance and rewrite it. And we're now probably going to see Mitt Romney's bill where we're going to be sending people money every month if they have children, and probably sending everybody else money every month. That's going to become the order of the day if we don't see it. If there is no consequence to sending people money, we're just going to keep sending it to them. Right now, the consequence is the poor get help, the unemployed get a bridge, and the rich, defined as equity markets, get new highs. So keep mailing checks. And I think we're going to keep doing that until we get inflation. And if we don't get inflation, we're just going to keep mailing checks and have to rethink our whole monetary theory.
Jack, what do you think the market is anticipating when it comes to inflation?
Well, when I look at inflation, I mean, I think there are certainly some pressures building to drive it higher, but there are long-term anchors in place when it comes to where inflation can actually go. You have the rise of e-commerce, online shopping. I mean, we as consumers right now have more price discovery power than basically any human being in the history of commerce. And then you have the rise of or a very large and growing, I should say, trade deficit with China. You have the United States coming online as a swing producer in global energy markets after the shale oil revolution. All of these things, I think, keep a lid on where inflation can go. So I don't think anyone is seriously pricing in, 10, 15% a return to the late 70s when it comes to the inflation environment. But is it possible that all of this money sloshing around in the economy right now starts to bubble up inflation in the back half of this year? I think that is entirely in the cards. But what that looks like is maybe breaching the Fed's 2% target modestly, rather than sort of shooting the lights out and getting into double-digit disaster-like territory.
I'm going to say thank you to our guests because we have Disney earnings. Jim Bianco, Research President, Jack Manley, JP Morgan Asset Management. Thank you both for hearing. Jared, what's going on with Disney?
All right, we got a nice beat on several key metrics here. Disney Plus subscribers, probably the focus here, 94.9 million. The estimate was for 90.7 million. So really nice beat there. Adjusted EPS, now this is earnings per share, not loss per share, swung to a profit, 32 cents. The estimated loss per share was 38 cents. So the opposite, basically. Revenue coming in at 16.25 billion. Estimate was for lower at 15.91 billion. Still a substantial drop. I estimate that's about 20% lower than last year, but given what's going on with the parks and the theater, understandable. ESPN Plus subscribers, 12.1 million, coming in higher than the estimate of 11.5 million. Total Hulu subscribers, 39.4 million. Estimate was for 38.4 million. So just reading into the report here, we have a quote here from the report. We believe the strategic actions we're taking to transform our company will fuel our growth and enhance shareholder value, as demonstrated by the incredible strides we've made in our DTC business, that's direct to consumer, reaching more than 146 million total paid subscriptions across our streaming services at the end of the quarter. That is from Bob Chapek. Chief Executive Officer. So just to review these numbers one more time, nice beat on total subscriptions coming in at about 94.9 million, estimate lower. And all the top line and bottom line metrics, nice beats there. So just taking a look at the stock as it is trading right now, the initial pop is up. It's up about 1.88%. You can see over the trailing year, holding on to gains of 35%. And that's pretty impressive considering all the pivots they'd have to make. I also want to mention that they've also announced that they're rolling out movies this year, haven't adjusted the schedules. Black Widow starring Scarlett Johansson, still scheduled to open on May 7th. Already knew that, but just kind of indicative of what direction they're heading in right now. Planning for the best.
All right, Jared Blickery, thanks so much. We want to bring in Dan Roberts for his reaction on this. And Dan, we have to start with that Disney Plus number, 94.9 million. Estimate was for 90.7 million. That was really the number that analysts were closely watching going into this report.
That's right, Shauna. And, you would think that the financials are more important. And as Jared mentioned, a nice beat there on both revenue and EPS. And yet, as I wrote about last quarter, when the numbers financially were abysmal, all that really matters these days for how the stock moves is the streaming numbers. And you mentioned Disney Plus, but also it's key, I would say, that the other two streaming pillars that Disney now has, Hulu and ESPN Plus, also beat the street's expectations for total subscribers. It's remarkable. Jared read that quote from Bob Chapek, and there is some irony that I want to remind everyone about, to see that quote from Bob Chapek talking about DTC, because he was brought on as the head of parks. They pulled the parks chief to be the new CEO. And right now, nothing has really changed yet in terms of the story with the pandemic and the parks. The parks are still either closed or operating at severely reduced capacity. That's going to be a major story, for the next few months or even more than the next year. We'll see how things go with the vaccine. But only a year or so ago, we talked about the parks as the profit engine of the company. That's still the case. I mean, it's not the case right now during the pandemic, but these streaming efforts are not yet profitable. They're pumping money into them, and yet the street loves it. The street loves the growth for Disney Plus. Jared mentioned the plan with Black Widow, and I also should remind everyone that unlike Warner Media and Warner Brothers, Disney has not yet gone the skipping movie theaters route. It is still committed to putting those big Marvel and Star Wars blockbuster releases in theaters. So it's not just going to drop movies straight to Disney Plus, but with some movies, it's doing the hybrid model. They have that next Pixar movie. You can go see it in theaters where theaters are open, or you can pay a fee on top of your Disney Plus fee to watch that. So a lot going on the streaming side. And right now, that's what the stock moves based on, is Disney's streaming efforts.
Certainly is. And we're seeing that stock up just around 2% right now, 195 flat in after hours. All right, Dan Roberts, thanks so much for breaking down Disney's results for us. We're going to take a quick break, but we'll be back in just 2 minutes.
Welcome back to Yahoo Finance Live. Kathleen Sebelius is the former governor of Kansas, as well as the former United States Secretary of Health and Human Services. We invite her into the stream to help us get our understanding about what's happening in the government side of inoculating all of us with COVID. And thank you for being here, Secretary Sebelius. Real quick, the CDC today apparently said you don't have to quarantine 2 weeks after you've been inoculated, fully inoculated against COVID-19. What do you think this is saying to all of us?
Well, I think this is a brand new virus. It's about a year old, and each day scientists learn more. They learn more about what immunity looks like, what the vaccines are going to do, what happens if you've had the disease, and are you able to get it again? So I think the update today makes it clear that they feel strongly that once you have the 2 shots of the vaccine, you have built a strong enough immunity that even if you are directly in contact with somebody who is positive for COVID-19, you don't have to quarantine any longer. And I think that's good news for people. That's an additional layer of assurance around the protection that you will get.
Hey, Secretary, it's Shauna. President Biden, he nominated Javier Becerra to lead the HHS back in December. On December 7th, he made that nomination. He still has yet to be confirmed. I'm curious to get your thoughts just on how this is affecting the country's response so far to the pandemic under President Biden.
Well, I'm sure hoping they pick up the pace quickly with Javier Becerra, who is enormously well qualified to head this important agency. I think the good news for the American public is that there is a COVID team in place, many of them at the White House, and health experts who don't directly work for the government, who are waking up every morning, going to bed every night, thinking only about COVID and the health impact and the economic impact. So that work has not stopped. HHS, though, is a critical factor in that recovery. It's a critical factor in the health of this country. And there are lots and lots of services, children and families, mental health services, Department on Aging, the Centers for Medicaid and Medicare under HHS umbrella, in addition to the FDA and the CDC and the NIH. So getting the health leader in place, getting all of the confirmed new leaders in place at HHS is a really time-sensitive issue and needs to happen as quickly as possible.
And then we had, Dr. Fauci today saying that perhaps by April, anyone who wants to get a vaccine will be able to get to. And breaking news, we've not confirmed, but Washington Post is reporting that the Biden administration has secured 200 million additional vaccine doses that they talked about last month. What do you see that says, yeah, this is actually going to happen?
Well, actually, the news right now on COVID is very good. I think the reminder to people is we absolutely have to stay vigilant on masking and social distancing and hand washing and staying out of crowded indoor events. But deaths are going down. Good news. Hospitalizations are going down. Good news. Number of cases in the United States finally is taking a pretty dramatic drop. That's good news. And we're at the point where about 10% of the population has already been vaccinated, and vaccine amounts are increasing all over the country. What Dr. Fauci is saying, he thinks by April, and that's just around the corner, is that people of all ages, all categories will be able to find and get a vaccine. The extra 200 million doses means that we have now secured enough doses for 300 million people, virtually the entire population, to receive 2 doses of the vaccine. That's also good news. People don't have to wait for a contract to come from another country or wait for something else to happen. So I think the news is quite encouraging, but it's really, really important that we not think COVID is over, that we can just go back to normal. Getting our kids back in school, which is one of the Biden promises, is a critical part of getting the economy back up and running. And that means people need to stay out of bars. Yeah. They frankly need to stay out of restaurants. If we think schools are important, let's get the kids in school and continue what we're doing so the cases continue to drop.
Well, Secretary, real quick, we only have about a minute left, but it sounds like there's a lot to be optimistic right now when you take a look at some of the trends that you were just mentioning, the fact that the Biden administration has secured more doses of the vaccines. But what's your biggest worry as we stand here right now? I mean, what is the number one concern that you have when it comes to the COVID pandemic at this point?
Well, I think letting up on the things that work before everybody gets vaccinated, and frankly, running out of some of the supplies. So the vaccine, Pfizer has said they can double the time or cut in half the time that it's going to take them to manufacture. That's great. We need syringes. We need logistics. We need to make sure this is equitably distributed, that people know how to find and get a vaccine, and that we can overcome what is some people's reluctance to step up and step in line. So we need to keep working on the things that we know work, but we're on a much more optimistic path than we were a month ago.
Former U.S. Secretary of Health and Human Services, Kathleen Sebelius, thank you for joining us. When we come back, forget the Jetsons. Flying cars could be here sooner than you think, and I'm not talking about Studebaker.
Air taxi company Archer Aviation, they got a big order from United Airlines this week. And they also announced that they were going public via a SPAC. We want to bring in Brett Adcock and Adam Goldstein. They're both co-founders and co-CEOs of Archer. And congratulations to you both. You have had quite a big week. Brett, let me go to you first. Just tell us about the small electric aircraft, what we need to know, and what this deal with United really does to boost your business.
Well, thank you for having us on the show. As I take a step back, here at Archer, we are designing and developing an electric vertical takeoff and landing aircraft to be used for urban air mobility. We believe there's been a large step change in technologies for electric power systems the last 20 years that are enabling a new type of aircraft, one that can take off vertically like a helicopter, fly forward like an airplane, and will be using only electric motors and batteries. As you alluded to, we announced yesterday morning a commercial agreement with United Airlines for $1 billion pre-order of our aircraft, with an option for another $500 million order that we will start taking deliveries on in 2024.
So let me throw this to you, Brett. Have you built something that's gone up in the air yet? Because I want to get on one of these electric aircraft. I think it's the coolest thing I've heard about in years.
Yeah, absolutely. The industry has been building these for the last 10 years. Here at Archer, we're flying every single week out here in California. We'll be unveiling our full-scale electric vertical takeoff and landing aircraft this year. So we're super excited. The technology here is fully mature. We're not taking any large technology bets here at Archer. We're certifying currently with the FAA here in the United States. And we view it as a matter of time here over the next 2 to 3 years as we bring this to market and enable this service for users.
Hey, Adam, how big of a market do you think that this could potentially be 5, 10, 15, 20 years from now?
Yeah, that's a great question. And so just to, really help set the stage here, this step change in technology by allowing these planes to go electric really is just the next innovation of helicopters. So helicopters are these vehicles that we all know that exist in the market. There's something like 10 to 15,000 helicopters just in the US, plus DoD helicopters. And here you have these vehicles that are safer because you can scale down electric motors very efficiently and put on multiple rotors so you don't have any single points of failure on these vehicles like a helicopter. You can also change the frequency and dramatically reduce the noise that these vehicles make, because unlike a helicopter, which has one big rotor, they're smaller, it doesn't make the deep wop wop sound, and so they're quieter. And then ultimately, these are electric vehicles that can be highly utilized, so you can offer them at a much lower cost. So if you just think about just the kind of upgrade cycle or replacement cycle of helicopters, it's actually not very hard to conceive that and understand that. Now, if you start to think, okay, well, if I can actually take one of these vehicles and save myself a considerable amount of time, would I be willing to do that? And so when you start to think about it from that perspective, it's so much bigger than just the helicopter market. So
and
going from
imagine, let me interrupt you real quick because I want to get a lot in here. We got United Airlines that order. How big will that vehicle be? And I would imagine too, given the technology you've developed, Adam, it's going to have AI because not everyone knows how to be a pilot. So AI is a part of this, right? So how big is the United aircraft going to be? And will it be AI?
Yeah, so the United aircraft will be a piloted vehicle plus 4 passengers, and that's the vehicle we're in the certification process through. But again, we really just almost have to take a step back and understand the progression of these vehicles. In this decade, we will be largely replacing helicopters. If you think about that, it's thousands of vehicles. It's not thousands of vehicles in one city, right? There's 10, 12,000 helicopters right now. You don't see thousands of helicopters flying over your head right now. Right? But just even replacing the helicopter fleet is a massive multi-$100 billion industry. Over time, as autonomy starts to come to market, which is not the initial go-to-market plan, there's availability to scale this industry beyond. So just the simple cost reduction that these vehicles offer, which are similar prices to Uber, will allow the market to really expand beyond just the existing helicopter market, which is generally reserved for rich people.
Well, and to follow up on that, I guess, Brett, how affordable are we talking? If someone wanted to take a ride in this, how much would it likely cost if you can get that projection now?
Yeah, I mean, one of the best things here is you get when you have this massive step change to electric, is you can build a far cheaper vehicle and you can operate at much different prices than a helicopter. Our entry point is around $3 per passenger mile. So we want to make this service affordable to the masses and an everyday use case for folks, not just traveling like to and from work or to and from the airport, which are obvious examples, but how about places that are too far to travel to today? We're like stuck in gridlock all day long, that you can travel 150 miles an hour point to point. And so we get excited about the near-term case that Adam talked about of, helicopter market and electrifying that. But ultimately the long-term vision here is to start moving people and goods in and around cities. And we think that is a multi-trillion-dollar market over the next 2 decades.
A lot to look forward to, and you guys made me even more excited here about the future over the last couple of minutes. Brett Adcock and Adam Goldstein, congratulations. Great to have you on the show, co-founders and co-CEOs of Archer. We're going to take one more look at the markets here before we let you go. Again, a mixed picture today with the Dow closing in the red, just barely though, off just around 7 points. S&P and NASDAQ both holding on to gains. Coming up next here on Yahoo Finance, stick around for influencers. Yahoo Finance editor-in-chief Andy Serwer. He's going to sit down and talk with Grow Intelligence founder and CEO Sarah Manker. That all starts in just 2 minutes.
Sarah Menker left Wall Street in search of an answer to one of the most pressing questions facing the world today. What does the future of food look like? And where will our food come from? To find out, Menker is leveraging her experience in commodities trading and knowledge of data analytics to forecast everything from agriculture prices to the climate and its impact on our food supply. But it's not just ones and zeros. These models are helping governments and business to predict food shortages and avoid disaster all over the world. In this episode of Influencers, I'm joined by Grow Intelligence founder and CEO Sarah Menker as we discuss food security, how COVID exposed our agriculture system, and why she says we may be just a few years away from a global food crisis. Hello, everyone, and welcome to Influencers. I'm Andy Serwer, and welcome to our guest, Sarah Menker, founder and CEO of a company called Grow Intelligence. Sarah, welcome.
Thank you for having me, Andy.
So I guess I want to start off by asking you, what is Grow Intelligence?
Grow Intelligence is an AI company that is really driven by a mission to help the world better understand our sort of food systems and our climate. And it's a platform that we've built over the past 6 years that harnesses vast amounts of data from various different sources to drive insights, both about sort of the understanding about our food systems as well as climate change.
Great. And so is it a NGO or a for-profit company? Who are the customers? Tell us more about it.
Yeah, no, it's definitely a for-profit company. We're a company that was founded in 2014, and we are a company that started actually in Nairobi, Kenya, and we're global now. And I'm based in New York, and so New York and Nairobi are our two co-headquarters, and our customers are really, players across on the agriculture side, players across the food and agriculture supply chain. So think of that as input companies that sell seed, fertilizer, crop protection to farmers, banks that lend money to farmers, insurance companies that insure farms, as well as those who purchase from farms and serve as intermediaries. So traders, both in the financial markets as well as in the physical markets that move crops around the world, as well as food companies that use Grow to make decisions around procurement, supply chain planning, food safety, detection, and then retailers who get food on our supermarket shelves. So we basically work across the entire sort of supply chain in sort of the ecosystem.
So are predictive models kind of at the core of this? And you mentioned AI. Talk about the actual products that you produce then.
Yeah, so we have one product that serves as a platform for the generation of many, many different products, right? And so the first part of our sort of company's journey was saying, how do we take very large disaggregated data sets that often come in very inconvenient formats and local languages and create a mechanism whereby we standardize that data and organize it so that people can just discover it, right? So the first part of sort of the Grow journey was creating this massive dictionary of terms that have anything to do with global agriculture and classifying them in an automated way. So our platform currently classifies over 60 million terms related to global agriculture. So think of that as everything that can drive the supply side or the demand side, which means we have tons of environmental data, but we'll also have tons of demographic data because that drives a lot of sort of how we eat and what we eat, and the classification of it. And there's a layer of AI there because obviously when you're processing hundreds of trillions of data points every day, classifying that data and understanding that, say you take Canadian wheat exports as a number from a data set, you use neural networks to actually map that knowledge. So that's the first layer of AI. The second part of sort of our journey then became, when you have that much data, one, do you start creating new data about the world
to tell us things we didn't know before. So you train models to create new data sets for parts of the world that don't have as much reporting. And then the second is, do you use that data to generate predictive models? And so our platform has raw data, lots of it, almost too much of it. And where the power of the platform really emerges is in our predictive models, forecasting supply or demand or price or climate models that then people use to sort of drive the decision making. So we have thousands and thousands of predictive models that are built on top of the platform.
How did you see the need for this? And maybe akin to that, what is the use case here? And can you give us some examples?
Yeah, absolutely. So how do I identify the need? So I used to be a trader. I used to be a commodities trader. I traded energy at Morgan Stanley. And I had seen the power that sort of access to data and better information had brought to the efficiency in the markets and the way in which we allocated capital and the way we drove innovation. We take sort of for granted that to drive this, the energy, like, we talk about oil, we talk about gas today, and we talk about shale oil, shale gas. Those only became possibilities because there were mechanisms to finance those new innovations. Renewable energy, it was possible because there was lots of money that went into it. But a huge part of facilitating capital into markets and changing markets is information. And I had seen that there was huge information gaps that existed in the global agriculture ecosystem, which drives a lot of food insecurity around the world, et cetera. And also an understanding that unlike energy markets where it's just a few products, agriculture is tens of thousands of different products. It's everything from vanilla and black pepper to corn and wheat, and each one has a very different set of biological rules that govern it. So for me, it was driven by a desire to say, if we're going to change a system, we first need to understand it. And we want to be the infrastructure and the highway to understanding, right? So it is until we can facilitate that, then we're not going to drive any change. And so how can we be a change agent for industry in driving sort of decision making? Now, to your question of use cases, it is sort of the beauty in what we do and the complexity in what we do. Because we have so much data and we have so many models, it is really, a world where we say, tell us your problem and let us help you ask questions you didn't even need to know you needed to ask. So the system helps you ask questions differently, and it helps you sort of connect the dots. So let me give you one example of how a single model we have can impact every single player across the vertical. So let's take something as simple as, seemingly simple as, what is the forecasted corn production in China today? Well, that has massive implications for everybody across the supply chain. Let's start from the very top. If I'm a seed company, I care about that question and I care about the predictive models that we have around that, because I need to know that based off of the supply there, how much demand is there going to be for my seed the next season and the next season in other parts of the world I'm selling. So for example, seed companies manufacture 1.5 years in advance, right? So they need to be able to predict the acres that US farmers and Brazilian farmers are going to have. And China plays a very big part of that. So they use that as an input to predict acreage. Now, if I'm a bank, I want to understand that because I want to understand farmers' abilities to repay my loans. If I'm a bank locally, it's about local repayment. If I'm a bank internationally, i.e., say a US bank that lends to to farmers in the US, I still care because farmers, the amount of corn that China produces impacts the global corn price, which will impact the bottom line of the farmer in the US, which is how the farmer is going to repay my loan. That same question now applied to sort of a trader. Traders like to buy low, sell high, right? So that becomes a mechanism whereby I'm looking at what global supply is and I compare that versus global demand, and all of a sudden I'm making that decision. If I'm a food company, I use corn as an input, as ingredients into my supply chain. So now that will drive both, sort of the price at which I procure, and it will also drive how much I want to keep in reserves as a food company, because that will give me a sense of what to do. So that same sort of one model gets used in many different ways. So there's the model, and then there's the use case. And the use case of that model changes based off who you are and what type of organization you are. But the power in sort of what we do is unifying that decision-making process so people are working off of some baseline level of knowledge that allows them to have conversations that are somewhat aligned.
We'll be right back with more from Sarah Manker, Grow Intelligence CEO and founder. Welcome back to Influencers. I'm Andy Serwer. I'm here with Grow Intelligence CEO and founder, Sarah Manker. You've put out there that you think there is going to be food scarcity in the coming decades, and this is a critical issue. Why is that?
Well, so I think, some of it we're already facing right now, unfortunately, right? And last year, COVID exposed how fragile our food systems really are, how they're built on very short-term thinking, right? So the breaks that we saw in the supply chains were a function of the fact that, if you think about food and agriculture, it's an industry that's been around for over 12,000 years. However, if I find oil in the ground and I want to go sell it 20 years forward, I can do that. If I want, most food transactions are still done on a week-to-week, month-to-month, day-to-day basis. And so that means that something goes wrong, the system breaks. And so, a huge part of the crisis we were warning against was driven by the fact that it is a global market. And so a global market means that you have sort of supply centers and you have demand centers. And if there's these deep imbalances that are built, you could have, the areas where you have the largest growth in sort of demand could have a complete mismatch from the areas where you have the largest growth in supply or have the largest pools of supply and the cost, right? So it's a function of trade, it's a function of demand growth, and then it's a function of cost. And what we're seeing happening this year, and it's a story that no one's really talking a lot about it, I think it's going to only manifest itself more and more, is that the local cost of food in so many economies has skyrocketed over the past year. Because again, you have net exporting countries like the US and Brazil, Argentina, Russia. But outside of the US, every one of these net exporting countries are having currency crises due to COVID, right? And very weak macroeconomic structures. And what that is leading their governments to do is to start curbing exports. as a mechanism for protecting local inflation, because food inflation is your worst form of inflation. And so in a world where you have commodity prices and food prices that are going up, which is what's happened over the past year, because of demand coming out of China, Chinese demand hasn't slowed down. You have countries that are exporting countries with currencies that are down 20%, which means that if your price of a product is up 15% and then your local currency is down 20%, your inflation is just skyrocketing. So you're having a lot of countries now curb sort of exports and lead to protectionist policies that I think can lead to all sorts of effects.
What countries are you referring to, Sarah?
So Russia, Ukraine, these are very large consequential economies that also play massive exporting roles, and South American countries like Brazil and Argentina, right? So big countries play a very big role in agriculture, but actually play a large role in like global sort of economic dynamics as well.
One thing you didn't mention as a threat, and I know you're concerned about this as well, is climate change. How does that factor into your thinking?
Well, it factors in a huge amount, right? So if you think of how we ended up with, our platform currently ingests over 40,000 different data sources from around the world. Think of it as data that comes from public agencies, NGOs, companies that we partner with and license their data, and we redistribute their data. So it's a wide range, and then data we generate ourselves. A huge amount of understanding agriculture means understanding your environment and ecology. Like if you think of sort of the climate change conversation is this natural tension between ecology and economy, right? There's this tension, like economic growth has come at the cost of ecological decline. And agriculture kind of sits in the middle of the two, because agricultural demand is very much a function of economic growth and economy, and agricultural supply is very much about ecology. And because of that, our platform had tons of economic data and tons of climate data just naturally in it. And so we were able to sort of model and look at the role that climate change has in agricultural supply, and then extend that to many, many other industries, everything from infrastructure to mining to utilities, et cetera. And one of the things that we saw, in a year like last year, the US alone experienced wildfires in the West Coast, experienced floods in the early part of the season, then drought, then like unprecedented derecho winds in the same little microcosm of the Midwest, right? And so you're having multiple types of disruptions happening much faster than they ever did before. And that's going to impact industry in sort of an unprecedented rate. And it is already, right? The number of billion-dollar plus climate disasters that the US had last year was 22. It had 22 billion-dollar plus climate-related disasters. This is everything from hurricanes to droughts to wildfires to storms and whatnot. Now, if you think of the trajectory, if you look at the last 40 years, the last 5 years have had record numbers year after year. The second record after the 22 we had last year is 17. The pace at which this is growing is just huge. And this is happening everywhere in the world.
We're going to take a quick break. We'll be right back with more from Grow Intelligence founder and CEO, Sarah Minker. Welcome back to Influencers. I'm Andy Serwer. I'm here with Sarah Menker, CEO and founder of Grow Intelligence. I want to ask about politics next and how that factors in. We have a changing the guard here in the United States. I want to ask you the implications about that. But the bigger trend is towards protectionism around the world, Joe Biden notwithstanding. Obviously, you can go around the whole globe and just point to nationalistic leaders. So A, U.S., and B, global. What's the environment?
Yeah, so I mean, I think with the U.S., with the changing of the guard, obviously a very big change is around climate, right? Re-entering the Paris Agreement, leading up to COP26, which is happening in November and December of this year, and the role sort of that the U.S. is going to play and the prominent stage that the U.S. is going to take in sort of the climate change conversations, which are economic discussions and are conversations about trade-offs that every country is going to have to make to sort of move to a world of net zero. So I would say that probably is the most consequential change as it sort of relates to the world that I live in, which is climate and agriculture. On the food side, and just in general, I would say that, again, I always remind people food security is a national security. Like it really is. And we always forget it until there's something that reminds us, right? And last time it was the Arab Spring. And I like watching sort of countries like Russia and Ukraine clamp down on exports. I mean, think about it. You basically have a currency crisis. The way you solve for a currency crisis is by getting more foreign exchange reserves. You are sacrificing foreign exchange reserves by curbing exports because it is still more important to make sure your people are fed at the right price than it is to get more foreign exchange reserves in the country. And that's literally the world we're living in today in many, many parts of the world. And so it's, I think there's a lot we're going to be on the lookout for this year.
Quick follow-up question, Sarah. Arab Spring and food security? I missed that connection.
Oh, Arab Spring food security. It was, a huge amount of it was driven by the price of bread and wheat, right? And when you have large populations that can't afford the basics.
Right. Oh, I thought it was an effect. It was a cause of the Arab Spring rather than an effect of the Arab Spring.
Yeah, cause. Exactly.
Let me turn and ask you about you. And how you got to this place. And you were born and raised in Ethiopia. And tell us about your journey. Yeah, so I was born and raised in Ethiopia. I came to the US for college and I ended up on Wall Street after graduating. So I, like I said, I worked at Morgan Stanley, started there in commodities, was always a commodities person. So I've only had 2 jobs in my life. I worked at Morgan Stanley and I was CEO of my own company. And sort of, grew within Morgan Stanley and became an options trader, which was not a typical path, but it was fun. And at some point I realized that I was good at it, but I didn't love it, which is when I left and then started this sort of new journey. But when you were growing up, were you connected to agriculture in any way? Did you live in a farm or, what is it about? How'd you get connected to agriculture, I guess? Well, again, food security, national security, right? One is I was raised in Ethiopia during like the famine that everybody still, had associated Ethiopia with. That was my reality growing up, right? Like, and that was sort of my perspective of what disaster looks like was driven by a communist government and country that rationed everything from fuel to food. And when the 08-09 financial crisis happened, I had a lot of colleagues and a lot of people were like, oh my gosh, like this is the end of the world. And I'm like, no, I kind of know what the end of the world looks like. Like Morgan Stanley stock going to zero sucks, but it's not the end of the world. Like it's, and that was actually what led me to start thinking about food security because, I
I was like, well, hold on a second. Like, if the world's coming to an end, I just want to eat. Like, I keep it basic. And it was sort of that drove me down this journey of asking a lot of questions. And, 4 years of asking why, I eventually realized I was so much more passionate asking these whys, but also realizing how broken our system was, that it was time for me to sort of go to the next adventure.
Okay, Sarah Maker, CEO and founder of Grow Intelligence. Thank you so much for your time.
Thank you, Andy.
You've been watching Influencers. I'm Andy Serwer. We'll see you next time.